in progress.
Good morning and welcome to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman. I am your moderator for the day, and today is day 5, the live trading day, where you will be able to experience an entire day trading side by side with Mark Minervini and Mark Ritchie and myself. We'll also have a Market Smith review from Scott St. Clair of Market Smith, who is our exclusive sponsor for the event. Also, we will have the chance to have questions and answers throughout the day, depending upon how things are going, any trading we're doing, but there's always some downtime. So we'll definitely get to ask some of your questions that you've been emailing me. If you do have any questions still, you can email me at bob@minervini.com. Also, let me just do a quick sound check to make sure that you are hearing me. If you would, please raise your hand. Should have done that to start with. Otherwise, I just spend a lot of time talking and you're not hearing me. All right, great. I do see hundreds of hands raising. Great. If you ever do have a problem, of course, always log off, log back on again with Zoom, but it's an incredibly, for the worldwide audience that we have, it's an incredible platform. So we got to give them credit for that. Good morning, everybody. Let me just take a quick look here.
Okay, let's make sure Mark Ritchie's here.
I'm here. You guys hear me all right?
Yeah, if you could just do a sound, raise your hand hearing Mark Ritchie, please, so we can just verify you're hearing him okay as well. That looks great.
It says host has an enabled video. So if you guys want to see that, then Bob, I think that's on your end.
Yeah, okay. You should have that now. And finally, let's just do a quick sound check with Mark Minervini as well. Just if you can raise your hand with that.
Okay, you guys are hearing me okay? Okay, great. And you can see my screen.
Yes.
Okay.
Raise your hand just if you're seeing Mark's screen again, please. Thank you.
Okay. All right, let's get started. So, Mark, did you find anything last night? Any stocks that to look at this morning?
I've got a list here, comparing notes with one of the lists you pre-sent me as well.
Okay.
Where do you want to start?
Well, I'm just going to start off just
alphabetical.
I'm gonna first go over my layout here and then show how I got to where I am here with the list of names. So first of all, let's just take a look at my layout. This is what I keep open. I keep a daily and a weekly and a level 2 over here. Very basic. This is what I trade off of. Underneath here, I do have a 5-minute that I can access, and I also can just flip up a larger chart here, which I will often, if I want to zoom up here, I'll just flip up the larger chart. Let's just see. I want to make sure because I got this Zoom thing puts things in the way. And also I'll bring up a larger weekly. So I keep those minimized. Other than that, the nice thing about this is the eSignal platform. Everything's tethered. So if I just click on a symbol, it's going to update all my charts, level 2, whatever I decide that I want to tether together. You can make watch list here on the left side. You can also track your portfolio. Right here, I just have full positions, half positions, quarter positions. These are positions that we have open on the MPA platform for our members. I went flat because I want to start today just with a clean slate. So personally, I'm flat. I don't know. Do you have any open positions right now, Mark?
Yeah, I have a little bit of XLE and VIX, but that's it. I'm holding a lot of cash too.
Okay, so we're essentially all in cash here. So armed and ready to go with I ran my screens last night and came up with, this is my focus list for the day, or actually for the week, and this is my on deck, which are a little bit closer, and then I have my watch list. So these are just some names that I'm watching, and basically I put them in a hierarchy system, and then I have buy stop over here. This is what, if I'm going to buy something here today, then I'll move it over here. The nice thing about this platform too is you can just grab a stock, just put it here and move it around. So let's just go over some of the focus list names real quick. Also, I have the indexes here, which I usually just minimize. I have a broader list of indexes right here, and then I have the main indexes right here, which is very easy to access and to see. So I'm seeing my overall portfolio, if you will, and the indexes all in one bird's eye view, and then I see the focus list trading, and I can once we get trading, you'll see I can get an idea of how things are trading just by how much red and green's on the screen and so forth. The full half quarter positions, if I would have a different size position, I could just relabel that, but I can move this around. You can see here, this says R1X. It means I reduced it one time. So it would have been in the full position, but then when I reduced it, I move it down and I put in here reduced 1X. So now I know that that's a position that I already reduced and I took some profit on. Up here, I keep a sold list so I can go back and look at the stocks that I sold. And also I may still want to keep an eye on them, that they may reset, something I might have gotten stopped out of and so forth. So that's, some people think that I trade and I've got 15 screens, and I do have another screen to the right of me, but it just has my order entry on it. So I can look at everything here and still enter an order at the same time. I don't want to go off my screen while I'm entering an order. So I do have right now I have my TradeStation account open on the other screen here. So you'll hear and see that, I guess, if we put some orders in.
Mark, people are asking, what platform are you using?
So right here, this is, I thought I said it, this is the eSignal platform, which I previously used to use something called quote.com. I used it ever since the 1990s. And then eSignal bought them. And this is pretty similar to quote. I liked quote.com a little bit better. But eSignal purchased them and I ended up with eSignal. And the reason why I like this eSignal platform is because, like I said, everything's tethered and laid out in a very logical fashion. With this little, I know you're not seeing the whole screen here, but this little green hash mark, you can go in here and you can link, if you want to link everything, or assign a color, and then you can go assign a color to your other charts, and you can link whatever you want to each other. So now when I click on Monster Beverage here, it updates all my charts and my minimized charts. So I have charts here that are minimized. I open this, it updated this weekly. It's updating everything on my screen, or it doesn't have to. I can say I want it to update in this screen, and this one stays static. And it also, will update the level 2. So you've got this portfolio management. Also, like if I buy shares here, I can go in here and I can put in how many shares and put in the price, and then that will journal it right here. So it keeps track of, it's a portfolio, management tool. And I can make these lists too. It's real easy to make lists. You just go in here and you put a blank column in here and right click, and you can just title them. You can see here I got the focus list, my on deck, my IPO watch list. These are just some IPOs that I'm watching here that they're not ready yet, but they're the closest IPOs that I see that are maybe in bases or close to being in bases. This MBLY just recently came public. I'll show you all this. We'll get to this even more and answer your questions as we go along here, and we'll look at, and this all came from generating from MarketSmith. So running the screens on MarketSmith, and we're going to get into that in depth. Right now I want to see if we can find anything to trade. That's the first thing. And we have all day and to discuss things, and we have, of course, Scott Sinclair from MarketSmith. So my focus list, this is again, this is what I'm focusing on. That's why it's called my focus list. And some of the names here, let's just go through this list and take a look at some of these names. And I'm going to bring up a bigger chart here, just so we can see. So this is, just a big VCP forming this big cup with handle. If I zoom up, another nice tool is you can just zoom up and down like this. I know some of the other programs can do that too. And you have this measuring tool where I just click and I can now measure. See, that's 6.5, 6.7% peak to trough. I can go like this, right? I can measure the base. I haven't seen this tool, this measuring tool, anywhere else up until, but I haven't, I shouldn't even really say that. It's kind of misleading because I've been using the same thing for so long. I haven't really looked at anything else, but the few other programs I've looked at, and I've heard a lot of people ask about this tool. It's a really nice tool to be able to measure quickly. So this is an acceptable range here. This 6 some odd percent pullback on this right side. You see, we've gone through these iterations, right? So we've got this first correction here, right here. Then we've got the second one right here. That's 13%. Now we're at about 6.5. So as I pointed out before during the curriculum, they usually about halve themselves, these contractions. Like here you're about 30, now you're about 13. That's just about half. 15 would be half of 13, almost perfectly half. That's generally, not exactly, but they'll generally about halve themselves, sometimes 2/3 or 1/3. And as they get smaller, you're looking for, of course, that right side development. And there's a lot of things to look at, volume, and to put together by analyzing this chart. But right now, we're just going to look at the right side and try to find some tight final contractions here. Now you can see also in this final 6%, within the 6%, you've got a low cheat forming here. You're getting nice and tight right here, and this is one that I've been looking to buy for the past few days. It has not moved through the pivot here, which I would put right in this area right here. If you want to give it a little bit of room, right about here is fine. You can maybe, if it opens up quiet today, I would look for it to open quiet like this. I would actually like it to open up quiet and stay quiet, maybe for even another day, and do something like this and come out. I'll probably start buying it as it gets through this level right here, and then from there, I'll watch it, see if it tightens up even more, maybe add to the position. In this type of market right now, and coming from cash and not having much exposure on, I wouldn't take a big position here. I wouldn't just go in and take a big position. And even if it takes off and I got it right, that's fine. I'll go with a small position, as we talked about progressive exposure. So that's one. So now,
Real quick, Mark.
go ahead. Jump in
Apparently,
anytime if you guys have a
yeah,
question.
Trading View and Thinkorswim also has a measuring tool like that.
Okay, so maybe that's something that has been added lately, because I know a lot of people said that they didn't have that tool. So ADM right here, I'm going to watch it here, these levels right here. A lot of times I'll set an alert even before it gets to my breakout level, because I want to get a heads up and get ready and set my buy order, because I do everything manually. I don't put in orders and let them put them in with the broker. I enter them manually, and I usually trade. And if once I start trading size and things are working, I trade in 5,000 year blocks. So let's see. So here,
And also, real quick, if I could, Mark, people are asking the moving averages, guys. The blue line is the 20-day simple moving average. The red line is the 50-day simple moving average, and it's kind of a gray, but it's the 200-day, right, Mark? Is the 200-day is that gray line? So it's just a three simple moving averages.
So you can add alerts here with this. I'll bring this in here, and I'm sure you can do this, with any other program too. Get it in the screen here. So here, what I'm going to do is I'm going to take a look, and I want to see it when it gets above. I want to know when it gets above that 95.70 right here. I know the high today is or Friday was 95.61. I'm going to put it above 95.70. So we'll just say 95.71 for right now. We'll go 95.71. And so now that sets an alert, and I've got a visual right there. It'll also, an audio alert will come up and let me know. Let me see, do I have let me share my sound of my, okay, I shared my sound on my screen so you can hear that if that happens. So if that should breach that, it'll let me know. And then I might be interested in buying it. Like I said, if it gaps out of here, I probably will leave it alone. If it opens up quietly, then it could be a candidate. So I'll set that up right here. I'll put that to buy stop. So I'm just going to move down the list, and then Mark will see if you have anything in addition to some of these names. If you have any comments on these, of course, feel free to chime in. AKRO is one that we actually put on as a buy, or actually it was on our breakout alert right over here. I think it was on this day right here, the 29th. Came out the day before. I did not buy it. However, it's still holding up really good, very strong, and setting up on the right side here. So we'll keep an eye on that. ALNY is another one that is trying to set up this low cheat. Again, it looks like it needs a little bit of work, maybe a little bit of tightening here. So not price ready perfectly just yet. BTU is another one, big base here. And again, just the same exact analysis as we went over and all those precedents in these past 4 days of curriculum. Again, if you just draw a line across right here from that pivot point, you can see it's contained. Most of the price, almost all the price, has been contained below that level. So now as we're tightening up here and the volume's coming down, this is where we want to start looking for a potential entry. CVI, just trying to find something that's actionable today. So with this, I like the double bottom here, and we're starting to tighten up again. I'm going to measure this. Let's see. So that's about 15%. So that's a bit too wide here, but now it tightens up over here, and this is about 8.8. We'll call it 9%. So now we're in that single digit. I can start considering this, and I would want this to open up quietly and maybe start turning up from there, and I can get enter a pullback buy and maybe start a position there. So I think that's one that I can put in here as a potential, although I've been being careful with these energy names. Let's put an alert at 40.21. So when it gets to that point, so I'll come over here. Let's go 40.21. So we'll have an alert there. Nope, that didn't. Why didn't I go put that up? Hold on a second. I'm sorry, I hit the wrong thing. I don't know why I did that. Let's start over here. There we go. Sorry. Say 40.21. 40.21.
Attention,
Alert.
an alert target has been reached.
I misread it. Okay, 40.21. It closed on it, so it went right. So we'll go a little above that. I don't know why it's on at or below. Should be at or above. 40. Let's go 40.22 right above it. There we go. Okay, so now we've got the alert set here. Let's see what else we have. DG. So DG, again, this is one that I'm pretty sure I bought it back here. We had it on the platform, but then it failed. It tried to come out of this nice little tight VCP 1, 2, 3. Now it's trying to reset. This is what we were talking about, how you may get knocked out of a name, but it may reset. This is a pivot failure that took a long time to reset, but you had a big decline over here. And again, a lot of supply to deal with because such a quick, big decline. So now that culminated in this digestion period, and now it's trying to tighten up here. This is a bit sloppy for me on this right side. Let me see. So we're looking at pretty tight though. You're less than 8%. So right here is super tight. I'll keep that as a potential. We'll put that down here as a potential. DGII is one that I've been wanting to get on board lately. It's acting really strong, but it just been sort of just wedging its way up and kind of volatile. So haven't really found a way to get on board that. And PH we just bought recently here coming out, but it reversed, it squatted. So we'll watch that today. That's a potential too. Let's see, KRTX. So this is a low cheat forming here, or certainly a cheat. You could even make an argument right here for a low cheat. It tightened up a bit more. So again, this is one that we'll keep an eye on here on this right side. I'm going to put that over here. KRYS.
Mark, I got to jump in here. People, there is a view button in the top right corner of your Zoom screen. If you have your video feeds of Mark, me, and Mark on the right-hand side, you can adjust that to go to the top because some people are saying it's covering up your chart. So you need to manually on your side, adjust your view screen with the Zoom feature. That will get the video off of Mark's chart, or not covering it.
I'm not covering up the chart. I'm exposing the whole thing. So
yeah, it's they just have it on the right-hand side, not the top.
So here's this Merrimack Pharmaceutical, which recently took off here. Mark, you know a little bit about this one, right? We looked at this in the past few days.
Yes,
Yeah.
that enormous gap was on I believe a phase 3 approval for or a good study, not approval yet. They're putting the drug up for approval, so that's why the stock's having that huge gap.
Yeah, I'm gonna look at the weekly here. So we've only got 1 week here. We don't have too much time of it consolidating, so it is pretty short right now. 1, 2, 3, 4, 5, 6, 7, 8 days. So this is a bit premature. Usually when you go this tight, it's like a proposed merger or something, and the price goes completely, flatlined. So this is super, super tight, and I like it, but it is a little bit strange on how tight it's gotten. But I'm gonna keep an eye on this today for sure. Let's see here. Monster already came out here or started moving up from a pullback by here a few days ago, then tried to move out on Friday, but didn't get out clean into new highs. That's one that's a little compressed up the right side, but also looks pretty good. PCVX. This is one that, again, this is very similar, where you had 1, 2, 3, 4, 5, 6, 7, 8, 9 days short, came out here. I actually bought this. This got stopped. It didn't work out and got stopped out, had a shakeout here. This may reset. This could also be a Hardaway crossover if it just takes off in the next day or so, shakes you out, and boom, off to the races here. So we put in a couple more days now. Again, a power play like MACK, really tight but short. So I'm just gonna keep an eye on that one. Let's see here. And you see that actually came up on my failures list. I keep a little list here of stocks that failed, and that was one of them. Let's see, PRCT. This has a pretty well-defined pivot over here on the right side. A little bit of supply here. The action is a bit erratic here on the right side, but it is tightening up. First thing I would do is just measure. See, this is about 20% or so. So that's a pretty big decline. And then right here, this is pretty tight though. So it is a little bit volatile right here. So that gives me a little bit of pause. And the volume, volume's coming in here. It's not too bad. We'll keep an eye on that one. Let's see. Just move that over here. PRTA. So PRTA is another one that tried to come out of a power play over here, but ended up needing more time. You can also see that the 200 days only been up in an uptrend for a short period of time. This is what I've talked about, how sometimes the power plays that just take right off after they're in a downtrend or in a long sideways move, you won't get that confirmed stage 2 uptrend. And that's sort of the caveat with power plays. You can entertain them even if you only got a month of the 200-day up. Any less than that, if they're in a downtrend, the 200 days in a downtrend, they become a lot more failure prone. So you got to be careful with that. But this could come off the lows here and you get a pullback buy again. I wouldn't take my full position, but I'm going to put that up here as well as one to watch. TH. Another one where you're forming that right side here. You shook out the low. You came ripping back here for 4 days and now setting up that right side. I do want to keep an eye on that. And then T-Mobile is one that I've been wanting to get on board, but it just simply, fundamentally, I like what's going on. It ripped up the right side. Now it's pulling back here, and just haven't got a chance to get any type of price action to get a good pivot. I'm not going to go over the on-deck names right now because we have a few here. I want to see, Mark, did you find anything other than what we have here?
Yeah, I think you went over some of the better ones, but one or two other ones maybe that could, AutoZone. AZO is, kind of putting this pullback, a little pivot to the base. My guess is that's already on your on deck list.
Yeah, it's right here on my on deck list. Yep.
So it's not one. And then Regeneron, which is a name we've been following for a while. Still holding up.
Yeah, we have it as open. I had a small position of that, but I liquidated it, of course. But yeah, trying to tighten up over here. That's still a bit sloppy, but again, first thing I do is I like to measure. and see how much. So this is a 9% from peak to trough. So this whole basing period has it looks pretty sloppy in here, but it's very tight. It's very tight. So that's good. That means that, you could maybe try to, take a little bit as it starts turning up here from this pullback, and you're trading pretty close to the danger point. Let's just say, you buy it coming out here as it, if it can open up, just get my tool here. This is a real pain in the butt. Well, I'll tell you, I have to get rid of these zoom controls. Hold on. Hide
float it or something.
floating meeting controls. Yes, there we go. Okay. All right, now I can go freely. Yeah, so you're trading close to the danger point here. Maybe if this opens up quietly, and it comes out, you start buying a little, turning up here, and now, from here down, even if you gave it all the way down to these lows, you're about 6 some odd percent. So you're within mathematically, and the chart would sour when you start taking out these lows. So you had some support here. You see right around these lows here. You did get some good supportive action. So that really should hold at this point as you're tightening up here and you're getting that support. And now you get real tight here. This is where you're trading close to the danger point. So let's pull that over here and keep an eye on that one.
More question being asked is if you watch or look at any of the pre-market activity on the names that you have on your watch or on your focus list.
Yeah. So not really, but I'll show you. And again, this chart, let me just move this around here because this zoom is messing me up a bit here. Hold on.
Yeah, we can see that nicely now.
Yeah. Okay. What I do is that I have a weekly here, right? But I also keep, and this is what I'll do with the 5-minute here. This lets me see the pre-market, what's going on in pre-market. So just as I click through here, here's the 5-minute chart. And that's really the only time I really use the 5-minute, or sometimes if I'm buying a pullback buy, I'll watch, and it's midday. I'll see if you're forming a little VCP or some type of cheat area on the 5-minute, and that's where I might look at it. But you see, I can see in the yellow here, I see the pre-market, what's going on in pre-market. So I usually in the morning, this is what I look at, and I'll leave this 5-minute open, and it'll let me see what's going on in the pre-market. So I do want to know if the stock's gapping up or not. But as soon as the market opens, I see whether it's gapping up or not. I'm gonna just quickly scan here and see what's up or down. And what I'm looking for is I'm looking for the stocks that are quiet. I want them to open quietly. If it gaps up, I'm not going to chase it. If it gaps down real big, that's obviously going in the wrong direction. I'm looking for the quiet stocks, the ones that are on my list, and maybe they're kind of flat. And then I look at those charts. I already know what I'm interested in, though. You see, I know CVI, ADM, a couple of these that I'm interested in. I already know the stocks that I'm interested in. So as soon as they open, I know what I want to see. I want to see the stock open quiet. Great. So I want to see a flat number, and I'll show you that in just as soon as we open.
Mark, good question. Do you have your with the open positions? Do you have your alerts for setting your stops, or do you have stops entered with brokers? And that's for Mark Ritchie as well.
Yeah. So I don't set stops with brokers. I set stops when I have my own open position. I just set a stop. Usually it's before that level too. When it starts closing in on that level, let's just say it's 5%, I might set it at 4 or 3. So now I know it's getting close, but I'm watching the stock so closely, I know. And I also know just by right here, by the percentage gain, these are the percentage gains and losses of our current open position. So you can see, I can sort them here too, see? So, again, the largest loss right now is 2.76%. Largest gain is 17.96%. So that's what that's going to stick right out. As soon as that starts ballooning, I'm watching this very carefully. And then, of course, and I have Mark Ritchie, and Mark Ritchie has, a co-trader. And so we have a team. So I've got that luxury, but yeah, I'm watching it, and I'm putting on an alert. I'm not putting it in with the broker. And that's simply because of size, with now, if I just have, a very small position, I might put it in with the broker, for convenience. If it's 1,000 shares, a couple thousand shares, then I might just put it in with the broker, and then if it hits my stop, it hits my stop. But when things are working, I'm usually trading much larger than that. I'd be trading 20,000 to 40, 50,000 shares. I'm not going to put that all in there, at a market order and then and blast the stock.
Mark Ritchie.
Yeah, same. I set a lot of alerts, and then if it's something I want to buy, though, I know I already have the size prepared. I know everything in advance. I'm just not letting it sit at the broker.
We got off track here too, Mark. Any other names?
Not. I mean, from there, the quality starts to go down. So there's
not many.
Yeah, there's not many. I mean, Pepsi is one that has a decent looking weekly chart, PEP, but that's not for me anyway, just because I like the weekly better than the daily. But even that whole area on the right is reasonably tight. Pretty conservative name, though.
Right. And when he says he likes the weekly better than the daily, what he's talking about is, the daily we don't have that tight pivot yet. So we may be getting there on the weekly. You can see it's a pretty big base here, and we're setting up, but we have to go back and find that nice tight trading entry. And so again, what I would do is, first thing I would do is measure right here. So that's only about 4.5%. So it's super tight. I mean, you could buy this breaking out, but I'm looking at the chart relative to itself, and I want to see even more tightening here. This is still a bit erratic within the chart here. So even though percentage wise, it's pretty tight, I'm a real stickler for getting that VCP action, because as we pointed out back where we talked about why volatility contraction, because we're looking for that explosive action, and we want to see that volatility come way down, the volume dry up, to give an indication that supply has stopped coming to market. Why? Because that's what creates the potential for very quick explosive action in your direction of your trade. And the goal is to get at a profit right away. That's what we want. We want to trade as low risk as possible and get at a profit as quickly as possible, because that opens up those other options of financing risk, or even taking profits, and that's the goal.
Question being asked, you have the level 2 open. Why? It seems to be kind of antiquated anymore. And do you use it, or how do you use it?
Well, just look at the bid and the ask. I don't think it's antiquated. It's bid and ask. I mean, you have to see the bid and ask. That's what you're going to be buying at the offer. You're going to be selling at the bid. And sometimes, if I'm taking a really big position and I look at the bid and ask spread, if it's $1 and I'm going to buy 20,000 shares, I don't want to be at a $20,000 loss right off the hop. So I usually watch and see if that bid starts coming up and that spread maybe narrows. I might avoid a stock like that, depending, on the size that I'm trading, and it depends on how things are going. Once again, if I'm down in my account, and now I started ratcheting up and I don't have much traction, I don't have much in the way of profits. Well, I'm not going to put myself at a 1-point loss right off the hop, even though it might be $100 stock or $500 stock. I might not want to do that, because now again, if my timing's off, that stock starts going and then it turns right around, like many are doing now. We're getting a lot of these squats. They break out and they turn tail, and next thing you know, you're down. If starting off with a wide spread like that, I could be down 2 or 3 points in just in a heartbeat. And now, you got 10,000 shares on, 20,000 shares on, you're down 30,000, 60,000, $100,000. It's all relative too. If you're trading smaller, it's not to minimize, if the loss, if it was 500 shares, it all depends on, what's relative to what's a lot of money to you. To me, I started off poor, so I respect the dollar. Every dollar's, I don't just say, oh, well, it's just $500. I'm trying to lose nothing. That's my goal, is to lose absolutely nothing and to trade as perfectly as possible as the stock is moving in my direction, get myself at a profit right away. And Mark will tell you the same thing.
Guys, we will be going through Mark's screening process. Get a lot of questions there for that.
Right now it's 9:05. We're gonna go over MarketSmith in more detail. I'll bring this up right now in just a second. Go ahead, Bob. Do you have something to say?
Yeah, just a question was being asked if you have one brokerage or multiple. You did mention having that mirrored account for the story you shared, and people are asking what brokers do we use?
I'm not going to recommend a broker. So I don't even know how many accounts I have now, about probably 12. I have a lot of accounts, but I trade generally off of just one at any one time. Right now I have my TradeStation account open over here. I think I've got $8 or $10 million worth of buying power in it. It's a smaller account right now. I have also a backup account. For any account that I have, I always have a backup mirror account. So again, I have a bunch of different brokerage accounts, but you can use any of them. The IB platform, TradeStation, Ameritrade, E-Trade, Thinkorswim, of course. They're all basically, you're going to get decent service as far as execution. Some may be better than others, some have better short box, but the tools, I guess, are most important, of which layout you like the most, and the tools and so forth. TradeStation I've used for a while for my execution. That works really well, but I have pretty much all of them. What do you use Thinkorswim, Mark, Ritchie?
No, I have right now I've got TradeStation and IB up as well. Those are sort of the primary ones. I also have some other ones as well, but those are the main ones.
You probably have IB because that there's some other instruments that you can trade on there in foreign, right?
Exactly. I mean, but I don't know. I've demoed a few. I don't know. You've probably demoed more than anybody, Mark, but they all have their strengths and weaknesses. I don't think there's there's no one stop shop I would recommend.
No.
And one of the things to share, guys, is exactly that. What you have a need for, if you're a mobile trader, you're out on the road, you may want the one that has the best mobile platform, or if you're in front of the computer and things are important to you, that's a really unique decision. I will share that we all, if you notice, have multiple accounts for multiple reasons and multiple needs for different features and functions. I use TradeStation as well as my primary, but Interactive Brokers is by far our most common brokerage from the international community. So they really seem to be the best from the standpoint of being an international company and can operate, sort of globally, but they are US based. So you do have some security and comfort with that. But otherwise, question mark is being asked on the e-signal. If first off, using the elite version or which version of it is being asked, but also separately, if it connects to the broker, or do you trade separately from the e-signal chart?
I think with e-signal you can connect to the broker. I see there is buys and sells capability, but I don't use that. I trade separately on a separate computer. I mean, if I'm traveling, I do it all on my laptop and I kind of switch back and forth, but I like to be able to trade, and I have a keyboard that I can move around if I want. It's right to the right here. I like to have my order entry separate so I can watch what's going on and keep this whole bird's eye view on this charting on the e-signal, and then put my order in and keep those separate. And then I have a pretty big screen. I think it's like a 20 something inch. It's a desktop that I keep my trading platform on. So this, I don't know if this is the elite version. I don't know. It's just, I've been using the same one for so long, and I just update the software, but I'm not sure. I didn't know there was an elite version, to be honest with you.
I think there's a signature and elite.
Again, these are the least of your worries. I mean, you just get a platform that gives you charts and can track your list, and that's just a tool. There's nothing magical. It's just whatever one you like that works the best for you.
One thing I was just about to say, Mark, is this is a pretty expensive piece of software just for charting, and I don't think, Mark, you would recommend you need to spend this kind of money just for charting, because most brokers include charting with your account. But one of the things that Mark really has the need for in particular is this portfolio management feature, which we're sort of advising on the MPA service trades that Mark might not be taking. So it's a little bit different need that he has. I think for most everybody, you just need to know what stocks you own or not, and you don't have the
Yeah, but
same
with
need
all-
of this portfolio management.
Yeah, not to contradict you, Bob, but you're right. But regardless of before MPA or any of that stuff, I use this exact same system.
Yeah.
So so I'd have to say that that's true, but not completely true. This has nothing to do with me advising others. This is what I have used for 30 years. This exact layout I have had all the way back to 91 or whenever it was. I don't even remember. 91, actually, no, maybe 95 when we first started getting these kind of quote systems and online trading. I was in the mid 90s. I think I'm so old now I can't even remember. But anyway, I've been using this for a long quote.com since the 90s, and it was the same layout. Just had a couple different features with the alerts and stuff there was some really quick hotkey things that I liked. There were minor differences, but I just was so used to it that when I switched over, probably now if I switched over back to quote.com, I'd probably feel uncomfortable because I'm used to this one now.
Curious, Mark, just for a little history lesson, what were a lot of guys using prior to real-time charting? And I know you were like printing this stuff off, but yeah, curious what you were using then.
Well, when I first started, I was using the newspaper. I was actually trading off the newspaper, and delayed quotes, and that was the first thing we had. So they were like 20, 30 minutes delayed. So it was really quite archaic. But when I first got quotes, they barely worked. I had that little quote trek, and that was off of FM signal, and it was then I did have quotes. It was just all you had were just green. It was just basically this part right here where you would just get a list and you would get your bid and offer, and there was no charting. Then later on we got online access, and then you started getting charting, and I was using weekly charts from Daily Graphs as my screening, and I would just flip through the pages. As a matter of fact, those books, we usually show those books. Yeah, they're right here. I'll show you those books right here. I actually these are the books that they're broken down into the New York, and some of you probably know this, but these are the books right here. They're broken down into the New York and the NASDAQ, and then and David Ryan and we'd love to go back to this. I'd rather have this than screening, to be honest with you, because this makes you have to do and see there's 4 charts on each page. And this is how we would screen. We just flip through and just look at the charts. So, and then, we just watch the quotes. And then when a stock hit the level that we wanted to purchase it at, we pick up the phone, call the broker. They would say, okay, we'll get back to you, hang up, and then call you back and let you know what your execution was. So it was a long time in between where you would know where your execution was, and the spreads were real wide. So there was a lot of risk because you could be buying a stock with a $3 spread, fast market, and it's breaking out, and then it turns back against you, and you hadn't even yet gotten the confirmation that you own it yet. You don't even know if you own it yet. So it was definitely much more difficult. Now trading is just so easy.
Mark, questions to both Marks. Do you ever do any trading pre-market or post-market? I
almost never. I don't do trading pre-market or post-market almost ever. Sometimes there's an earnings report and the stock gap's real big in after hours. I sometimes will use it to sell, but generally I'll give it till the next morning.
Same, exactly the same.
Any trading outside of the U.S., either with ETFs or ADRs?
I don't, but I think Mark does at times.
Yeah, very occasionally. But yeah, I would say 9. It's one out of 100. Maybe even less. If I see something maybe like a power play in another time zone that has liquidity, I might play it or something like that. But the other thing, I like to sleep, guys. So if it's the markets are stressful enough here in the U.S., so I'll just keep it here. That's kind of how I do it.
Yeah. Real quick on MarketSmith. So the easiest way to screen, to find stocks that are potential leaders is just to run a screen where you have This is really just my, my main screen is that I'm just running relative strength, and you can put a cutoff. I have it at 89. I'm usually looking at 89 and above. Current price, $10, 25% off the highs, the maximum I would want to go. That's actually, I'm almost never buying a stock 25% off the high, usually 15 maybe off of a low cheat. No closed-end funds, ETFs, and trading 100,000 shares a day. That brings me to 539 names. So that gives me, and then from there, I just sort them into relative strength. And then if you just hit the space bar on MarketSmith, you can go through those. I'm sure we'll go through this with Scott Sinclair. And now I'm just looking at the charts with my eye and looking at the strongest to the weakest within that range. This will get you in the direction of almost all these stocks will be in stage 2 uptrends. But if you want to make absolutely certain, or you can run even a separate screen, here's the trend template, and I'll show you how you can do that. So there's a couple ways, and I got to open this up a little bit. If you just go to stock ideas right here, and you go to weekly review right here, right below O'Neill is Minervini trend template. And if you hit that, and that goes down the bottom here. So I got to open that up for a second, show you right here. You can see the screens, and you can just click on those. But let me show you another way that I do it, or you can do it. You can make a screen. You put a new screen, and then over here, where you're screening from, the database. Like if you put this right here, this is from, it comes up, MarketSmith database. See, this is of 9,697 stocks. But if I go to the trend template, what I did is I made it right here. You can go right here and you can decide what you're screening from. What is your beginning database? So this is a screen where 89 and above, 50,000 or more, current price above $12, but they all have to meet the trend template. So now this brings it down to 197 names. These are all names that will be in a confirmed stage 2 uptrend. And then here is the 1 month, where again, this is just the same criteria, just from the 1 month trend template. Now that brings it down to 50 names. And then I'm putting them in relative strength order. So I'm going to see the strongest first. And then here I'm going to screen down and go through them. And I want to see, I want to look at the strongest stocks. Those are the ones I'm going to prioritize. So that's 98% of my screening. It's that simple. Then I will, if we're in a correction, a bear market, particularly if we're in a bear market and when we're trading down by the lows, I run a RS new high, and that will give me stocks that are trading with their RS lines hitting new highs. Also, if I want to single out a group, this is a way here where I'll show you. You can just set it up. This is $10 ETFs, 50,000 shares or more in the solar group. So now this brings up 12 stocks. And then I put them in relative strength order. If I do that, you can't see the bottom here, but it's just a list of names. There's 12 names. So FSLR for solar comes up first. That's the strongest stock. As I go down, ARRY, 98 relative strength. We go to ENPH, 98. And as you go down, you'll see the charts get worse and worse. and as you go down, there are stocks that I wouldn't buy. And you can see when the earnings dates are coming and so forth on the chart. So this is a way to just look at a specific group. If we want to look at a specific group, see what's setting up in that group. And I do have some of you that want to have everything covered. You can certainly put a screen together like this. This is what I call the techno fundamental screen. This has got a bunch of stuff in it, but again, there's nothing magical about it. You're going to see the exact same names. Like there's all overlap. The only you're going to see if you run this RS screen, this is sort of the net that grabs everything. So I would rather run this and then just look at the fundamentals, because if I run a fundamental screen, I'm going to knock out the biotechs. I'm going to knock out stocks that I might want to buy, and I won't see them. So here's the thing about screening: if you put 100, say you come up with the perfect screen, and there's 100 variables. If it misses on just one, you won't see the stock. It would have to meet all 100. That's why you don't want to, the mistake that people make with screening is they try to put too much criteria in it. It's better to put less criteria, run a couple different screens and sort of slice the market up in different ways. So what I do is I slice it up into the relative strength and then the IPOs, which that you won't have the stage 2 uptrend, and the relative strength sometimes won't be there as high. So now the IPOs, I run that screen, there's 107 IPOs. Watch this. I put them in IPO order. You can put it in IPO date. So if you put them in IPO date, what will happen is the newest IPOs will come up first that meet your criteria. And then as you click through them, you'll see they'll just elongate and they'll get longer and longer. And you'll go through all the IPOs from the most recent developed to the longer. And I just put it a year back. So I'm looking at all the IPOs that came out within the last year. I'll show you what that looks like. See, it's just IPO date. This one's actually 2021 on. Current price $12. Our RS rating 25. So that's looking at virtually everything. Okay. Let's see here. Any questions on screening?
There's a lot of questions, but
I'm sure there's tons of questions.
Do you have your alerts set for after hours so that it will trigger if some news event is affecting your stock price after hours?
I do not.
Biggest question seems to be when buying a stock, are you using a market order or limit order?
Usually using a market order. It depends though. Of course depends on the situation, but usually I'm buying in block and I'm breaking my order up into blocks and buying it at market.
All right. All right.
So it's 922. And I think the stock that's set up the tightest right now is this ADM, which is in the agricultural area. It looks like it's set to gap up a little bit here. Let's see, what's the XLE doing? Just want to see. So XLE looks like, just zoom out a little bit here. Looks like it's coming under some pressure here. So closed around this 91 change, looking at 89.76, which is around the low here. It's still within the range, staying inside. And the market, I don't even know what the market's going to do here. Let's see.
Market, I think it's down about 40 points.
Okay, so market's down about 40. Again, I am really focused on the stocks. I don't focus on the index as much. Usually I just minimize this and I watch my stocks. But I want to know, of course, what's going on with the market. I've got CNBC on right now just to see pre-market what's happening. But I'm focusing on the stocks. I mean, this what's guiding me is this list right here, my focus list, my on deck current holdings or stocks that I may be just watching, my buy list. That's what is determining what I do. It wouldn't matter if the Dow was down 300 points and was gapping down today. If stocks were setting up and they were breaking out, I'm gonna probably buy them. I'm gonna buy something. I'm really 99% of everything that I do is the catalyst is the stock itself, the individual stocks. Even my overall market calls and opinion of the overall market and buy and sell signals are highly dominated by the individual stocks. We do have the risk model that I've put together that we've been reporting to our members for the past decade or so. That's done a really great job of keeping us on the right side of the market. But the components in it are new highs and new lows, up, down volume. One component of it is the general market, basically the O'Neill follow-through date distribution strategy, just a little bit permutated a little bit differently, or actually it's closer to the older way that O'Neill did it. They changed it in IVD, and then the individual stocks. So, but then we also have what you call the STEM models, stock trading environment model, and that's based purely on just how the individual stocks are acting. And right now, That's on, we have red, orange, or green, and it's on red right now, which means it's a very risky environment and there's not much that's working. So we're in a very cautious mode right now.
Real quick, guys, I just want you to be able to appreciate something. When I first saw Mark trading and you see my office, and even though this is not my real office, this is just a background, but I actually do have like 10 monitors in front of me. This screen is really all that Mark is operating off of. As successful as he is, as accomplished as he is, he's primarily focusing on this one screen, just flipping through the stocks, staying alert, staying on top of them, screening through them. And it's amazing just how simple it can be. You don't need a lot of fancy stuff and a lot of, whatever is going on to become a successful trader. It really is something. Keeping it as simple as you can is what Mark has perfected, is what I would say.
I manage tens of millions of dollars and take as much as a $10 million position with what you're saying right here. This is it in one screen of my order entry. So, I all these, like, again, all these indicators, all these things, these screens and everything, it's all about knowing, having skill, the skill to read the chart and to use this information and really boiling it down to what actually works. And then, I that's why I love sports where like tennis, two guys go on a court, they got a racket in their hands, a racket and a ball, it's pure skill, whoever can, wheel that racket the best, or, same thing with this, it really, all these indicators and all these things that you find and read about and that are advertised, it's all just an offshoot of the price and volume itself, and it can never really, if the caboose is being pulled by the train, if MACD and stochastics and all these indicators are being calculated by this price, well, then they can only be coincident or lagging. They can never lead. So why not, this is something that Bill O'Neill convinced me of, is that all you need is learn how to read bar charts. The reason why, a lot of people use all these other elements is because, and they're not successful with something simple because they don't have the skill. So over this last 4 days of curriculum, I gave you everything to develop that skill and what to look for. Certainly there's other ways of trading. Mine isn't the only way. There's some people who use overbought, oversold indicators and have all these squiggly lines all over their screen. They got 14 screens and they make it work. They make money. But I can tell you this, when I got interviewed for Market Wizards with Jack Schwager, one of the problems that Jack Schwager had, and even more recently, and he said it several times, I've heard him, and he told me personally, his biggest problem was finding 10 or 12 people out of the whole world that had the type of performance like myself, or Paul Tudor Jones, or some Stevie Cohen, and some William O'Neill. He said that the big problem was finding there's so few of those people. All the ones that I know, and I know a lot of them personally, that I talk to, a number of the market wizards are very close friends of mine that I talk to all the time. Everybody's got real simple approaches. I haven't seen too many of them that are really have complex approaches. Even if they're doing strategies different than mine, that usually they boil it down to something that's a lot of not a lot of moving parts. I think that's the beauty and essence of the the art form part of this.
All right, guys, so we have the opening bell
2
coming up
minutes
here
for
in
the
just
opening.
another moment or so.
And Bob, as we're going intraday, as the charts develop, because we'll need to let a little bit of time go by to let some charts develop. But if you see anything intraday, you can certainly point it out. I can bring it up, because these techniques that we've gone over, they work on any time frame. So, and we do have, I do have friends, and we have members and clients that use them intraday very successfully. I don't use the intraday charts. I trade off of the dailies.
Well, if you want to pull up EMPH, Mark, it was on intraday having a nice low cheat pullback buy, but didn't like the big volume on the close there.
You're saying right here?
Yeah, yeah.
Yeah. Yeah, and now we're coming off a bit in pre-market, so let's see.
Yeah, exactly. So that's gonna kind of
Yeah.
negate some of these energy solar names seem to be down this morning.
All right, here we go. So we're opening up here. So this is opening up down a little bit. So here's where what I'll do is first thing I'll just sort all my lists in percentage change for the day, so I can see what's down, what's opening up. So right here, I immediately see what's going on here. All right, I'm interested in the CVI. It's opening down 3%. So let's take a look at that. So this is opening relatively quietly because it's staying inside here. So this is a potential buy. So we'll keep an eye on that. Let's see what else. This ADM, very quiet open. I love this. I love the quiet open here. This is one that definitely would be the now with it being real quiet here and being so close to this pivot, I right away would put this on my screen on my trading platform and set it up. So I would set this up so I'm ready to go if I want to buy it. So that's ready to go. I could literally fire it off an order here now in a moment's notice in just a second here and buy that if it starts moving. So, but it's going to hit that alert, and at least it'll let me know if it's moving in my direction. So I don't want to buy a stock unless it's moving in my direction. Even if I'm buying a pullback or I'm coming off of this low cheat, I want to see it at least some progression in my direction. Because again, if it's going in the opposite direction, they start opening that spread. Next thing you know, I'm at a loss. I'm trying to be at a profit immediately. So hopefully we'll get an opportunity to do that. REGN, again, opened up quietly here. So with it opening up quiet above this previous day, you've got this little, if you want to call it a low cheat, a little pullback buy. Again, I would definitely not get too aggressive here, but we could buy some above that 745.40. Let's add. Let's just put in 745.40. So I got that alert right there. We'll keep an eye on that one. Let's see, PRTA, another one, real quiet here. Again, this would be a little pullback buy. So you're going inside here. I'd be really really careful with this one and only buy a small position. But if this starts turning up here, you could buy it from this pullback buy. Again, we don't have many stocks that are setting up real crisp low cheats or handle entries where you've got the pivot and their breakouts. We've got a bunch of pullbacks here. So this means that again, we're a little more risky here. There's not a whole lot that's setting up for real crisp breakouts. I don't know. How about you, Mark? You seen anything? AZO's up 1%.
Yeah,
So AZO is actually turning up.
Yeah, that's one.
You could buy this. I mean, this, this is one that, of course, here I want to buy it coming out of this base right here. This is the buy point, but it gapped. This is one of the reasons why I've been watching this for a while. This right here, it did gap up, and that kept me away from it. But it had a nice 4 or 5 out of 6 days up or so, 4 out of 6 days up here. Natural reaction, just pulling back here, and now you're turning up from that natural reaction. I know we had a lot of questions. Can you buy the natural reaction? Well, yeah, but you're paying up a bit now, right? You're around here buying it on this breakout. Now you're paying up a bit. So yeah, I mean, you could definitely you could buy it here, but optimally I want to buy it over here, and that's what Mark said. Why didn't you see it before? Well, I did see it, this one, but it gapped and it kept me away from it.
Mark, how do you determine or when are you determining as well if you're going to be buying a quarter, half, or a full size position?
Yeah, that's a judgment call, and again, if and that depends on the market environment. It more depends on my own traction in the market of if things are going well.
I got an alarm on DGII going off here too. That one's
DGII. Yeah.
All right.
That's starting to try to come out here, and this would be a very now again, let's just say this isn't the most perfect setup. It is one that's been just stepping up here. This is one that maybe if you want to try to get it dead right, starts coming out here, you set a stop at the low. real, or maybe the previous day a low, starting to break out here. And, so let's just say, what's the low here? 41.50. So, if I buy 1,000 shares here and I get in here around 42 change, my risk is $600, $700, $800 per 1,000 shares. Let me just see here. Let's look at the spread here. So yeah, trading at 42.01 by 16 cents. Now a lot of these breakouts are turning right around on us. So just keep that in mind. You got to be real careful here. That's why I'm saying keep it on a real short leash. But this is probably the best acting stock right now out of everything we have on the list. TH is up about 4% here. How's that looking? And that's turning up. I would say DGII is probably the best looking name right now. The way it's acting right here, and it's breaking out of a little tight area.
Mark, question: if that spread is wide, or what would be considered too wide, or is there a limit to how wide of a spread you'll buy a stock?
It's all your own tolerance. I mean, you have to decide how much you're buying. If I'm buying 50,000 shares, it's a 2-point spread. I'm not going to be at $100,000 loss, no matter how rich I am, or no matter what the stock chart looks like. I'm not going to put myself at 100K loss immediately. So that, for me, that would be too wide. For someone else, it might be a $2,000, and you would have to position size accordingly. So that's part of it. But sometimes the best names are going to have wider spreads, and that's certainly a risk. Now, again, if that spread is 0.5% or 1%, your stop's 8%. Obviously, that's not really a deterrent. So it depends. Like I said, there is, for me, there is a dollar amount, that I'm cognizant of that I'm not going to want to risk sometimes. And it also depends if I'm doing great and I've made tons of money. There's times where, I'm up $1 million in a month, and I've got a lot, I've done really well. So other times where, I can't get anything to work. I mean, this year I had a lot of trades working for me the first half of the year, short-term trades, taking partial positions off into strength, and then this last couple of months I haven't been able to get any traction whatsoever. So I would be really, really careful at this point right now. It's really anything with risk is I could tell you, looking at the charts and sort of what the volatility, single digit getting into the pivots and so forth, on how stocks generally act. But risk, as far as how much risk you're going to take and how much dollar loss you're going to accept, is completely a personal decision. And that's, would be handled through position sizing. See here. Yeah, so far this one's acting, DGI is acting pretty good. The CVI is off about 4% now. ADM still staying pretty tight. Market's down here. You got the Dow up a little bit now, so it's actually turning around. But this MAC is staying really, really tight. That's what we want to see. Let's see. So the ENPH is down a bit here. So coming in now, see, here's a perfect example of a stock that, it breaks out here, and it's coming back in here. And this is where, after you get a squat like this will usually shake out a lot of people, a lot of shorter term traders, a lot of amateurs. And this is where, and again, if your stop is set at the day's low or something, then fine, you're out if you're really short-term oriented. But if you're going to swing trade and give the stocks a little bit of room, this would be too quick to sell out, most likely. And again, this is where the rubber meets the road. You got to see if it can tighten up, because if this can hold up here and tighten up a bit more, let's just say it holds today and then it comes inside. Whoops, wrong line. Comes inside for a day or so, and starts tightening up, and maybe you get something like this, And now that actually got better. This could improve quite a bit. And now you'd get a breakout from an even tighter level. Hopefully the volume will come way down, and you'll take out that reversal, which would be a 1, 2, 3, 4. It would be a 5-day reversal recovery, and you would take out all the supply at one time. So that's what I would look for. And if I was in the name and maybe I was small, then I would add here or take an initial position. But just because, let's just say, even the stock stops you out, and you've got to stop, that's tight here, it stops you out. Well, you can re-enter it, if it tightens up here, because then it would just be still part of this VCP process. So right here, here's your first, right? It's down about 20, so we'll call it 27%. Right here comes about 17. Okay, peak to trough right here. You're off about 9 or 10. Right here, off a little bit more, maybe 6 or 7. And now this would be even tighter. That would be like a 5. Right. So you've 1, 2, 3, 4, you get a 5T. That's what you want to see. You want to see it get tighter and tighter and tighter. So just because it stopped you out doesn't mean that it can't reset on you. Just get that on there. And you want to keep an eye on it, especially in a group like the solar group is, these stocks are some of the strongest stocks in the market right now. But FSLR is definitely acting the best out of that group right now. Let's see here. So DGII is handling this little breakout so far, holding up, squatting a bit. And this is what's been happening over and over and over. You get these stocks, they move into new high ground and they just come right in. Retail buying brings them out, institutions sell into it, and there's no bids. There's nothing to hold it up. And that's what you're always trying to gauge. When the breakouts start working, they just come out, they take off, and then you're sitting there on the launch pad just watching these rockets take off left and right. And that's when we'll get aggressive. Until that happens, though, we're very careful, and we might even just watch a bunch of pitches come across the plate. Like this right here in a really strong market. I'd be buying this. I'd be buying this in size. Even though maybe it's not, it's moving itself up here and it's not coming out of a big base, a little bit extended, but I'd be buying these high momentum names that are breaking out to new highs. Let's see what else. Texas Roadhouse. This is one too that's trying to tighten up here, just staying tight. Bob, any questions? I think you're talking on the phone though.
Yeah. Question. A lot of ticker symbols, which we will get to being able to look at. I don't know if you want to take any ticker symbols right now, Mark, but
let's take some ticker symbols. Anybody have anything that they think is set up right now?
Flex.
Yeah. I have Flex on my on deck right here. Yeah, I mean, again, this is an early turn. See, it's only up for a little bit here. It's a big base. Let's go out here. So yeah, you do have a really big base here. And as I pointed out, when you get the really large bases, sometimes that will cause the long-term moving averages to flatten out or even start trending down. So then when you come out of the base, it's an early turn. So you got it. That's sort of a caveat. You have to look, if you have a real long base, you may be able to cut it a little bit of slack on the uptrend because you have had a long period of consolidation. This is kind of wedged up a bit here. It's a little bit sloppy. It just doesn't have the orderly type of, price action that I would, buy here. See, it came out this morning already. You're getting duped. It comes out, it came right up to the old highs. I don't think it actually 2050. Where did it trade? 2050. Yeah. Came right to that 2050, pulled back here. So that's not one that I would, I do have it on deck, as you can see right here, but
ALNY mark is taken on Friday's high. Is it
ALNY? Yeah, that's got that low cheat or that cheat area. That actually looks pretty good. That's a pretty good looking, let's see, I think I'd want to see it confirm a little bit more. So down to this low is about 10, 11% below the pivot here. You do have the 50 days, what I call an angle warning, when you got the the price going in the opposite direction of the 50-day coming out of a base. It's minor. It's not downtrending too much. So that's a minor angle warning. If this was really steep, if this 50-day was like that and the price was coming out, that would be a warning. You got to be careful, because until the intermediate trend starts flattening out and turning up, you're going against the trend. You want all the trends to be in your favor. The long-term trend template, stage 2 uptrend, the intermediate term, and even the short term, you want it that day to be moving in your direction. You want all the trends going in your direction. This could come out here. This could also very easily, stall out here, or even poke its head out a little bit, and then spend a little bit more time, similar to the ENPH, and maybe just tighten up a bit more. And then it comes out, and see, that would actually look even better, right? That would tighten up a bit more, and you'd get that next iteration. So this could be part, you don't know, you're not going to know until in hindsight. So you've got to make a decision if you're going to buy it. Now, in a good market, now I'm not waiting, I'm buying the stock. It comes out here, I'm buying, as long as that this right here, that's about 6%. That's within single digits. I'm buying this as soon as it takes out these highs right across here. You can see if you go across the whole base, it only traded above that level on maybe, I don't know, 10 or 12 days. It only closed above it on maybe 7 or 8. And that applies to the left. It is a bit early turn, but you have this explosion here. So this was a potential, let's see here, go back 8 weeks or so. This was close to a power play, very, very potential power play, but it didn't hold up. And now it needed to form a bigger base. So this is looking pretty good here. Take this out there. I'm going to put this over here as a potential and move this up to here. So the 2, and we had DGII, of course, which is up about 3% now, acting pretty good, holding up. And you see with this platform, I can very quickly just move stocks around. That's what I like about this. I can move them from this table over here and just jockey them around. It's very, very easy to use, very quick. I'm sure there's other platforms that do this too. ADM though, so you're trading down here a bit, still holding up, but this is one that I would look to buy only if it, at the very least, would have to take out Friday's high. I want to see it get going here and start moving, through this pivot point. That would be at the very least. I would not buy unless it can at least take out yesterday's high. So that's what we would wait for there. And ALNY again, starting to come on a little bit here. This is one where, what do we got? We got a spread, 219.78. So you got it's a little bit of spready, but it is a $200 stock. Oops, sorry about that. Just drop my pad. Let's see. I like the way this looks. Now we could bring up a Market Smith to look at it here. Oops. And 96 relative strength had earnings here. Of course, this is a biotech. You can see no earnings, all losses. Biotechs will generally have profit margins, and they get a blockbuster drug or something. They can have, billions of dollars in sales and have profit margins of 80%. You can see here the margins 80%. So that's what makes them so powerful, potential big movers. Let's see, I'm going to put this up on my order entry here, just watching it. Mark, you interested in anything?
I'm watching this ALNY a little bit.
Yeah.
And honestly, I like the way everything's open right now. Now it's just more, can these stocks, stay quiet and then go higher?
Yeah.
Our question, people, can you just describe what you mean by staying quiet? Stock acting quiet.
Just not much price action. Just opening up quiet means it doesn't open up on a big gap up or down. Volume is relatively low. You can see we've got really no volume here in the morning here. You can see even here if you're looking at it intraday. If you want to look at volume, one thing that a 5-minute or an intraday chart is good for is ascertaining how the volume is running. I know we had questions about the volume at the particular time because you don't have the end of the day volume yet to know if the volume is up. You can look intraday and see how the volume is running. And that's what basically you want to see as the stock's moving. If you see blocks coming in and the volume is strong, this stock's holding up, pretty good here. Like I said, this is definitely buyable in this market, though. We've got so many names that stick their head out and they come right back. So I would be, I'm in the stage of trading right now with in the market in this market environment where it's all about test positions right now. It's not even really about making any big money, and it's about if I'm going to make any money and chip up, like even if I bought 1,000 shares of this and I make 10% on it or something. Okay, well then I've got that money now to finance some bigger risk. I don't want to go into that principle. That's the main thing. That's rule number one is to try to protect that principle because you don't want to be digging out of a hole, right? Losses work geometrically against you. So getting that traction and financing larger trades. To take bigger positions, I want to have some traction under my belt. Now I'm already up for the year. I actually have profits, but that money's mine already, and right now I'm in cash. So I'm coming back into the market. So I'm not going to say, well, I got X amount of profits to work with and I'm going to start risking that. No, this sort of starts all over again because now there's not many setups. I've gotten maybe knocked out of some names. The last couple of months have been difficult. So now I start that whole process all over again from that new level. Like I said, always thinking risk reward. Remember we talked about the power factor where, as you're moving yourself up and you're making these profits, you want to start protecting from that new level and thinking risk reward from that new level. And this is about as key as it can get for not only making big returns and compounding, but because the main thing is to keep yourself from having big drawdowns and losing your principal and giving back big portions of your profits. So
I think that's important, really important point, Mark, your idea of, not getting sloppy when things are good, because that is definitely, a temptation. I think a lot of folks, you're running with open profits and you think, wow, I'm just playing with house money. And that you don't really take that attitude. Well, you don't take that attitude at all. Neither do I.
No. TH is moving up here about 6% now. So this this came up from this little pullback buy, which actually triggered on Friday, and it's now following through a bit here. So again, this is one. You could have even started buying this on Friday, and then of course you can see it squatted a bit. It didn't really take off, but now it's following through. Not much happening here. You can see not much up really big or down. CVI's the other one that I was looking at, but it's trading near the lows here. So definitely don't want to try to trade that here. Now, there is one thing you can do. Well, if you are trading a stock down, sometimes I will trade near the danger point, but usually it has to be turning back up. So you see like right here, it's just starting to turn back up on the 5-minute. I usually just know that because I watch how the stock is trading. But right here, I don't want it to take out this low. So just a concept, is that if you have a stop, like I'm okay with buying a stock, anticipating. If you want to try to anticipate, it generally isn't a good idea. And this type of market, it's usually a horrible idea to try to anticipate anything. And you don't usually have to, waiting for the stock to pivot. But if you did want to buy a stock on a pullback, at least here, you're really close to this low, that should hold. You want this to hold inside. That's, the key is to have this hold inside. Because now if it takes out this low, then to break out today, it's got to have an outside day. It's just getting more and more ominous as it comes down and takes out these lows, and you're widening, you're not tightening, right? We want it to stay tight, want the volume to stay quiet. So buying it right here, you could calculate right from here down to this low, you're just a couple percent, maybe 1.5, 2%. So it is, if you get it right, and this starts turning up here, maybe the market's down today, it starts turning up and this stock ends up pivoting or even stays inside, closing the upper end of its range, stays inside. If you're at a 3-4% profit, 2-3-4% profit today, and then it breaks out the next day, and you can maybe add to it. You're coming in with a very, very low risk. So if you are going to anything that you trade, just always try to trade from the lowest risk possible entry that the chart and the math come together. And that's what we call backing into risk. Backing into risk, trading near the danger point. But that doesn't mean that you're going to go and buy a stock in a nosedive and bottom fish some stock that has giant overhead supply. You want to put these techniques. Everything should be stacked upon. Like I said in the during the program, everything that I talked about previous, everything builds on that. It doesn't erase any of that, and you still have to have all that previous the previous criteria. So you have to put this in context, of course. If you're in the uptrend, you've got the VCP. Again, that's when you're gonna want to try these tactics that I'm telling you. They're not just blanket tactics that you can use anywhere.
Question, Mark. You mentioned, you're out of the market, you have the profits for the year, it's all locked up. Common question being asked, when, at what point do you do that? What if you made $10,000 today? Is tomorrow your account $10,000 higher? Do you recognize that profit is now yours, so to speak?
I don't understand what that means. If I need 10,000, I mean, if I need to take money out of the account.
No. If you made $10,000 today, is
yeah.
tomorrow's, is that still profit? Tomorrow, are you resetting your, position sizing? And
Oh, well, yeah. Well, the position sizing, I'm not sure if you want to adjust it that quickly. If you just, if you had, let's say, $100,000 account and then it went up 10%, I mean, it's not going to matter a whole lot if you move your position size up by another 10%. But yeah, if the account grows, let's just say you have 100,000 and now it goes to 150. Well, yeah, your position sizing on 150 now. Otherwise, you wouldn't compound. So yes, you're now you could maybe have some rules of thumb where, I used to advise newbies to not really position size bigger or to take much more risk until they can double their account, or at least get their account up 50%. Until you can do that, keep the position sizing maybe constant with that original number. But again, it's more of a personal choice, but there is mathematics behind it. If you don't compound, then yeah, you're not going to take advantage of growing your money. So you do have to compound. You have to increase your position sizing with the growth.
When you are coming from a cash position and you start, with a much smaller than normal full size position, even though you have full size on your chart, your screens there, that doesn't necessarily mean you're trading immediately from the start at full, what would ultimately be your full size 25% position, correct?
In this particular instance right here, this is just what this says full and half is just what we put on the platform. My personal position size would be in shares and would be tabulated separately. So this is just what we have on our MPA platform right now. Like I said, I went flat because of this seminar, and even then I only had in the stocks that I own ENPH, a few of these names, but I'm very small in them. So but the answer is that these are actual full positions. We don't have a position sizing as far as like a model portfolio, but if we don't say half position or quarter position, then it by default it means a full position. But again, the only position sizing with our platform isn't for actual position sizing purposes to say take X amount of size. It's to show a relative to whatever your full position is, that we're saying, hey, maybe this is this is coming from a low cheat, and we're recommending a quarter position here because there's a lot of overhead supply, and then we think we can maybe add to it down the road if it rebuilds and sets up a cheat or a handle. And stocks that we would maybe move more incrementally in, we would start smaller. Or if the market is just not acting very well, but we're getting some setups, but we have no traction, then we might also tiptoe a little bit and come in with quarter positions. But go ahead.
In the reverse sense of your progressive exposure, if you do have a loss or 2 or 3, how, and you started that to 6.25%, how much would you keep dropping it with each subsequent loss down to? What's the smallest amount you would go to?
Again, it's going to be, once you cut it in half a few times, it's going to be negligible. So I would, and Mark, this is a good question for you too. I tend to just sort of, if things aren't working, I usually cut my trading back at least in half. And then if it's still not working, I cut it back in half again. And like I said, if you start off with a 10% position and you cut it to 5, then 2.5, you're trading, at negligible levels. You only have to cut it in half a few times, and then you're basically not trading. It's just purely, a token trade to keep your finger on the pulse, if you will. So I would say, general rule of thumb though is, cut your trading back in half of the size. You're taking $100,000 position sizes. A few stocks aren't working, things are moving against you. All right, maybe take cut it in half to 50,000. Those aren't working, 25,000, 12,000, and just keep cutting it back until it's so small that maybe you just stop trading. And again, if I were to lose a couple iterations, I go in there and take a few trades, they don't work. I take a few more, they don't work. I take a few more, they don't work. I'm probably going to just stop. I'm going to stop trading, and then I'm going to watch some trades for a while and wait to see. That's going to be enough evidence. And I'll probably see on my watch list and the names that I'm watching, there's going to be, everything's going to start failing because, again, I have good techniques. We're starting to move up here with this. I'm just going to buy 1,000 shares here.
Order filled.
So I just bought 1,000 shares of LNY. And I'll give it a little room here and see what happens, see how it acts here, see if it can break out. All right, so I bought 1,000 shares ALNY. My stop now, again, I didn't tell you a stop, but I already know in my head my maximum that I'm going to give this thing is the low of the day right now. I've already made that decision. I maybe should have told you that ahead of time, but low of the day is where I'm drawing the line in the sand right now. Now it depends. Let me see how it acts here. And the more it goes up today, the more that low of the day would be something that I would want to enforce. I mean, if this does this today, and just blast off, well, now a full reversal and coming all the way back down would be pretty ominous. But I don't want to risk much on this. So I'm going to just try to get it right here. Let's hope that this just moves right from here. But I like the way, you see, it came out and then it pulled in a little bit and it didn't reverse much. It stayed strong. And now it's starting to follow through a bit. So you can see a little bit of volume coming in here. That might be some of you, are buying this too, and we might be pushing it a little bit, but we're not going to have much of an effect. I can tell you that, and we're certainly not going to be able to hold it up. So we'll see what happens here.
That's just a good example too, Mark, where you draw the line.
Is that you? Is that you muscling? Are you?
No, that is not me. That is not me. No, I was just going to say it's a good example though. Of, if you draw the line on this one, you're taking out a good chunk of the supply, like we showed, in over the last 2 weekends, and this stock is, making the turn here. It should, there's not much supply if you look left.
Yeah. This looks really good. I mean, this is really set up quite nicely. Biotechs, the biotech group was really looking really promising for a while, but it's been fragmented. There's not a lot of stocks that are working well, even though you got a lot of stocks that are blast off, but there's still a lot of volatility. They're not coming out of bases really well. Even a lot of the power plays have failed. So we're in a bear market, and it's just a difficult environment for any group at this point. So until we can get better action, and we could get an indication that maybe we've morphed into a new bull market here, you just got to be prepared for a lot of these stocks are going to fail. O'Neill has in his book, I forget what page it is, it says a loud warning to the wise. You should read that. And it basically says that, with in a bear market, all this stuff, coupled with handles and pivot points and everything, don't work, or don't work a lot less of the time, and you're going to have difficulty. It's not that it doesn't work, it's just not the right time. And that's where it's so important to use progressive exposure and to realize that there's times where you need to be in cash, and you need to be sitting on the sidelines. And we come in and we take these test positions, and once we get that traction, I can assure you, if we're going into a new bull market, it's going to last for a while. So you don't have to ring a bell and get fully invested in the first day of a follow through day. Or now some of the better names might take off even before the market makes its final low, and that's why you want to incrementally entertain some ideas early on, and then as things pick up and things improve, you can add some names. So this is acting pretty good. See, again, came up a bit here, and it's holding up. So I like the way this is acting so far. How it acts on the breakout's really important in the subsequent days. That's why we went over the violations and the confirmations. Those first few days are really important to watch. How it acts during the day. And I should point out, the confirmations and violations, you could watch a 5-minute and you want to see the same exact thing. So far here, we've got, since you came out of this little base right here on the 5-minute, this intraday this morning, you've got 1, 2, 3, 4, looks like 5 out of 7 days, 5 out of 8 days up, or 5 bars, if you will. 1, 2, 3, 4 good closes. So the same exact thing you'd want to see on the intraday if you're shorter term oriented, or you want to get an indication how it's acting from the breakout. You could take a look at the 5-minute and apply those same confirmations and violations. I generally don't look at the 5-minute, so I have this up for you guys, but I usually just have my weekly up here and not even looking at the 5-minute unless in pre-market, just to see what's happening with the stocks. You can see the market's turned down here a bit. So we're yeah, not much though. We're just sort of pretty tight range here today in the general market. TH is moving up a bit more now, up 7% or so. So that's the only star performer here so far. DGII stalled out and hasn't been able to really follow through much. That's what I kind of suspected would happen here. Yeah, not much. You can see it just really sort of a flat market. HP, the energy are coming off here. So looks like we're going to get a bit more pullback here on the XLE, and then these individual stocks in that group, I would look to those. You can see like HP got a big base here, forming this right side. I know Oxy is also got a big base. See, so you need more tightness here. See how it got tight right here, but then now it's leaking off, and so it needs more time. They're just not ready. But you got nice big bases here. So you may get another move in these energy names, but it just doesn't look like they're price ready just yet.
Question, thoughts on VWAP? One question, somebody's asking if that's what you're using there on the 5-minute, as well as ATR.
Yeah, I don't use ATR and VWAP. I did stick a VWAP on here at the behest of my, if that's even the right word, of a friend of mine who we were talking about VWAP and just talking about it intraday. I put it on. I didn't take it off, but I don't even look. VWAP means nothing to me. It means absolutely. And I know a lot of people use VWAP. I think it's probably the most overrated, useless indicator, if you want to call it that, or reading that you can use. But again, if it works for you, if you have a way of making it work, absolutely, you should use whatever works. Arch Crawford used to use follow the stars and use astrology. If that works for him, God bless him. I don't know how to use VWAP to make it work for me as far as adding, being accretive and adding any value to what I do. Again, like I said before, I try to break it down to what's necessary. Is it necessary for me to have this indicator or this other screen or what I want to take it down to the least amount of moving parts, to only what is absolutely necessary, and make the whole process as simple and straightforward as possible. That's really the key that you should be trying to accomplish with any strategy, is to bring it down to the and with anything. I've been in a lot of sports and over the years, and of course, I have a mindset book about performance. It's breaking it down to those things that are most important, and really breaking, if you break a baseball swing down or a golf swing down, that's what they say, to break down the swing, to break the swing down. You're trying to break it down to its individual parts, and then bring it down to the least amount of moving parts, and find out what's the most important, what influenced the outcome the most, and get rid of all that noise. Same thing with this, and if you've got the skill to read the charts and to understand the fundamentals, you don't need much. You don't need much. It's right there. Everything's right there for you. But there's a lot here. It may seem simple, but there's a lot here. There's a lot for someone who doesn't do this. This is like EKGs and looking at all these sine waves, and it is complex.
Vertex is being asked about, and BOX.
Yeah. So I've been watching Vertex for a while. It's just not much. There's really no power here of it coming out. It's been a little bit volatile. I'm just not ready to buy this here yet. I would like to see it tighten up a bit more. I mean, you could have been buying it on Friday. So I would maybe start a position there. What was the other one?
BOX.
Box. Yeah. Yeah. So this, a nice VCP. It's interesting. I didn't see this one. That's probably a lower relative strength. Let's see. Let's bring it up on MarketSmith. Usually when I don't see one, it's because 85. So it's a lower RS, and that's the reason why I'm not seeing it. Weekly, this is really looks laggardish. It doesn't look like a leader to me. So in a bear market in particular, or a big correction, but in a bear market, I want to go with the higher RS. I want to be 89 and above. When you start getting 85 relative strength, you're in the laggard names, and I want to be in the leading names. So I love the VCP, and it's setting up really, really nice here. This is super tight. You can certainly play this, but it lacks the momentum. You want to try to trade where momentum is the strongest, because that's where you're going to get the faster moves, the velocity, and the trend is already in place. With this, you do have a little bit of overhead supply to the left. It's not too bad, but okay, so above here, you'd be buying it coming out above this level right here. It's pretty tight. We measure it here. Let's see. The peak to trough right here is about 4.8%, down here about 10%. So all your analysis is correct here. It's just in context, it's not in a strong stage 2 uptrend, or even really in a stage 2 uptrend, confirmed. And it's a low RS. So I would put it, this would not make my cut. And it may take off. This may take off and be a big winner. I may be buying it higher. I may be buying it 100% up from here. But again, I'm not really concerned where I'm buying it, how much it's gone up before I bought it. I'm concerned with how much it's going to go up after I buy it. I don't care if the stock goes up 1,000 points, as long as after it's trading at 1,000, it goes to 2,000, and it goes up from where I purchased it. So this is the boring and monotonous life of a stock trader. Right, Mark? We sit here and just watch and screen, and in a quiet day like today, I may be going through my screens, and but I'm just, if there's nothing setting up and there's nothing happening, then there's not much trading to do. So we're really just spectating and sitting back and watching. And I'll do post analysis, or get other things done, do house cleaning, we call it. Day like today, there's not much here. ADM is turning up a bit here now, so I want to zoom back in on that. So we came right down to that low. I like the way ADM's acting here, just from my own experience. With this type of action, it would be great to see it one more day and go inside and come out, but it could certainly come out today. If this were to move above this level right here, I'd say you can buy this one. Again, just setting a stop down at this low right here would only be in the 4 or 5% range. So from a swing trade basis, that's pretty reasonable. And if you wanted to get really tight and set it below this little pivot right here, that's even a lot tighter, around that 93.84. And if you want to be a total stickler and it just has to go immediately and that's it, you could use the low of the day. Those would be sort of the three stops, and you can stagger it even. You can sell some, maybe some if it hits the low of the day, it pivots, it hits the low of the day, you take a third off, if it gets below the pivot, and a third off here. And now, which doesn't, again, I want to point out this though, it doesn't make much sense to do thirds if you're staggering and you're putting a stop at 2, 4, and 6, because now essentially, you're getting the same middle price. So sometimes it's better to just keep the two prices, and you'll give more room on half the position instead of getting knocked out of 2/3, if that makes sense. This is one that I've been watching for a number of days here, and we're waiting for it to turn up and pivot to buy. Let's go back to ALNY. Yeah, so this is squatting in a bit here. So again, this is not what I want to see, but this is normal. This is normal. It is pulling back here. And again, you can look at the intraday. If this was daily, and this broke out on a daily, would this be normal or abnormal? This would be normal. This is not acting. This looks like just a natural reaction right now intraday. If we can get back into new high ground here, then you'd have tennis ball action, and it's acting perfectly fine. So like I said, the intraday is just as valid as far as confirmations and violations. It's pulling back a little bit here. So far this is normal. I don't like the fact that I'm down. Well, I was down about 1,300. Now I'm down 800. I don't like the fact that I'm negative, but it's still within the confines of acting normal. This is one too that I might be willing, if this could move to new high ground now, let's just say, we turn up here and we take out the highs, it's still within the range. If it's still within, say, 1% above the breakout, and I've moved in a little bit, but it hasn't yet gotten past that pivot point by more than 1%, and it takes out the highs, and now we're maybe, coming in around that 1%, I might add to it. That's where, because it's confirming, it's acting well. It's pulled back, it's squatted intraday, and it's able to recover. So now again, in that direction, I'm going to buy a little more at a higher price, not a much higher price, a little bit higher, but I'm getting that confirmation. Why would I want to add, the stock, I buy it tries to break out, starts pulling back. Why would I want to add and it coming in on me? It's not confirming, it's not going in the direction that I expected. So I'm adding to a stock that I'm wrong on at that particular point. So I'm always adding at a higher price, 99% of the time, adding at a higher price. Let's see. Mark, did you buy this too? Did you buy some of this?
ALNY, no, I did not buy this.
Okay. Let's see, what time is it? So it's 10:17. I think Scott's coming around 11 or 11:30. So maybe we'll get a lull, and usually around lunchtime, market stays kind of quiet. And we'll go over Market Smith. Bob, let's get to some questions, and also,
Yep.
I'll probably pull up at some point. Usually on this live trading day, I go back to the workbook, and so that daily routine slide, but I kind of went over that already. I pretty much went over that. There's a couple things in there that I leave out and I skip, and then I go over it. If we have enough time, we'll do that. But I can tell you right now, it's not material stuff. It's you're seeing it anyway. But we can go back to that. Any questions that you want to go over? With regard to what we're talking about here.
CPRX is another name.
Okay. Again, this live trading, we're dependent on the market conditions. It's only on one day, so we can't force the trade setups. Sometimes they're setups where some years where we had some nice setups and they just blasted off and things were running really good. It was some years we had some good intraday setups, and a couple of years where we had nothing. It was quite boring. So this is one that is also one that I've been watching. It's a bit sloppy here. This is one that I was pointing out to our members over here on 11/7. And I think that was the spot at which you could have bought this from that cheat area. Now it's setting up pretty good, but I want to watch, see if it can hold, maybe tighten up a bit here. If it can tighten up a little bit more, maybe buy this coming above, started above that 16-ish level, and then add to it if you can reversal recovery. But I still think this is a little bit erratic here. But it is one that I'm keeping an eye on. It's right here on my watch list, as you can see. This is sort of hierarchy, like the focus lists are the ones that I think can be set up this week. They're either set up already or they are close enough where they could be set up any day. The on deck are just a little bit, for whatever reason, a little bit further, and they're not in my immediate focus. And the watch are some names that I'm keeping that I just want to keep an eye on. Something like the GFF, which broke out, is now pulling back here. With this breakout here, this would be an instance where I might be willing, particularly in a really good market, in a really great market, which you might not even get this chance. In a really great market, they break out and usually they follow through the next day, a couple of days. But I might buy this pullback, back to the breakout level. If you can get back to this breakout level and we start turning back up, you could maybe come in and then you'd accomplish buying it the same price as the breakout on Friday. So that's one that I've been watching. I'll move that over here and keep an eye on that, my main list. But not a whole lot going on, as you can see here. What else, Bob? Any other questions?
Going up.
Any other questions as far as beyond just stocks?
Oh, yeah. Well, a lot of it's from the workbook as well. Do have some questions there lingering. People were asking, Mark Ritchie had made a reference a couple of times of using the same 3 screens, that he's been using for 12 years. What are they, or how do they differ from what Mark's screens are?
Yeah, I don't think they're going to, like Mark was saying, there's a lot of overlap, so they're not going to differ in terms of, what the names we're looking at. But yeah, I can give you those real quick. So the 190, I run the top relative strength, top 3%, 97 to 99 relative strength. Only qualifiers on that are basically just the share price and volume. So nothing fancy there. I just eliminate the really low priced or really low volume stuff.
Right, so same, just RS, but
Yep.
he's 97 to 99, the highest RS. Those are usually the power plays. You'll put a price cutoff. I put a percentage off that's high, and then a minimum share volume and no ETFs. So it's essentially the same thing. Mark's saying.
Same thing. Yeah, the other one, I run a high composite. I think the composite ranking, 85 or higher that MarketSmith has, and then I just removed the top 3 highest RS from that group because I've already seen them all. I run that, and then I run an IPO screen. Basically,
here's your composite screen. I just want to show you real quickly. This I have set at 68 to 99. And you can see there's a few other things here that I added. I added no more than 10% below the 50-day and 7% below the 21-day. You can put this in your screening. The reason why is that when you get to the low cheats, sometimes you'll be below the 50-day. And you can buy a stock below the 50 days as long as it's not. I used to use 8% as a cutoff. I've raised it to 10 because I like to get a heads up. And so if it's below 10% below the 50-day, you can still buy it, but usually those are, I'm buying from the cheat and the low cheat area. And I also found the 20 or the 21-day, you don't want it to be too below that as well. So this adds a few more parameters to keep them in the shorter term and intermediate term uptrends, if you will. Percentage off the high above the 200-day, at least above the 200-day. So I just added a few other criteria in here. An RS 89 to 99 with the comp rating. So this is sort of what Mark's saying, except I added some additional criteria here. But go ahead, Mark. I just wanted to kind of show the similarities between the screens. You're not showing your exact screens, but yours are even more simplistic.
Yeah, they're pretty bare bones. And then, yeah, I mentioned the IPO screen is same idea. I just, anything that's IPO'd in the last 2-3 years, RS of 70 or higher.
Yeah, so mine is right now I'm running it to 2021 on current price and RS 25 or higher. But again, pretty much the same, just looking at all the IPOs and then sorting them in as IPO date. So, if you just run the trend templates, and if you don't have Market Smith, you just run high RS, IPOs, you're going to see pretty much every stock that you're going to want to see. You're going to see the stocks in an uptrend that have the relative strength. And then from there, you've got to start looking at the chart and at the fundamentals and going through what we have, what I went through in the workbooks, categorizing the company, decide what kind of company is it, and that's what's going to put the earnings, the fundamental picture, into perspective. Turnaround situation, you want to see big earnings in the recent quarters, right? Biotech, you don't really need earnings, but you're going to want to see a super strong chart, usually power plays and the charts that are really strong. Cyclicals have inverse PE cycles and earnings. And, I laid all that out for you as far as categorizing and then looking at the earnings, sales, and margins, looking for the acceleration, and putting all this together manually, because again, you can run all these different screens. I got a bunch of different screens. I fool around with these all the time, but if I run all these screens, you're going to get the same names. You're just going to get a narrower list or a bigger list. Now, if I start taking stocks that are in downtrends too, and stocks that are 50% off their highs, then I'm looking at the whole market. I'm not willing to buy those. I'm narrowing it down to the stocks that are in an uptrend, trading within a certain percentage of their 52-week highs, and that is my universe. So again, we're going to get Mark and I are looking at the exact same names. Each morning, we compare lists, and we're almost identical within one or two names.
Got a lot of questions. Actually, quick reference. I'm sorry. IMGO.
IMGO.
Yeah, being acquired by Merck today, it's up 100%, but that's not going to become a power play likely when you have a buyout, right?
That's an acquisition or a buyout, proposed merger. Yeah, we're not going to mess with that.
A lot of questions we're asking about gaps, how you handle your stops.
LNY is moving up here, so hold on. Just saw we're up 2%. Okay, I got a little bit of a profit here now on my position. So far acting good. I like the way this is acting. So you see here, it's looking like a natural reaction. So the same thing that we would look on the daily chart. We want to see, we had a couple bars down. It's 1, 2, 3, 4. I'd like to see this get back into new highs in less bars than it took to get down. And again, I want to make sure I point out that I do not look at this. Like, this is not how I gauge. I watch the stock and I just watch the daily. I don't even really use this, but I am for you right now. If you want to look at it this way, that's fine to get granular. This is the way, if I were to use an intraday chart, I would use a 5-minute and I would just look at it, from the breakout and just see how it's acting. But this could throw you off too, because what will happen is you could get it to break down and act abnormal, but it's still on the daily, it's fine. And you're going to see all this, what looks ominous on the short-term intraday, but it still hasn't even gotten down to maybe it's mid of its daily range. So you got to be really careful when you get on these shorter-term timeframes. They can become very emotional, and you're now getting so myopic that you're missing the big picture. That's why I tend to just, watch the daily, set my stop, and stay in there until it hits my stop, and look for the confirmations, violations on the daily chart. That's the time frame I would recommend you trade from. But for today's purposes and showing you that this is timeless and be able to read this and get more activity, we're going to look at this 5-minute. Let's see what happens here.
So questions were a bunch of people asking about how you handle gaps through your stops. If there's anything that you could do to avoid them, if there are any hints of them. One person has had 4 gaps in the last month of 10% or more alone. So he's been getting really beaten up badly.
I'd like to see those 4. Well, I'd be curious to see if you're sticking to sound rules, or if there's something that you're doing that's putting you in a position to have stocks that gap down big, whether you're in downtrends or buying into supply. There's nothing you can do about it. There's no way you can know if a stock is going to gap. So the only thing you can do is position size. That's really the bottom line, is position sizing. There is a chance that a stock could gap down huge on you. It's very rare. I mean, I've been doing this for 40 years, and to have a gap that really hurt me with any type of size, I've well, I've never had one really put any kind of big dent in me because of position sizing. But I've had a couple big ones that were definitely, were painful. But yeah, I would say, in 40 years, I can count them on one or two hands. So I don't know. How about you, Mark? I mean, as far as big gaps against you,
I've had a few, nothing though. I think the worst gap I ever had, I think a stock gap down 40% maybe, but it was a really small position. Still not fun. My rule is it goes through your stop, you get out, you take the next best price you can. I will on occasion, let's say my stop is at 100, and the stock gaps to 99. I might give it the low of the first minute or two, but even that's with the understanding though that I am getting out.
Yeah. I was just having a conversation with my wife the other night about we were just talking about estate planning, and my daughter's going to be 17 soon, and we're concerned what happens if something happens to us together, we're in a plane crash or something. We got to figure out exactly how we're going to have our wealth distributed and so forth. But I told her, I said, if anything ever happens to me, I want you to make sure you never ever put any more than 25% of our money in any one area. So sort of the same 25% position sizing. I told my wife about our entire wealth, because again, even if let's just say it went to zero, you put money with, who knows, someone's managing her money, she trusts somebody after I die, and puts quarter of the money with someone, and they steal it, they run away and steal it all. You still have 75%. You can recover from that. It doesn't take down the ship. Same thing with trading. 25% position, the chances of a stock going to zero that quickly without you being able to stop out and mitigate the loss is near zero. So, but the chances of it going down and gapping 15%, 20%, even 50%, can happen. So let's just say it gaps down 50%, before you can get out. That's huge. That's about as big as it might get. It's 12.5%. It's a giant loss, but you can recover from that. You still have the majority of your capital. So you have to position size. And again, especially overnight, like you don't ever want to put all your money overnight into something that have full exposure, because now you're at a true really big devastating risk, potential
Mark,
devastating risk.
Weissman is with two S's. Just remember that.
What's that?
When you're dividing up the wealth, Weissman's two S's.
Gotcha.
Question is being asked about AMLX here, actually.
And I just want to point out here, so far, we're turning up here. This is acting, and maybe what we do here is we just trade this stock. Let's trade this stock based on the 5 minute. As an exercise, let's trade this and act as these are the dailies. So as long as this is acting right, if it gets extended and it starts meeting sell rules, we'll sell it. If we get violations, we'll reduce it or sell it. I mean, I only bought 1,000 shares. But we can certainly, I want to have some type of activity here, and I think we could play this intraday as an exercise here. So that's what I'm going to do. I'm going to keep watching this intraday, and we'll play this trade that way, or at least maybe half of it. But go ahead. I'm sorry. Go ahead, Bob.
You actually brought up a good question that somebody was asking if both Marks could share. Do you have retirement accounts? Do you trade those in a different strategy? For one question being asked, if you have other assets outside of stocks as well. People are just asking like how you diversify.
Yeah. So I do not have all my money in the market, nowhere near anymore, because I don't need to. And I have a retirement account just simply because it allows a certain amount of my income, I have a 401k, a certain amount of income to come out and to be tax deferred, but it just goes into fixed income. I don't trade any retirement accounts. I do have an account from my daughter that is an S&P 500 that I trade basically off the longer term trend model, our own models. But my own money, it's pretty much up until, I don't know, decade ago or so, like all my entire wealth was in the stock market and I would trade. In the last 10 years or so, I've moved that back, and it changes. Like if right now I'm trading a small amount of money, but if the market starts doing really well, I'll trade one of my bigger accounts, or I'll add money to my account and I'll trade more money. But yeah, I don't have retirement accounts. Like I'm trading them differently, multiple accounts. I have one strategy, one approach, and that's it. And I've been doing that for the last 30 years. It's been just one strategy, one approach. How about you, Mark?
Actually pretty similar in terms of, I would say 100% of my net worth was pretty much on the line until the last few years. But in regards to other accounts, I have a really tiny 401k type thing, but I don't really trade it at all. And then as far as other stock accounts, I would never do anything differently. If or when like I have one or two longer term positions, I might trade those off the weekly or something just for a bigger move. But I'm getting in the exact same way. And then like I've had some money in Bitcoin for a number of years, that type of thing, but nothing. 90% of my net worth is basically in our trading accounts.
Monster Beverage, of course, is breaking out here of this little handle. We already bought some of this. You can see here on 11:15 as it started turning up from this little pullback buy over here, and then it stayed tight. Was acting fine the last couple of days. Love the close on Thursday, Friday. Came out here above that pivot. Once again, you can do the same type of analysis where if you just draw a line right across here, you can see Friday it came out, it cleared pretty much everything. It only traded above that level on one day. And even if you go back all the way here, oops, sorry about that. It came back up to this high right here. So that's really clearing out all the supply. Now it's following through. So this is acting great. This is exactly what you want to see. Only up about 2 1/3% from our purchase. Back to ALNY.
I was going to mention that Mark Monster on the 5-minute intraday because it did have a nice mini cup with handle there about 2 bars ago.
Right here.
Yep.
You see how even on the 5-minute, you see how this is coming from a little cheat area right here? You see, it doesn't matter the time frame. Every time frame is going to go through these same iterations, the volatility contraction, the low cheat, the handle. It doesn't matter the time frame because this is the law of supply and demand on display. It is timeless. It doesn't know any time frame, and it will work for the end till the end of time, until gravity stops working. It's the same thing. It's like the law of gravity. It's not the cause, it's the effect. These are the footprints of supply and demand dynamics. So it's not like because this is doing this, people are acting and it does it, or lack of it, because it gets tight. Everybody comes in and buys it and the stock takes off. No, the stock takes off because it's tight. It's completely the opposite. That's really important to understand. So you have confidence in this. But of course, there's a skill involved in being able to interpret normal from abnormal price action and to manage the risk in relation to reward. That's what it's all about. It's all about forming reference points and putting yourself in a position to get lucky, to be in the right place at the right time, and then managing the opposite side of that equation. Because with that equation, it is the downside. There's the upside, but there's also the potential for the downside. And now you have to manage that downside in relation to that upside. And the upside sort of acts as your pace car. That wherever that upside is, you've got to stay a certain distance behind it. Think of it like a pace car. And after a while, that pace car becomes very consistent. It travels at a speed that is in a range that you pretty much can count on and And certainly when it doesn't, it gives you a lot of valuable information. That pace car normally, goes at 55 miles an hour, and all of a sudden it comes to a complete stop and it's going 5 miles an hour. Something's wrong, right? So again, just like another metaphor, on a racetrack, they have the pace car in the beginning of the race. So just think of the gain as your pace car, the potential reward, and managing that risk in relation.
Curriculum questions can be asked via email. If you guys want to post like on the spot questions, you can definitely do that here in the chat box. Mark, UTHR question being asked, it's not 100% move for it to qualify as a power play.
Yeah.
Would this just be considered too extended of a setup to be trading?
I like the little setup here. Let's bring it up on a Market Smith here, UT, and let's see what we got as far as RS is 96. Biotech, I see. Yeah, it's not even close to enough to be a power play. Let me look at the weekly. So pretty big base here. So the first thing I want to do is kind of put it into perspective. There's a couple things I want to look at. First of all, it's a big base. So this is more of a breakaway move. So that's good. This isn't a move that has been running up, has accelerated, and this is a blow-off stage. This is a breakaway move. And if you look at here, you see this line, this is the S&P 500. So you can see that it's outperforming. And we know that just because of the relative strength line. See, the RS line is moving up here. And it's moving up here. Since we topped here, this stock has been outperforming. So it's stair-stepping its way higher while the market is stair-stepping its way down. And it's now moved into an uptrend. It's in a stage 2 uptrend. Now, I don't know if it's confirmed how long we got here. Yeah, so it is, it's pretty much a confirmed stage 2 uptrend. It is a confirmed. We're above the 200-day. So the thing is, it's a short base. We call this a short stroke when it doesn't have the power. And it definitely is more failure prone. Sometimes what will happen is, they'll break out, then they'll come back in. They might undercut the lows and rebase. But it might not. It might go here. So you gotta decide, what are you going to risk here? So this is coming out. If you bought it right here, you let it come all the way down to the low of this little pullback. You're only talking about 6%. So I think this would be, and if you're just holding it maybe, below this little pivot right here, you're talking about 3 or 4%. So this looks like a good risk reward play. I could add this definitely to my list here. Let me see here, UTHR. Keep an eye on that. I think it's buyable right here. I think you can buy it.
Yeah, maybe he is.
Now, here's a perfect example of another look at sort of progressive exposure. So I bought ALNY. Now, this one here is starting to come out here. Now, I might take another position. Maybe I buy this one. A couple come out today. But let's just say ALNY is underwater. I buy this one here. It starts pulling back. I get underwater here. I'm not going to keep buying stocks. Now ADM maybe comes out, or instead of buying, my original position size, maybe I was going to buy X here. I was going to buy $500,000 worth of stock. I might only buy 250 now, or maybe even 100,000, and take a smaller position. I'm going to bend until I get that traction. I'm not going to just keep piling in money and putting good money after bad. I want to see some traction. Always looking for traction and pyramiding on the backs of success. This is where you get into a lot of trouble if you start trying to speculate as to what might happen, as opposed to just waiting to see when it happens. But what happens is that the FOMO, you're worried that this one's going to take off, and you're going to miss it, so you buy it, and the fear of missing out comes in. You got to get away from that. You got to get away from those emotions. I have a much bigger fear of losing my money than I have a fear of missing out. So I make sure that I cover my downside. This is acting really good here. I like the way this is acting. And I think now that it came all the way back down to this low, and I'm getting real microscopic here. Again, I wouldn't recommend that you trade with these really tight stops like this most of the time. in this particular market, or if you were underwater or you're just starting to get in the market and you want to just get your toe in there, yeah, maybe you can come in and really take some really low risk because you just don't want to get yourself at a loss yet. But you're going to choke the trades off. You're going to choke off trades that may not stop you out and go on to make bigger moves. So just realize that there's a trade-off. When you get real tight on the stops, you're going to be stopped out a lot more often. Now, if you got a reentry mechanism, that's fine, but it may not reset in a manner that you're going to be able to buy it from a low risk entry point again. So let's see here. So today's low is 90, 94.17, 94.11 the previous day.
Attention, an alert target has
You
been
can see
reached.
that's starting to come out here on ADM. I'm definitely I'm gonna buy some of this here. So I just bought. Let's see here. So I just bought 5,000 shares. So I went a little bigger on this one. So that's about a $500,000 position. So with this one here, now let's just say that position size is huge. That 500,000, whatever the number may be for you, it might be $1 million, it might be 50,000. But let's just say this is uncomfortable for me. This position as far as taking a lot of risk, and I'm just trying to get it right. So I'm up right now. I'm up about what do you got here? I'm up about. I was up about 2,500. Now I'm up 1,600. I could finance right now, as it's moving here. If I take a really big position, I want to take it down to 1,000 shares. If I sell off 4,000 shares of it, I'm going to finance a lot of my risk. So I'm going to sell right now. Boom. I'll go. So wait, hold on. What did I just do here? Okay, I hit the wrong button. I didn't sell enough. Order filled. All right, so I sold 4,000 shares out of the 5,000. Now again, I'm doing all this really fast here in shorter term trading just to illustrate points. This is way too quick. I just want to let you know for swing trading. But now I've got 1,000 shares on, right? I got in at my average price is 95.81. I took a little bit off. I put a little bit of profit in there. So now I've financed some of the downside. If this comes in on me now, I put a little money in the bank. You could mess around with these numbers however you want. If this stock were to take off here over the next couple of days, even let's say a few days, this stock, it holds up today. You hold it for a couple of days. You got a pretty good sized position, and now you're up 7-8%. Your stop is at 5, 6, 7, 8% down here. Well, you sell off half of that position. You've free rolled it. But I'm trying to free roll it right now intraday. Right. I'm trying to, and sometimes what I'll do is I'll take a bigger position intraday. And if I can get that stock to move, then I finance my overnight position. I take that overnight risk and I de-risk the trade. I'm always trying to de-risk the trade. I just want to get myself in a position to have the upside with the least amount of downside, or maybe even no downside at all. And that's the key. The key is that downside. If you constantly keep choking off that downside and you expose yourself to the upside, and don't choke off the upside too much, you allow that upside to come to fruition, you have an edge. You can't help but win over time. It's like the casino. A casino operates on a 0.5 to 2% edge in any one of the games, like in craps or blackjack. The edge is just a 1 or 2%. All right, but you're rolling that over. The casinos build these palaces based on that because the odds are with them over that distribution curve. Your odds can, in this particular business, your odds can be shifted huge in your favor. I mean, just monumental. Statistically speaking, if your odds were, you had a 10% or 20% edge versus a 1 or 2% edge like the casino, it's an astronomical edge. And you can create that. But you've got to get off of the worrying about the upside and manage the downside. That's why what I'm doing here is just to try to illustrate the concepts of risk first, of covering your ass. All right. That's the main thing, is the concept. And then, okay, I get some profits. And now let's just say ALNY ADM start taking off here. And here's a perfect example. I'm down $1,000 on ALNY. So I've actually cushioned that a bit. With taking the ADM profit, I cushioned that a little bit. So at the end of the day here, if we were to close out right now, I'd be flat. And I have one stock that is not up really at all, and another one that's down. I'd still be flat here. I wouldn't lose much money. I took a little off the table. I cushioned a bit. Same thing with ALNY. It runs up here. Maybe I take a little bit off, and now I put myself. I've got that option. See, you create those options. Once you get at a profit, it creates options for you to start de-risking and free rolling. Now, if the market, and you might want to even, explain, Mark, how you do this, but I know a lot of it's the same, obviously. In a really good market, let's just say everything starts ripping. We had a question before, do you go right to that full size position? So all this, jockeying and covering our downside so carefully, we're not going to do this, because now we want to put those big positions on and give the stock. We want to keep our position. We want to keep our position sizing, but that's after you've got some traction and you've got some evidence that the market's moving in your direction. Right now, again, we're in a bear market, and look here, the market's down here, right? Nasdaq's down 1%. You see, I'm not looking at the market. The market's hitting new lows here, and I'm over here buying breakouts. I'm not looking. It's not concerning me, and again, if the market was down 1,000 points today, if stocks were breaking out, that would even make me more interested in them, because that means they're performing amazingly in a down market. So I'm looking at the stocks and I'm gauging it. I put my toe in here on a few names. If they start working, I'm trusting the stocks. I don't care what the indexes are doing. I'll look at the indexes at the end of the day, and I'll take that in relation to how the stocks acted and see if there's distribution. Now, if we start getting distribution days on the, on the Nasdaq and the NYSE, fine. But what are the stocks doing? If I'm getting a bunch of stocks that broke out and there's pivot failures and I'm getting distribution, okay, well, that makes sense. Everything's not working, and I'll bend to that, but I'm not going to let the Dow 30 stocks dictate what I do with my trading when the individual stocks are the real market. So again, ALNY is still acting fine. See, it's just building a little base here intraday. Still, if this was a daily, it would not have given me any indication here that I'm in trouble or I need to sell. There's any violations. It's still acting perfectly fine. ADM, let's see, intraday. So we've broken out. You got a little cup with handle here, a little V-shaped. Now you're pulling back, right? This is your first pullback. This is where the rubber meets the road. If this was a daily, we don't want to see this crashing in here now and giving all the gain back. And so we got to watch if we get any supportive action here. This would be, if you're watching a daily, this is right where, you might come back into the breakout. That's perfectly natural. And that's where we want to see some support. So it started to squat. You got an outside day here. This also, now that we, well, actually it's not, I was right to the penny, wasn't it? Let's see, 17. Yeah, we didn't get an outside day. So I think at this point, now that we took out the highs, if you engulf the previous day and we went outside, now I think the previous day's low would be a good short-term stop if you were to be short-term oriented, because now you'd be putting in the megaphone. Now you're widening in volatility, the opposite of what you want to see. Volatility is two directions, remember? So we want to see alpha. We want this stock to go up and have minimum downside. Alpha with low standard deviation. So again, always managing that risk reward. I'm sorry, Mark, I said that I was going to let you comment on that.
Well, yeah, what was the question again? Sorry.
I know. I'm sorry. I think it was.
And just in relation to how aggressive you're going to be right now. I think it's
the position sizing and aggression.
Yeah, I mean, look, I'm just trying to get, we're trying to get our feet under us before we, are really getting aggressive. That's really just how I think about it. I took a tiny bit of this ADM. I'm trading at sizes right now, just very small, just to keep a pulse. But your example before, even if you're a shorter term trader, maybe you buy the ALNY and it just blasts off. Then I'm looking. Anytime I get positive feedback, I want to take that back and then say, okay, how many other setups do I have? How else is the trading going elsewhere? Lately, the positive feedback has only lasted a very short period of time. And anytime you've used it to sort of get more aggressive, it's been just constant jockeying for position. So, it won't change for me until, you get some real traction.
That PepsiCo is coming out here. Came out pretty nicely so far. So again, as we said, this is pretty tight here. I would like to see it tighten up a bit more, but this is coming out. Now, again, you start seeing, though, PepsiCo, these are defensive names. We've seen a lot of these defensive names in food stocks and some of the beverage names and so forth. It's not the best sign when you get stocks like PepsiCo that are leading. But who knows? Maybe the growth stocks led for so long. Maybe we're getting the old stocks that have been beat up for decades are going to have their day here for a while. Who knows? Maybe values coming back in. But the charts, you're going to see it in the charts, and you're going to see it in the stocks that are in uptrends. It'll all show up in the charts of the individual names, and that's where you'll focus on what's showing up and what's setting up.
Mark, on MEC, Mary, Edward, Charlie. Basically, question being asked if a power play can happen from a stock just running up like this as opposed to like a big gap up.
Did you say NEC?
Mary, Edward, Charlie.
Yeah.
And then 2, so can a stock be a power play even if it doesn't gap up 100, that makes that big move?
It can't be a power play unless it goes up 100% in within 8 weeks or less. So it has to go up 100%. I mean, if you want to call it, if it's 95, 93%, that's close enough. But about a double in 8 weeks or less. So if we measure from this low right here, this is just to pretty much hits 100%, 97, 98%. Problem here is that you've got a gigantic decline, and you're not even turned up in the 200-day at all. So it's just trying to flatten out here. So you are going and it's a lower price stock. So I would be careful with this. This is one that could very easily come in because you're going counter trend now. I would want to see the 200-day, and it's such a steep, look at the 200-day, how steep it is. And you've got a lot of supply here, big giant decline. Where did this go down here? This came off, 75%. So be careful with this one. This isn't the best looking power play.
Damien's asking if we were in a bull market and market's trading well, is there any stock he would take a full position on? And I'm not sure if you mean his entire portfolio or if you mean a full position. He takes full positions all the time. But
yeah, I wouldn't, if you say a full position, meaning the whole portfolio, I wouldn't take a full position overnight. Certainly not with the amount of wealth that I've acquired. That's taken me 40 years. But, again, let's just say, even if you were, I first started out, I had a couple $1,000. The account that I grew that ended up being my track record and that Jack Swagger audited, started with $32,382. So that, if I lost all that would have been, at the time, it would have been my entire account. However, I could have went and worked and saved money and replaced that, so you got to think of it in also dollar terms. If you've amassed tens of millions or hundreds of millions of dollars, you can't replace that overnight. That took me a lifetime to get to where I am now. So that has to be taken into consideration. See here. So I'm going to go back to the ALNY. So again, coming off a bit here, but still acting relatively normal. This is sort of where the rubber needs to meet the road now. Still acting pretty normal. It's the market's down here. We're definitely going you're seeing there's not a lot of green. There's not many stocks up big. So it's definitely a market today that's not getting much traction. Unfortunately, we're getting a quiet day. We're not getting much moving on the upside, but this could change. Sometimes you get these breakouts. The market's weak in the morning. You get breakouts. They hold, they squat, they don't stop you out. And then at the end of the day, the market comes on. You get a rally, and all of a sudden, the stocks that broke out take out the highs, move higher, get good closes, and other stocks that were setting up break out on the heels of it. And at that point, then I might take another position or two. Again, coming back into the market here, I'm willing to take 5 or 10 positions, but they're small. If I take 5% positions, I've got 25% exposure. And that would be sort of my first toe in the water, is usually about 25% or so. And then if things work, I'll usually move up to 50. And then from there, I'll make a decision whether I want to go jump right to, fully invested. If I've got the ideas that are available, or maybe 75, I start trying to get myself to a more aggressive posture. So we're getting a little support here, pulling back to where the stock moved through the pivot. So far, so good on ADM. ALNY is coming in a bit here. This is now, I'm at my biggest loss in the stock right now. So that certainly gets my attention as far as where I am. It's hitting the lowest level since I bought it. It was holding above my purchase price, and now it's moved below my purchase price coming in here. So now if this was a daily chart, yeah, this is getting a little bit ominous. You're getting that first pullback. But here, if this was a daily chart, this would be already went through 1 and 2 natural reactions. So this would probably be anywhere between an 8 and a 20% move. So you might have already taken some off. Again, like when we compress this, you have to realize that you're compressing the time frame, and now you've got to trade this in really small increments now. So what would seem like, oh, I'm not going to take the profit here. It's only, I'm up $1,000 or whatever, a couple of thousand, it's 1 or 2%. Yeah, but you're trading that shorter term time frame. That could be, on the chart, that could be the same as if it was up 15 or 20% on a daily.
ADP, Mark.
ADP. Gotta get a tissue. My nose is stuffy. Let me see here. Yeah, I saw this one over the weekend on screening. Wedging up a little bit here. Again, I think this is sort of a kind of a defensive type name. ADP. It's acting okay. I think I wouldn't rank this aces or kings, but it is wedging up a little bit here. But on Friday is where if you're going to be buying this, Friday was the day. Now you're starting to follow through here, so it's buyable.
Canal question being asked: if Mark is not holding overnight positions because of the hard penny environment that we're in, but would you hold overnight positions during the easy dollar bull market environments?
Oh, absolutely. I'm holding overnight positions now at times. I'm just not holding large positions. So I am holding overnight positions during this market. And Mark Ritchie is also. But we're not taking any big risk, and I'm trying to finance my risk if I can. Like I said, if a stock runs up and I buy it and it runs up 7 or 8%, I got a big day. Sometimes buy some of these names and they pop real big. I will maybe take some off. Often I'm taking some off and financing some of the risk overnight, depending on the situation. But I am holding overnight. Just I'm not willing to hold any large positions overnight right now.
Question being asked: when you take a swing core position and you trade around it on a shorter term basis, do you consider all that activity to be a single trade, or would you consider the short term trading for one strategy and the swing trading for a separate strategy for your trading results?
It's really how you want to calculate it. I mean, if I were to pyramid into a trade and I bought a quarter position, then moved it to a half, then moved it to a full, then moved it back to a half and traded around the position, I would consider that one trade and sort of net it all out. But if I'm in and out short term and I've liquidated the whole trade and then moved in again, I would consider those separate trades. But that's really, sort of how you want your accounting. We do have on our own software, one thing that's unique about the software that we have with our trading logger is that you can go in there and put quarter, half position, put all different position sizes, and it will net it all out as far as the average cost basis and everything. It's kind of unique in that way. And then you can also decide which shares you're disposing of when you sell and match them to which pieces that you bought.
When you have
So
based on
ALNY
your,
has now come down to where it's almost flat on the day here. And again, not super ominous, but this is definitely on a daily chart. Again, you're definitely correcting now. And this is not natural now. See, this is not natural. Now we've got, let's look at it as if it was a daily. 1, 2, 3, we got 4 lower lows, right? So now we're coming back. Here's the breakout. So you're getting a full retracement now. So if you didn't already sell into this, let's just say this was a 20% gain. Well, I'm not going to let this come all the way back down and put me at a loss. But I bought it higher here, so I'm already at a loss. But I'm just saying, if you were buying it, out of this base, if you will, and now you've got the lower lows, and your natural reaction did not hold up. So again, this would be getting some violations now.
question, if you have your exposure, good market conditions, you're fully exposed, what's the maximum risk, portfolio risk you would take if all your trades got stopped out? What's the most amount of risk you're comfortable taking?
I'll let
in
you,
market risk?
you haven't said much, Mark, so I'll let you talk to that one.
So are they asking, assuming you're fully invested? Is that the question, Bob?
Right.
Well, I'll take, as much as, 4 or 5%, but that's going to only be assuming I have profits. So, I'm going to be leaning on either booked, or I'm certainly not going to let myself go into a 5% hole, off the hop. So meaning, let's say I'm up double digits or more, ideally, I'm willing to carry a little more risk, versus a situation like now where I'm willing to carry very little.
You'd have to repeat the question for me, Bob, if you want me to.
If you're
answer it.
fully invested, market's good, you're fully invested, what's the maximum portfolio risk you're willing to take if you were to get stopped out on every position?
Right. So I wasn't even listening to Mark Ritchie's answer, so forgive me if I repeat what he said. So I don't look at it that way, although I am cognizant of, I know what my maximum drawdown is if I were to get stopped out of everything, but I take it stock by stock, and I'm treating each stock individually. So I've already come up, that's sort of built by default into the plan. So if I manage each individual stock correctly, and I'm constantly managing risk in relation to reward, then that sort of works itself out. But I am, I certainly am cognizant of the number that where I am as far as the gain, and if they all stop me out, what I would lose. This is something that it's a great question. It's a great question, and you definitely want to minimize that drawdown, but you have to be careful that you don't just come up with these hard numbers and try to make these hard and fast rules, because that's where you start ignoring the individual parts, and manage each stock individually. And if you make each individual stock a good risk reward decision, your overall your whole portfolio will be a good risk reward proposition. So now here again, we're coming off here. We're going to now 1, 2, 3, 4, 5 lower lows. So if this was a daily chart, I probably just reduce here. We're getting near the low here of the day here. We can call this the weekly low. Maybe if this was the daily, this would be the weekly. I'm just going to reduce. I'm going to sell. So I just sold half. Again, that puts me in a position if it goes higher. So like I said, good thing I held half. If it goes lower, good thing I sold half. So I'm selling half of it here, taking a little a loss on that half position. And let's see if we can hold this low here today. But this is, again, in this market, this is exactly what I would expect. This is what I said right in the beginning, that we break out and we come back in, and they just don't follow through. This is happening over and over and over. So I would have to be a fool to just jump in here really big size and go buy a stock that's doing exactly what has been happening over and over and over, and it hasn't been working until it starts working, until we see that there's an appetite for stocks breaking out of bases, coming through cheats, low cheats, handles, and these stocks are starting to follow through. Until we see that happening, there's just toes in the water here. For me, this is very very small trading. This is microscopic trading for me to buy these position sizes. So I'm not getting myself for someone else. If they take a $3,000, $5,000, $10,000 loss, it's huge. When I first started, that would have been, I would have been jumping out a window if I lost $10,000 in a day. So again, it's relative. This risk is all relative to your own situation. But the charts, the percentages level that playing field, and of course we'll make those decisions to each of your own instances. ADM, it's not following through here. DGII is up 4% now, so that one's moving up. That's acting pretty good. Even TH is coming back a bit here now, about 4%. So that's squatting a little bit. That's coming into a little bit of supply. Normal. There's no real major abnormal action here. Nothing's acting crazy or completely abnormal. But just no real traction yet. And again, you see this list here, we don't have a very big list. And even you have to also grade the quality of the list. Like you look at your list, are there a lot of setups that are really nice, crisp setups that are well defined and the breakouts are working? Just by that alone, I know sort of the health of the market. If there's not a whole lot of setups, that tells me right there it's a market I don't want to get too aggressive in. I think Scott Sinclair is coming on. Yep. So he should be coming on pretty soon here. What time is it? It's 11:10.
Hi, good morning, and Mark, how are you?
I'm good. I'm great. How are you?
Good. Thank you. I wasn't sure what time you want me to join, so I will just stay in the background and listen, and you just yell at me if you need me.
You can come on right now if you want. I don't know if you want to share your camera or not. We're on here. It's up to you.
Yeah, I can.
Awesome. Great to see you, Scott. Scott, obviously, as you guys know, if you don't know, he's with IBD and with Market Smith, a friend of mine and a friend of ours, a great guy, Scott, and very knowledgeable. He's been doing this for a long time, knows the products inside out. Thank you for being here. Appreciate you taking the time.
Of course, I appreciate the invite. Yeah, it's really cool to be a part of it.
So let me ask you, Scott, what's going on today? I think, did you go on IBD Live today?
I did. Yeah, I just got off, which is why I'm dressed appropriately for your show. Got a collar and everything. Yeah.
Yeah. Any insights or what the thoughts are as far as what's going on today, what everybody's seeing, and then your thoughts about the market in general? We're just talking about the market here and seeing really a lack of a lot of setups lately, not much really working and following through. A lot of stocks sort of try to break out and then squat and pull back. So a lot of volatility around breakouts, making it difficult. Mark and I were just talking about how, we'll take smaller test positions and sort of put our toe in the water. And then until trades are actually working and giving us that feedback that our ideas are actually being rewarded in the marketplace, we ride the brake and we act, as I always say, I'm the caboose and the market's the engine. O'Neill might have said that. I might have stole that from him, but that's it also includes intraday. Bought a couple stocks here. We took a small position in ALNY as it started to move up here. But once again, just like every one of these plays that have been happening lately, pulling back here. Hopefully it's going to hold up. ADM's another one. We took a little position in ADM as it started to turn up here through this little tight area, but just not getting any traction really in anything at this point. Are you seeing the same? What's your feeling as far as what's going on?
I couldn't agree more. I feel like I can find stocks to go up. I just can't find stocks that stay up. So they last for hours, sometimes a day or two, but nothing is trending. I haven't yet to find a stock. I can't remember the last stock I was able to hold for weeks and weeks. So it's a difficult environment. I feel like big cap tech stocks are under distribution. The institutions, they want out. Yeah. But there's nobody on the other side. I don't know who's left to buy the Apples, the Googles, the Teslas of the world. So, and those companies influence the indexes, obviously, due to the weighting. So they're putting a lot of pressure on the market.
what Scott just said is so important. He said you can find stocks that go up but don't stay up. And that is actually the most dangerous environment that you can possibly trade in when you're a low risk trader that uses stop losses, because that is the whipsaw environment where you get sucked in, you get knocked out, and you get death by 1,000 cuts. And that's a much more dangerous environment than if the market's just going down and everything's collapsing. People think that's like, a lot of times, my friends, if the market get flash crashes and big down days, I'll see a friend of mine, they'll be like, whoa, Bart, you having a bad day today? Did you get, crushed? I'm like, no, like those are the days where I'm just out, there's nothing to buy. It's the days like, today, where you get something that sets up, breaks out, and then turns around, pulls back, and maybe stops you out. And you're at a loss now, and you get a few of those. If that keeps happening, that's where you rack up the losses. And that's sort of the trade-off. That's the trade-off from, having those small losses and taking those small. There's a cost. You're going to be knocked out more often. You're going to be whipped around a bit more. And that's why this progressive exposure concept is so important, that you don't just go barreling in, that you have to make sure that you're not in that whipsaw environment. And this goes back to Mark Ritchie, where he's saying that this isn't like, even if you have a 50-50 batting average, it's not like it goes win, loss, win, loss, win, loss, and has that equal distribution. These situations trend, they come in bunches, and sometimes the bunches are huge. You could go months and months with just trade after trade after trade not working. And it will frustrate the crap out of people, if they don't understand that this is normal. And part of trading is staying out. It's the biggest part, actually. When that's the most important decision, is when to do nothing, or to be very light in the market. Let's see here. Why don't we? So Scott, we just go off the cuff here, on this day here, and even with Market Smith, going over markets, we went over just some screens and some general concepts of how we screen. We tend to, Mark and I run pretty wide. We cast wide nets. We want to kind of see everything. I was telling everyone that, if you set a screen and you put too many parameters in it, you try to make this perfect screen and you put 100 parameters in it. If it misses on one and it makes it on 99, you don't see the stock. So I sort of try to cast a wider net. What we've done in the past, and Arusha was great at this, of showing us, sort of doing a tutorial on MarketSmith. I've learned things every year. I've learned something new about how to use it. And I've been using the product for 30 years in one form or another. However you want to, go over MarketSmith is fine with me. I can display anything, and you can share your screen too. If you have any presentation, if you want to share your screen, feel free, and we can go over some MarketSmith and go over the product, because I'd like everyone to see why it's so unique and so powerful.
Okay, let me pull up mine. My
And again,
MarketSmith.
we don't get paid to use MarketSmith. We've sort of, MarketSmith and IBD have come together over the years. MarketSmith and IBD have never sponsored another event outside their own events. They've had their own workshops. I'm the only event that they've ever been willing to put their name on that wasn't one of their own, and vice versa. We've never had another sponsor. So we've never allowed anybody to, and we've had lots and lots of people want to sponsor us, but we never did, because MarketSmith is truly something that I've used, become part of my fabric of my trading. Prior to MarketSmith, it was Daily Graphs Online. Prior to Daily Graphs Online, it was Daily Graphs to printed books. And I go all the way back to the 1980s and 90s of using Daily Graphs books, then online, then MarketSmith. So I have a long history of using this product. And as Mark said, we don't want to endorse anything that we don't use and know ourselves. But again, we're not paid endorsers here, just so you know. So how do you want to do it, Scott? You want to show your screen, or you want to?
Sure.
Yeah.
Let me
Is he enabled to share, Bob?
I think I am. I do see that option.
Yeah.
Yeah.
You have to stop sharing, and then he can share his screen.
It says this will stop other share screening. Do you wish to continue?
Yeah, go ahead.
Okay. So yes. All right. Let me pick the right monitor here. Sorry, I have too many monitors.
Sure.
Screen 2. Okay. Do you guys see a chart with a red X in there?
Yep.
Okay.
You raise your hand, everybody, just to let us know that you are seeing Scott's screen. Okay, plenty of hands being raised.
Awesome.
Okay, great. All right. So I imagine you did show people where to find. Let's start with your stuff, Mark. The templates down below
I did
in the
briefly. Go ahead.
reports.
Yep.
Okay. Let me pull this up so you can see a little bit better. But it can be, if you have Market Smith, it can be hidden a little bit because it's stacked inside these folders. So you have a stocks folder, which you'd need to open, and then you'd have to open the technical folder. And if you scroll down, you'll see the 1 month, the 1 to 4, the 5 month, and then the 5 month wide. Did you discuss kind of the differences in those, Mark?
I just the 1 month to the 5 month. The 1 to 4 is in between what it says, 1 to 4 month, and that's sort of looking at a narrow slice. But the wide, just we took out the relative strength rating, so you can, if you want to put a lower RS, you could put a lower RS rating in it. So it just gives you a little, it gives you some flexibility.
And right now, probably because of the way the market is, they're very close. You have 215 in the 5 month, and you have 244 in the wide. You can see
Right.
the number of stocks. But you're right. The wide does not have that RS rating filter that the original one did. I think it's a filter of at least 70, but I could be wrong if I sort this list.
Yeah.
You'll see in the original one that Mark and Arusha built together, the RS rating, the lowest RS rating is an 88. So the wide allows lower RS rating stocks if you want to, cast a wider net, like Mark mentioned.
You also, I pointed out, Scott, up in the open stock ideas up in the right, there's a shortcut to it.
Correct.
Yeah.
You
go to weekly.
So it's in the
Go to weekly.
the weekly review,
Yeah.
and we need to. I wish this was bigger, this box, because some people don't see the scroll, but you just have to scroll down a little bit,
and then when you click on it, actually,
it
takes you to that one, but it also takes you where the other ones actually populate. So it's kind of nice to get there quick.
Yeah, if you don't have all of those open, it would have done the 5 steps that I did to open them. It does it in one fell swoop.
Scott, the other thing too, as I was pointing out, is that you can either screen from the entire, you can use this as a qualifier and then build a screen, and you can screen from the whole entire Market Smith database, which is 90 some 100 stocks, or you can screen and use this as the qualifier from that database. So that was another thing I pointed out.
Great, cool, yeah. So if you create a new stock screen, you can originally, when you first create it, it's going to screen from the database. You can see it says Market Smith database, 9,697 stocks. Of that, roughly, it's about 5,000 stocks. The rest are ETF/closed-end funds. But if you wanted to change that universe, you can click on it, and then you've got these stacked folders like I talked about, technical. And then I can tell Market Smith, I just want to screen Mark Minervini's 5 month wide list. So I'm going to click on that. And now instead of searching the 9,697, you're going to search the 244.
And you need to put some criteria in to have something come up. It won't show anything if you put one piece of criteria.
Yeah, all of these dull orange categories have options you can choose from. Price and volume, for example, has 36 items. So let's just see which one is up. If I were to say price today, price percentage change current day, let's see 5% is my minimum.
Mm-hmm.
So of the 244 stocks, there's one that's up 5%. See, and it gives you feedback too. I can see, well, that's pretty tight, my screen. It's probably too tight. Let's go ahead and change that from 5 to 1. And now there are 30 stocks that are up at least 1% today, and you can see them populate down below in the list panel.
Right, and you can see DGII there. You can see AZO, a bunch of names that came from my list, my focus list today. So those are stocks that are going to be in that stage 2 uptrend and in an uptrend. And now you can overlay criteria on there, but now you're starting from that that database of being an uptrend. So now you won't be tempted to maybe buy those stocks. Times people show me a stock and they'll say, what do you think of this? And I don't even see those stocks because I'm not screening. Those will never make it through my filter. So I don't even see those names. I'm not even tempted to buy the falling knives and the stocks that are in downtrends and so forth.
Exactly. You're starting from a much cleaner universe of potential ideas, right? And so,
right.
But you could, this would be like a daily screen, so to speak, something you could do during the day when the market's open. If you wanted something more of a research related, you could say, I want the stocks to be within, I don't know, 20% of new high, or I want the stock to have been up at least 12% in the last 3 months, and so on and so forth. There's a million ways to slice this, which is like what you mentioned.
Yeah.
I'm going to turn off that figure. So in the last 3 months, there are 101 stocks that are up at least 12% or more in that list, things like that.
Yeah. And now,
like Mark said,
show your own, if you want to show whatever you want to show features,
sure.
feel free.
Yeah, what you said about the screening is very important. So unfortunately, it would be cool if we had a screener that said, these are the 10 items that I love to look at. Give me the stocks that meet 7 of the 10 criteria. We don't have the logic for that. So the screener is very all or none. So you want to segment your screen. So if I'm looking for IPOs, I just create a screen based on IPOs, like Mark said. Or if I'm looking for stocks with big sales, I think I heard Mark Cuban on a TED Talk or a podcast or something where he talked about sales being a big thing. So I was like, oh, okay, let me just build a screen based on what he says and just see what shows up. So, I experiment a lot with this just to try to get an idea on what the market is, pushing out as far as potential ideas.
Yeah.
If you want to, now that's the custom screen. If you want us to do the work for you, then what Mark mentioned, the open stock ideas, this is your best bet. This is the table of contents for all the best screens and reports that we find most of our clients are using. So you've got breaking out today, stocks that are near a pivot based on the algorithm that we have, the pattern rec algorithm, stocks that have broken out in the last 3 weeks or less based on that same algorithm. RS line blue dot. So relative strength's a big deal, I imagine, to most of you. Stocks where the RS line is at or new high, and the stock is, I have my pattern rec off, so bear with me, I'll turn it on. So this blue dot is telling me that the relative strength is at 52-week highs, and the stock is either in a base or recently breaking out of a base, as in recently meaning this week. So here's Ashland, very close to the top of the space, and the relative strength line is at all-time highs, 52-week highs.
And I love the blue dot to run that in a bear market. That's a screen that you should always run in a bear market. RS line near new high, and this narrows it down a bit more, looking at the stock price in a base and near a new high. So this is one that where the leaders, it's almost impossible for the really the best names and the leading stocks to get by you if you run this in a bear market, because they're the ones that, while the market's in a downtrend, they're holding up. They're building bases. The RS line is moving up, because even if the stock doesn't go up, if it goes down less than the market, that's going to improve the relative strength. So this is a key screen to run. Scott, also something that I love that you guys have added is you can put RS line near a new high with a certain percentage now.
So that would be
a little heads up.
A screener item. Yep. So if you want to get ahead of the curve, like you said, yeah, you could say, if I go to, let's open this and go to price and volume. And so you've got relative strength line is within 5% of a new high. So you just choose yes in this case. So you've got RS line new high, yes or no, if you or new low. If you're interested in shorting, you could do that. But you just choose yes in this case. And let's turn off the other parameter. But within the 5-month wide, there are 78 stocks where the RS line is within 5% of the new high, of its new high. The RS line's new high, not the stock price.
Yeah, I call that my orange dot screen. Got the blue dot, that's orange dot.
I like it. Yeah, though the blue dot has two parameters, right? You've got the RS line, but you also have to have a base as identified by the algorithm. That's
Right.
both good and bad, right? And maybe you don't like the base. Maybe there's an earlier entry that you might use,
Sure.
and the algorithm doesn't see that earlier entry. So that's why I think you want to do both. You got the blue dot, and you have either a screen like this, or down below, we have a list called all RS line new highs. So every Friday, it's just going to screen the database for all the stocks where the RS line is at new high ground, and just give you a list, regardless of the pattern, regardless of the fundamentals, the technicals. All it's looking for is a relative strength line at new high, yes or no, and it creates this list for you. You can see there are 351 items. It's sorted by event date. So the most relevant names to you would be on top. As you scroll down this list and do your work, it's going to become more of a history book, so to speak, of previous RS line new highs, which is fine, but just keep that in mind. And the names will stay in this list for 45 days. So after 45 days, they'll fall off. Unless the RS line is still a new high, then it can stay in there.
And I should point out that when you take something like a screen like this and you build the trend template, my trend template in there, and you're using RS lines in new high or near new highs, if you went back and you ran this and you looked at when Amazon came out of its bases, and when Netflix, and when Google, and when all these big leaders, that some of the best stocks ever, they all would have came up on this screen. You're not going to miss the leaders. You're definitely going to see the stocks in the uptrends, because all of those stocks bottom, the best stocks bottom before the market. So you'll see the market will be in a bear market, and the best names are already in uptrends. So this will pick that up. And that's why it's important to run this, particularly when you're in a correction or a big bear market.
And Mark, a common question I get emails all the time, because you have so many people across the globe. We are U.S. listed equities only. We do have ADRs, but it has to be, BABA, Pinduoduo is in Marcus Smith, but it's all U.S. listed stocks only. We don't have any foreign exchanges, unfortunately. And a question somebody asked about the RS rating. Our RS rating is a little different than most people. It's not like an RSI, like an overbought, oversold. It's more, it's measuring relative to our entire database. So the best way to think about the 89 for Ashland in the last 12 months, and it's not a perfect trailing 12 months. There is some proprietary nature to it. It does weight the current environment more. The 3-month and the 6-month performance is weighted. But as a general rule, in the last 12 months, Ashland has outperformed 89% of the stocks in our database. That's what an 89 would be.
Just to let you guys know too, I stopped out of the ALNY. Just like we said, we're looking at the intraday as sort of as the daily, and the daily as the weekly, sort of an exercise. We did take out that low, and we're breaking down here. We didn't get that support. We had 1, 2, 3, 4, 5, 6 lower lows, a dead cat bounce. I know the charts I'm not sharing right now, but I could show you later.
Yeah. Do you want to switch?
No,
do you
that's fine.
Okay.
It's okay. No, keep going. I just wanted to point that out and just let you know that I did stop out of that. So I got knocked out of that trade.
Okay. And
Still in the
somebody
ADM.
asked, I'm sorry, Mark.
Go ahead.
Somebody asked about comparing the stock to the S&P. Well, we do that for you automatically with this relative strength line. So I'll pull up Apple, and bear with me. I have 2 relative strength lines on there. So let me take one off to make it cleaner.
And it's important to point out that another change that you guys made is that you can have you can compare it to the NASDAQ or the Russell too.
Correct. You can compare you could compare every stock you want to Tesla if you wanted. I mean, you can
Right.
choose anything, but this line is Apple's performance versus the S&P. So in essence, Apple is outperforming the S&P, or let me choose something that's a little bit easier to see. So here's Tesla going up, outperforming the S&P, going down, underperforming the S&P. And even if the S&P was going down, if Tesla's going down more than the S&P, that line will be, turning and pointing down. So that's what that relative strength line is.
Yeah, and you can see Tesla is turning into a textbook example of stage 2, stage 3, stage 4. You're turning down to stage 4. It got very toppy there. Took a long time for that top to form, but now you've rolled over. You've taken out those lows. The 200-day is in a downtrend. You're getting into that stage 4 decline now.
John asked about, he noticed on your screen and mine that I have like gross margin here for Tesla. And he has dividend PE. So this is something you can customize. So John, you would want to click on the wrench in the upper right corner. And in the drop-down menu, do you see the quarterly data blocks? This is the standard dividend PE range, but you can change it after tax, pre-tax, gross margin, return on equity. So if I just click on pre-tax margin, for example, now you'll see the pre-tax margin below the quarterly earnings and sales data block. Yep, of course. Thank you. Somebody asked about the scale, the logarithmic versus arithmetic. We just have a standard for the daily. You can adjust a weekly chart if needed. So right now on my weekly chart for Tesla, I am on price scale standard because it tells me best fit. Yeah. If I wanted to see this price action that's kind of off the chart, then I can tell Marcus Smith, fit the prices to the chart. And now it's going to scrunch it all there so it fits. And it lost its mind with the pattern rec when it did that, but you get the idea. So we only have those standards. You can't adjust them how you prefer to do it. For what it's worth, I prefer the standard view. I think the standard is the best way to look at them, but you can play with it and see how it looks for you. Somebody asked about adding moving averages. So that, again, we're going to be in the wrench, click on the wrench and choose moving averages. Marcus Smith has, let's talk daily chart, a 50 and a 200-day are automatic on the chart. You cannot adjust those. You cannot remove them. They're just there. So there's the 200, which is black. There's the 50, which is red. But you can add two custom time moving averages, I should say, to the 3 different time periods. So here's the daily option. Here's the weekly option. Here's the monthly option. So if I wanted I've got the 21-day, but let's scroll. If you see, you got the scroll wheel. If you wanted the 28-day moving average, whatever you did a study, that's the magic number, great. You want it to be exponential, no problem. You just hit apply changes. And now the green line is that 28-day exponential moving average that I just added.
Scott, one of the things that it's a very simple way to use Marcus Smith, but I find it to be one of the most powerful, is that when you run a screen, if we can go back to screening, and if you cast the net wide, like I said, you let's just say you look at all the stocks that are in the trend template that are in uptrend, which right now in this market, there's not very many. It's a couple of hundred. When the market's in a strong uptrend, a bull market, I've seen that up 900, 1,000 names. But what I like to do is set up my headings. So you've got the composite rating, RS, and then from there, just sort. The sorting function to me is one of the most powerful tools. I just want to look at everything in an uptrend, and then I can sort in relative strength. And then I look at them from RS from top RS down. If I'm looking for stocks that I want good fundamentals, I just sort in SMR rating. If I want to I can sort in composite rating, and that takes in account the group and everything. And you're going to probably see solar names in there, and the oil names, the stocks that are acting the best. So the sorting function, even right down to the IPOs, where I just sort in IPO date. So then I get the ones that are the shortest and the most recent. And then as I'm screening, it elongates. I hit the space bar and I scroll my way down. So I just find that the sorting function, if you cast your net wide and then use the sorting, it's very powerful just in that alone, just a very simple way to apply it.
I agree. If you get a big list, let's say you do a screen and there's 600 names in there, it might seem daunting to you. And so by sorting it, in this case, I sorted by the comp rating, brought all the 99s to the top. And if I just double click the very first stock, which is AIT, I'm going to close the screener here by just hitting this tab. And then I will hide this list panel. That way I get better real estate on my chart. So I'm going to hide it with this mini icon. And now I'm starting with all the 99s. And every time I hit my space bar, I move to the next 99 and eventually 98, so on and so forth. At some point, you might say, this is just not fruitful. I don't like the setups. I don't like the quality of the names. And you can just, stop and move on to your next screen or report.
Yeah.
And you can do a double sort, Jay asked. Sure. Yep, for sure, Jay. So
yeah.
The sorting is like a tiebreaker. So if I were to sort by market cap, it wouldn't make sense to do a second sort because all these numbers are so random and there's not going to be any tiebreakers. But with the proprietary ratings, especially if you have a quality list, there could be a lot of ties. Like I just scroll down, I can see there might be 30 99s. And so what it does, it's auto sorting the 99s based on alphabetical order. I'm going to click on this little yellow padlock. It's very subtle. You might not see it that well, but if you click inside that padlock, it'll lock it. And now I'm going to tell Marcus that I want a secondary sort. I want what I like to call a tiebreaker. So let's choose EPS rating, for example. So are there any 99.99s? Yes. There's 2, 4, 6, 7 of them. So now it's a much better list as far as quality. 99.99 at the top, 99.98, 99.97, and so on and so forth as you work your way down.
And you can do that with 3. You can add another one if you want to add SMR. And the good thing about that is, so now you're going to see 99.99s, then you're going to see 99.98s. So the reason why this is a good thing to do is because you want to prioritize the best performing names, the names that have the criteria and are showing the leadership profile, the criteria that is consistent with a leading stock. And so that's why I like to screen from the strongest to the weakest and then scroll in that direction, prioritize on my work the stocks I'm always favoring the stocks that are acting the best.
And when you do that, when you scroll through, Doug asked about, split screen. So I can't split screen the single monitor, but if you have a dual monitor system, like probably most of us do, like you look behind Bob, you can see all those screens. You can put a daily, a weekly, a monthly, an intraday right next to each other. And so you click on this little chart right there. It's a tiny little chart. It's called a new chart window. So if I click on that, you'll see that now I've got 2 charts, and I'm going to make this one the weekly chart. So I've got my main Marcus Smith chart is a daily. I want the next one to be a weekly, and you could rinse and repeat. You want a monthly, you want an intraday. You want to tell Marcus Smith to talk to each other. So let's tell it receive symbols from main chart with this button. And you can't see my screen because, you can only share one in Zoom, but I'm going to move the weekly over to the right. And now as I spacebar through the list, I go to Vertex Daily, and automatically you can see it's changed that other chart to a Vertex Weekly. Huge time saver, especially if you look at 500-600 charts a day, or a weekend. And if you like to look at more than one time frame, think about all the clicks that you'll save by doing that. So I would guess most of you have a dual monitor system. If you don't have one, and I probably would suggest you get one. it's a huge time saver in that regard for the different time frames.
You can also organize this on the iPad is actually really nice. On the iPad, you can split it and you can, and they actually puts all the charts stacked. So you can scroll through them and you can even put, I think you could put 3, right? You could put a monthly, weekly, and a daily, which is really nice. So the iPad has a function that's really great. I use it. I have the large iPad, and I'll sometimes, when I want to, on a Sunday when I'm watching football, I'll sit there and scroll through on the iPad.
Yeah, the iPad can do in one screen what the browser can't, unfortunately, at least at this point. Maybe in a future upgrade we can get the browser to do that. But and it's gonna scrunch your chart a little bit. But if you just kind of want to review a bunch of stocks, it's a cool way. Okay, Chris, yeah, sure, Chris, for the split screen thing, I apologize if I went too fast. If it's this little chart window right up here, if you hover your mouse over it, there's a bunch of icons up here, but it'll say new chart window. So you just click on it. You tell it the time frame. It's like a normal chart, pretty much. You just tell it the time frame you want. I want this one to be a monthly, or I want it to be an intraday. And you just, if you want them to talk to each other, that way you don't have to change the symbol each time, which makes total sense. Click on this button that says receive symbols from main chart. Oops, and I dragged it too quick, but then you just drag it to where you want it. And now when you're space barring through the list, Mark Smith is changing all the open charts you have. The stochastics, I'll defer to you, Mark. I don't use the stochastics, so you can say yes or no, or yay and nay on this, but I'll tell you how to add it. So in the upper corner, you've got the wrench. In the drop-down menu is stochastics, and it's going to create the stochastics above the chart. Take it away, because I just have, I've seen it for 20 some years, and I've just decided it's just too squiggly for me.
Yeah, I've never used stochastics,
Okay, good.
or MACD or any of that stuff for individual chart analysis of a stock. So I would, if doing what I do, I would stay away from it. And I know O'Neill would never use stochastics. But again, the charting programs are designed so there's people using this. There's investors out there that are value investors and are buying stocks that are down and oversold, and Marcus Smith is valuable for them too, even though it's been built around the O'Neill and the CanSlim criteria. It's really geared towards, but it's certainly flexible enough to be used for other applications, other strategies as well.
Yeah, so we don't have like MACDs or Bollinger Bands, and the reason is, like what Marcus said, this product was geared towards the William O'Neill investing style many moons ago, and it's kind of stayed that way in a kind of a legacy version. Now, we would like to add stuff that way. I think in a perfect world, we give you everything and allow you to say yay or nay. So the stochastics is a nay for me. I just turn it off. But some people, they ask about it, they like it, and so at least you have that option. So yeah, and eventually we'll add things like that, but mostly it's clean. It's the chart is designed the way Bill preferred it to be, and we've kind of stayed the course through all the years that way.
Yep.
Can I create a screen? Good question. So somebody asked if I create this screen based on Mark's 5-month wide list, for example, fast forward 6 months from now, the 5-month wide list is going to be different, right? It will update automatically. So every Friday, this list changes. Maybe it's very subtle from week to week, but it will change. So in 6 months, if there's 500 stocks in the 5-month wide, your universe at that time will be all those 500 stocks. You don't have to do this each time.
I think, Scott, I'm not sure. I think I think it was weekly updated at one time, and I was trying to get it to be updated in real time or daily. I'm not sure. Is that still weekly?
It is, yeah.
No?
Every
Yeah.
every Friday after the close,
Gotcha.
give or take a few hours, the list will change.
Gotcha. That's the only drawback is that intra week you do, and that's one of the reasons why even with my own screening, when I showed you some of the screens that I use, when I just look at the high RS names that are off the highs by a certain percentage, and even if I don't put in that criteria and use my own trend template, I'm seeing everything. I'm going to see everything that's in an uptrend, and there might be a few stocks that don't meet some of the criteria, but 99% of everything I'm going to see. But I'm able to do that daily because I do screen on a daily basis.
And so, if from a resource standpoint of programming hours, it would be cool. That would be one of the many things that I would like to add, is just to be able to make that more real time and things like that. So
Yeah.
it's something that we probably will have, but yeah, as we sit here now, it's only changing once a week.
And maybe on your weekend work, when you do my big screenings on my weekends, and that's where I do my I run a bunch of screenings. I sort of do my big screening, and then I do lighter screening throughout the week, sort of on the backs of those results. So maybe you could use that on your weekend work, and then as you go throughout the week, you have some utility screens.
Agreed. I think that's the best way to attack this, is a very thorough, strong weekend routine. And then depending on, some of us have day jobs, and it might be hard to do screening and research on a Tuesday afternoon or a Tuesday morning.
Yeah.
But if you have that strong foundation, you've prepared yourself with that weekend work, then you're ready. And then if you can, and like you guys that trade for a living, so to speak, you can, you have those other things you can use to, to search for ideas.
Yeah. Anything else as far as Market Smith? Now, I don't even know if I'm not prepared really for this, so I don't want to say something and put your foot in your mouth. But I don't know. I think you might have a special offer for attendees, right?
Yeah. So
Okay.
if you're new, if you've never taken Marcus Smith before, then we'll give you 15 months of service instead of the usual 12 on the annual. So the price is $14.99 a year. Some of you, it depends on where you're located, whether it's state tax or if you're in Europe, you'll be subject to the VAT, the value added tax. There is a tax. I want to make sure everyone knows it's $14.99 plus tax. But we do offer 15 months instead of the usual 12. If you're new or you're on a monthly, you can change to that. If you're on an annual already, if you've already gotten a promotion for us, then we can't change the 15 what you have to a 15 month. If you have an annual with us and you didn't get a promotion, it was a 12 month. I put the email in the chat just now, marketsmith@investors.com. Email us, and I'll be glad to add a bonus month to your subscription. So it's $14.99 for 15 months is the promotion that we have for Mark's attendees.
And I'll be sending out a flyer to everybody along with, I think we mentioned the certificate. We need to send out the properly updated certificate of completion as well. So you'll get an email, everybody, with these two updated flyers.
And an important part, although we hope that you stay the 15 months, if you use Market Smith for 92 days and decide, it's not for me, then you're always subject to the prorated refund, whether it's 92 days or 9 days or 100 days, it doesn't matter. You always have that option. So you don't feel like, when you make a commitment for 15 months, like, oh boy, I'm stuck. You always have the option of a prorated refund with the annual subscription. Lisa, I'm sorry, don't see the email that he put in. It's the email is Market Smith, so the name Market Smith @investors.com, investors.com.
You only send it to the host and panelists, not to everyone.
Oh,
Scott,
did I? I'm sorry. Thank you.
If you want
Have I been replying in the chat to nobody? Just to you guys?
If you hit the person's name individually.
Everyone. I needed everyone.
Yeah, everyone.
Yeah, that'll go out to everyone.
Okay. Yeah. I've been replying to some people's questions and no one saw that. I apologize. I messed that up. But yeah, if you have a question, send us an email, even if it's not subscription related. You won't need a promo code. I think, Bob, you will send them an email with the details.
Yeah, I think I can also even drop, I think, the link we have here. I'll send this to everybody here as well, but we'll send out the email in an email. But this is the link, guys, that takes you right to the special promotion for the Minervini Master Trader Program attendees.
And I don't get a kickback on this, so just so you know.
That is true. But
any-
Marcus Smith at investors.com, guys, as you can see now from Scott, that's how, for those who may already have, as mentioned, the promotion or a membership, you do have the ability to get what would be the one extra month taken care of.
Or just an in general question. Like
Okay.
if we didn't address your question, you're welcome to email us there as well.
There's a question that I know somebody asked if there's the ability to change the bar to candlesticks, or is that coming?
No, yeah. I hesitate to say that it's coming because I don't have any kind of ETA on when, but you know, fast forward long enough, we will have candlesticks.
I've heard that question many times.
Yeah. A lot of people like candlesticks.
I know.
It's one of the things we get probably the most requested item. So you know, and again, I don't think I would use it, but you know, it's like the stochastics. Give them a chance to turn it on or off if they want it, and go from there. So, but you know, the reason we've stayed kind of in our lane for so long and kind of fought these changes is that kind of legacy, that homage to Bill O'Neill is, you know, this is the way he liked it, and it works so well for him. Why change that? So
anything else that you want to show on any features? Or I mean, we've covered some of the real meat of it. It's very powerful. There's lots of things you can do, but as I said before, approaching it from a more simplistic way, where you don't get too complicated in the screens and use the sorting functions, and you sort of layer your screening by having wider nets. You get to see all the names. And, you know, bottom line, Scott, you know, as good as we've all been at, you know, Bill O'Neill wrote books, I wrote books, you guys have, you know, charting products, and we have rankings and all these things. We still can't quantify this to the point where it does the work for you. We still got to roll up our sleeves and do some good old fashioned analysis and legwork here. So I think it's important, and I often say that, you know, again, if we could quantify it, if we could put everything into a spreadsheet and quantify everything, then there would be no opportunity, because the market would be efficient. And so thank God that we can't, and that it is an art form, and it does require skill. Just like poker, you know, you can know about laying pot odds, and you can know the probability of every hand, but there's still a skill element of it. It's not going to be completely quantifiable, because you're in a game against other opponents where the skill of, you know, operating is you're going against. And the same thing with the market. Varying levels of skill and information is going to create inefficiencies, and that's the whole key. But everything that, you know, I was talking, Scott, over the fundamental section of the workshop, and, you know, I get these questions. I'll show, you know, I use margin, sales, earnings, and I start getting questions on, you know, price to sales, price to book, and all these other metrics. And two things. One, I always say, you know, if analyzing balance sheets was the key to being, you know, a great stock trader, accountants would be the richest people in the world, you know. So, but, you know, what I try to point back is to say, look, my success has been, you know, by looking at sales, earnings, and margins. And that's sort of the net. I mean, if a company's making money and they're delivering the earnings and their margins, you don't really have to look much further. And O'Neill, you know, Bill also kept it pretty simple with maybe return on equity and a few things, but, you know, it's all right here. You know, it's all right here. And I think it's important for everybody to understand that this whole system and what Bill's work and my work is not off the top of our head. It's based on not only, 100 years of collective trading experience, but also analyzing the stock market and the biggest winning stocks going all the way back to the 1800s. So there's a very, very strong foundation around the this information, and that's why MarketSmith is so great. It gives you everything you need in this bird's eye view. Very hard to get all this information in such a bird's eye view where it's so quick to be able to access exactly what you need and filter out all the noise.
Yeah, I think one of the advantages to MarketSmith is a time saver. You think about your time. There's in our database there's 9,000 stocks, ETFs, etc. There's probably as 20,000 worldwide, if you at least probably more. And how do you get down to a manageable level and find those names? I don't know. I've been a subscriber for years before I came on board. I don't know how I would find it without something like this. Yeah.
Okay. Let's see. Anything else you want to cover, Scott?
There's a couple of questions. If there's nothing going on in the market that you guys want to show, somebody asked about the pattern recognition.
Sure.
So, you see the stock, it's got this cup with handle, it's got this large consolidation, it's got this double bottom. So Mike Webster, some of you might be familiar with him. He is a former portfolio manager at William O'Neill forever, and he worked on
And a great guy.
Building this. Yeah, Mike is a solid guy. And he's gone out on his own and hung his own shingle, so to speak. So he's still involved in the markets, but he was instrumental in kind of programming and helping the programmers to try to understand, what a pattern is, what's the math behind it. And it's not perfect. It's, because it is math based. So, a lot of people might say, well, I see a cup with handle right here. How come MarketSmith doesn't? And I would just say, okay, no problem. Buy it right there if you want. That's fine. It's more of a guide. But if you hover your mouse inside the base, it'll tell you what the pattern is, what the pivot point, the action price, the buy point, whatever you want to call it, how deep the base is. That's actually probably my favorite feature, is how quickly I can kind of analyze the base. How deep did it correct? How deep did the handle correct? Things like that. And then these shaded areas are the money management principles that we use. And it's a guide. It's, here's the 0 to 5% range where you would build your position. So ideally you'd buy half here. If you wanted 1,000 shares, you'd buy 500, you'd wait. It gets halfway through the pivot, you'd buy 300, you'd wait. It pulls back, but it never hit your stop. This is down 5 to 8% from the pivot, that pink range. And then at the top of that box would be 5%. That's where you would add like your last 200 shares. That's kind of the standard O'Neill system for building a position. And then this green area is 20 to 25% from the pivot. So that's the kind of the standard profit taking area where you'd want to consider, selling or all or maybe a portion of it. And that's how these shaded areas are programmed in.
So a few things, a few points here that are good to talk about. First of all, these are guides, all right? These definitely guidelines, but they go together with the pattern recognition. That's something that if you're a beginner, you probably want to use, and it'll give you a good idea of when you're in a base. If you put this in connection with the my trend template, now you've got stocks that are in uptrends and are in bases. Now, I know there's a question about the measuring tool. There's the measuring tool that I use in the eSignal program. That they don't have the measuring tool here, but as Scott shown, you could hover over and it'll show you the depth of the base and the handle. So that will give you that some of that measurement that you can decipher in the volatility contraction, those iterations. So with that, and the fact that you're seeing where the bases are and they're in uptrends, and then you've got overlaid where you pyramid your position and where you would have your stop loss based on a maximum of 8%. You've got some real good guideposts here to at least get you in the ballpark and really not get you too far off track, because that's in the beginning. There's going to be a lot of variance in how well you do this, because you haven't done it very long and you're not very good at it yet. So you need to have these reference points, and they're very important.
Somebody asked about exporting. So if I run the screen that we built, the results are going to show up down below here in that list panel. And if you want to export those results to Excel, you just click on this wrench this time in the bottom right corner, and you'll see export in. Excel 9703 Excel. I find either one of them works. You just click on one of those. And
a quick hack also is if you just make a new screen and then the screen comes up and it'll be blank, you can cut and paste. If you're in Excel spreadsheet, you can grab a whole bunch of names if you want, and then just hit Control V, and it'll populate this. So instead of importing them in, you could actually import them that way too if you want to cut and paste them in. That's sort of a little quick way to do it that I use.
Correct. Yep, it works both ways if you had them already. So depending on your browser, most browsers dump into the bottom left corner. You'll see I'm using Edge. Edge creates this little download folder up there. And so that's where you'd find the results.
Yeah.
Last but not least, I think as somebody asked about the trend line alerts. So you can draw, I don't know, let's just say for whatever reason you wanted to know if Amazon broke this little downtrend right here. So step one is, and I'm using a PC, so it'll be a little different for a Mac. I think it's Command is the key. But in the bottom left corner of your keyboard is the Control key. Hold that Control key down and just drag your mouse where you want the line to be. And these are all temporary lines. So if you don't like it, you just do it again, or just refresh the chart by hitting the daily button so that it goes away. But once you have the line how you like it, if you hover your mouse over it, you'll see it creates this little dull yellow background. And now right click. Don't fail me now. Thank you. Okay. And here, let me turn off the pattern rec. Sometimes with the pattern rec on, it loses its mind. Oh, I just got too impatient, too much clicking. But if you, okay, so we draw the line, hover our mouse over it. Eventually we're going to get this. I promise.
Okay.
Right click, set alert becomes an option. You'll get the little pop-up box. It says symbol Amazon, win, line. D stands for dailies. Because I'm on the daily chart, it's going to create a daily trend line alert. You can do it on a weekly or even a monthly. Do you want an email notification? Yes, I prefer to get it. You can turn that on or off. Hit done. And then the line will change to a dotted black line. And that's a live alert. And it will follow the stock down. So eventually, pretty much, especially for a stock like Amazon, as this trends down, eventually it's going to cross above it and the alert will go off. You'll get the little pop-up bell here, and it will say Amazon crossed above your trend line, or you could do it below if you wanted to do it that way as well. So yes, it will follow the stock along the whole way. If you have Market Smith, it gets a little buggy if you try to set the screen. I'm sorry, if you try to set the line alert too far to the right, just an FYI. So just draw the line however you want. It will extend it all the way out. It'll follow that stock the whole way. So you don't have to worry about getting that line so perfect. Yeah, Rick mentioned in if you're having issues with this, it is a little buggy, we are troubleshooting it. So I hope to have this resolved, because this is a big deal. My favorite way to send an alert is with a trend line alert, because everybody has a price alert. I can do 1 million price alerts with my broker. So I like trend line alerts. Try clearing your browsing history and cache on your browser and then reopen the charts. That could help if you're finding this to be a little buggy. And then the other thing is turn off the pattern recognition. if you try to draw a trend line within the pattern recognition, it kind of loses its mind. It's not sure if you want a trend line or if you want an alert based on the pattern, because you can set an alert based on the pattern. So those are a couple of tricks anyways, until we fix it. And hopefully we'll get that fixed. It's not so unuser friendly.
Okay, Scott, great. Thank you, man. Appreciate it. We covered quite
Thank
a
you.
bit. Yeah, we covered
All
quite a
right.
bit on Market Smith. Any closing comments or anything?
I don't. I really appreciate it. Thank you for allowing us to be a part of your events. And again, if you have questions or want to take advantage of that offer, the Marcus Smith email, and or I think Bob will send you an email with a link on how to process that.
Okay, great. Awesome.
Okay.
Yeah,
Thank
man.
you, guys. Have a great week.
Thanks, Scott. Talk to you.
Bye.
Okay, great. So now let's see here. Let me go back to sharing my screen.
And real quick, Scott, before you left, I was going to say, okay. I didn't know if he was going to hang out or wanted to hang out, but he's more than happy to.
Oh yeah, certainly welcome to. So we got ADM is moving up a little bit more here, so that's good because it's offsetting my my loss on the as Gordon Gecko would say, the bow wow trade.
Dog with fleas.
Dog with fleas. If we take a look at ALNY, so now ALNY is moving lower here. So again, on the intraday, like I said, looking at this as this was a daily, you see the violations. Once the violations started piling up and you got all those lower lows, it wasn't acting natural now. And now it's corrected even more here. Now, of course, on the daily, this isn't really a big deal. We're magnifying it on the intraday. This is exactly what we've seen over and over. It's stalling out exactly where it should. If it's going to stall, this is where it should. But still, it's fine. I mean, if you're swing trading, you should not be selling this. And let me just point this out here. If this could hold up here, even if maybe it has a bad close around here today, comes off another day, well, as long as it holds up, it tightens up a bit here, you could be looking at a better setup in a couple of days from now. All right, let me show you. Oops, sorry. This here. And this tightens up a bit. Now you get a reversal recovery, take out that reversal, and you come from an even tighter pivot. And now that's just, once again, just another iteration. You got the first here, right? From here to here. Oops, sorry about that. From here to here, from here to here. And now you have just two more. Now you're getting real tight there, right? That would be perfect. That's exactly what we want to see. And preferably, we want to see that during a weak market. Like if the market came off here, let's say over the next few days, the market corrects. And when I say the market, I mean the indexes, and the Dow comes in, but during that time, this stock goes real tight and the volume stays real low. Well, that would be something I'd be even more interested in. Even though I just got stopped out of it, I'll go right back into it. I'll re-enter it if it can break out. So this may improve. And we just may be a little bit early here, but we don't know until in hindsight, we don't know, because this still met the criteria here. So once it starts tightening up and gets that single digit, we could start taking a position. But again, until we see some traction, until we start getting some traction and seeing stocks work and seeing a proliferation of these type of setups working, we want to be careful and just go in light. So yeah, we're moving up here. Also, ADM's moving up a little bit more here, only up a couple percent. But like I said, this is moving in the right direction now. The intraday is acting very good. You could see a little natural reaction, formed a little mini VCP, little natural reaction, boom, right into new high ground, and now we're accelerating here. So far so good. Volume, if you take a look at the volume, we're at 12 o'clock. That's actually pretty good volume. You can see we're about 2/3 of the way to average volume. This could easily be above average volume here. So I like what I'm seeing in ADM, ALNY. Unfortunately, ALNY was the one that I bought a bigger position in. So, but it would be nice if I had the 5,000, or I guess equivalent. The 5,000 shares in this one than in the ALNY. But again, offsetting, I took some off into the rally that banked a little bit of profit, cushioned me a little bit. And now I'm up on this one. I'm up about $1,300 on this one. So this is cushioning the hit on the ALNY a little bit. So again, if it just trying to finance that risk here. What else? Let's go. What we can do now is, why don't we go? It's 12 o'clock, 12:15. This is where we get into usually a more quieter period around lunchtime in the market. Maybe we can switch over to the workbook now and start going back to some questions that you have about, because we had some curriculum on day 4, of course, that we didn't have a Q&A. If you have questions on that. So let me just, I'm going to change my, I'm going to stop sharing. Or actually, you know what? No, I'm going to share. Hold on. Sorry about that. I'm going to share.
Workbook.
Yeah, I'm going to go to the workbook. Yeah, I'm going to share. Then I'm going to open the workbook here. Let me just set this
Mark,
up.
I also don't
I'm
know.
just going to show you the PowerPoint so you can see the PowerPoint, and I'll work from the PowerPoint. That'll be an easy way. And I'm just going to move this over to fill your screen.
Yeah. Did you, I don't know if you,
actually do this. Hold on. I can actually just, let me fill the screen so you guys can see it. It'll be a little better here. Okay, there you go. That should be
yeah, it's pretty solid there.
hold on, I'm going to get it where it fills the whole screen. So there you go. Okay, so now we're in the workbook. Okay, go ahead. I'm sorry, Bob. What were you saying?
I was going to ask if you wanted to have, I don't think we technically set a lunch time of any kind. It's kind of, guys, we're going to do what we do, but
yeah, well, we're not taking lunch, so
right. So
we're
just
not,
to let everybody
stopping.
know, we don't have a set time for a lunch break that we're not going to be projecting.
Didn't Gordon Gekko say lunch is for wimps? Anyway, no, we're not taking lunch, but I haven't even had breakfast yet, so I'm gonna try to get my wife to bring me something over here and bring me some food here.
Had a lot of questions, really, as you might imagine, with regards to progressive exposure. People essentially asking, when do you start pressing it? What if you have paper profits but not realized profits? Do you still increase your exposure there? At what point do you start? Would you bring it back down if you take one loss or 2 or 3? So yeah, a lot of questions about progressive exposure, as you might imagine.
Okay, so first of all, let me just say this, that and Mark, I'm going to bring you in on this too, because we haven't heard much from you. And progressive exposure is something I definitely would like you to talk about. Progressive exposure is a few things about progressive exposure. First of all, it is one of the absolute most important techniques or tactics that you need to understand, and that will make the biggest difference in your outcome, in your success or failure. It is without a doubt, for all the successful traders that I've worked with, that I've trained, they always come back to saying that was one of the absolute key things that made the biggest difference. Now, with that said, it also has the most subjectivity, I think, or it is the least of exact sciences. And we're going to go back here. The bottom line is that it has to be relative to your own size. You kind of start with what your maximum size would be. So just say if your maximum full position is 25%, that's sort of the starting point. Everything's based on that. So that's your starting point. Generally speaking, I'm going to trade at a quarter to a half of that full size and expose from there. So if I'm just starting to get into the market, I might take a quarter. I mean, and then it might even be just like today, it's just randomly, I just decided, X amount of dollar risk. I'm going to go in 1,000 shares. Let's just say, it's $2 to the low. It's $2,000 risk. I sometimes just make decisions like that, and that's fine, especially when you're trading sort of to keep your finger on the pulse. It doesn't really matter as much because you're just trying to put some money on the line and trade in under real conditions, but you're just getting feedback. So, Mark, why don't you? Is he here too? Because I got him off the screen.
Yes.
There you are. Okay.
Watching and waiting.
Yeah. So, this is the same question we get over and over and over and over. When do you press it? When do you pull back? How many trades have to be profitable before you bump up? How many trades, what percentage do you bump up? And again, maybe someday I'll do a better job at, quantifying this a bit more and having more of a strategic, black and white answer to that. I don't think so, though. I think it's because it's so built in, it's so based on the individual and this is really, part of the art form. But the key is to get yourself to trade the largest when you're trading the best and the smallest when you're trading your worst. That's what you want it to guarantee you, that as the trades are working, you're moving your exposure up, financing the risk. And as they're not, you're getting smaller. So you're not losing the same size or bigger size. When you're losing smaller and smaller and smaller. So if you get into a trending period, you're trading your absolute smallest, so you're in cash. That is the real key that you have to understand. But with that, Mark, as far as any kind of guidelines or rules, where are you at with that, and what would you recommend?
Yeah, I mean, look, this is really the part of this strategy that is the art, in terms of, but it doesn't, it's not that it doesn't have a very firm, science, mechanical, if you will, scientific underpinning. The idea.
I'll be right back. Continue.
Sure. Yeah. Go grab some food or whatever. So a couple of things. The one I would say is I always want to know what is actually going on in my trading, meaning, so let's just say, hypothetically speaking, I've got a list of 5 names. I buy one, it doesn't go anywhere, and 3 others blast off and I didn't buy them. Maybe I bought the first one, broke out, and it squatted. And so I didn't buy another one. Well, I'm going to take the fact that the names I own, I don't have anything to lean on. I'm always looking to build up a cushion to lean on. I know we had a question, Bob, you said about, do you wait for booked profits versus open? Generally speaking, for me, I'm always leaning on open profits first. So I want to use that first bit of traction as something to, as building in some padding for me to buy a little more. But that doesn't mean that I'm necessarily going to let everything just stop me out and clobber me right away. I might move some things up or make some overall portfolio decisions right then. But so the 2 big things is, what is happening in terms of my actual trading, and then where are things on balance? So the more you do this, you're going to have a list where you never buy the whole list, just by the way things work out. So you might have a list of 10 names, 20 names. Today's a good example. If you'd bought everything that poked its head out, ask yourself that, where would you be? You'd be underwater today. So I'm using that also as to say, at some point, we're going to be in a period where, and for those of you guys who've been doing this for a while, know exactly what I'm talking about, where a majority of the names that we're watching are acting well, or they're breaking out and holding and moving higher. So even if I'm only in 2 of them, but things on average across the universe are really acting well, that gives me, again, additional confidence to bump up size. But I am not, if I haven't earned the right in terms of my own trading, it doesn't matter how good everything else in the universe is trading. And there have been times where I buy 1 or 2, I buy a couple of the names that don't move, and a lot of other things blast off because I buy in the order of breakout. And maybe the first couple of names that pop their head out don't really get going, where you kind of have to continue to jockey for position. That is the best analogy, though. The idea of jockeying for position is you're sort of in the pack trying to figure out, how to maneuver. You don't necessarily know exactly, how to, position yourself right away. So that's how I think about it. But I'm never, ever, ever increasing without some form of a cushion. And for me, though, that is almost always open profits first. I don't wait to book them to at least get more aggressive initially.
One thing I was going to add to that.
I'm muted. I'm sorry. Let me just say something real quick. I like that, earn the right. I'm going to use that and put that in the PowerPoint here. Earning the right to trade larger. That is great. Yes. Have you earned the right? It doesn't matter what's happening in the world around you and the stocks that you're not in. It matters what you're in, because if stocks are blasting off, but your trading is not producing the results, you've got to manage that risk because you are now in the hole. And so that you can't trade larger just because the market looks good or whatever. You've got to earn the right. I love that. Go ahead, Bob. I'm sorry.
I was just going to say, I think I get this question asked, over all the years, probably more than almost any other question, but it really
Yeah.
comes down to, as a lot of times, is your individual risk tolerance. Mark are very happy or comfortable perhaps risking what would be profits, even paper profits before. I know some people are more conservative, would rather have locked in profits before they escalate. So that's why we always talk about the pillow factor. We have to do what you're comfortable with so you can sleep comfortably at night. And it can be frustrating if you use previous profits to then increase your exposure, only to have it get lose that back on the next trade, because in the example there, you're losing back the $1,000 that you made on the first trade. Mark's okay with that, because if he catches the market just right, it's going to lead to that second win, that's the third win, and accelerate it. And if he gives it back, it's nothing lost, nothing what's the expression you use, Mark? Nothing gained, nothing lost, kind of just a push. And that's something he's comfortable with, but some people are not, and complain and get all worked up when they just lost everything they just won or made in the first wave of trades. So that's the thing where it is an individual decision to really understand what you're comfortable with.
On another point too, just on position sizing and so forth, you see today, I went and I bought 1,000 shares of ADM. I bought 5,000 shares. So I bought a much larger position size. And now the one that I had the large position size, was the one that stopped me out, and the smaller position size is the one working. So, and this is another question we get all the time, as far as should you take equal position sizes or have favorites and so forth. It generally comes out with me. I'm a professional at this, and I'm going to I have such a consistent application of discipline that it comes out in the wash. I may have done that today, and tomorrow it'll be just the opposite. I'll position size big on the one that'll work, and the one that I position size small won't work. So my intuitive gut is pretty good at this. And even though I may not get it on any one day right, over time, they sort of just all come out in the wash. But you should probably try to be more mechanical with this and develop some type of formula based on your largest position size, and maybe cut it in half, quarters, and then just negligible, sort of just keep your finger on the pulse, what David Ryan calls mental health buys, just buying a little bit in case the stock takes off, and being involved. I would try to break it down into those tranches and sort of have a formula, some plan that you stick with, instead of shooting strictly off of your own emotions or having favorites and things like that. It's going to take a long time before you get to that. And even with myself, I try to keep my position sizing as standard as possible. When I start trading, and the way I do it, to be honest with you, the way I do it is I just try to work up to the biggest positions I can possibly get on. That's sort of how and that is really when I'm making money, big money. It's when I've got the big positions on and I got the big exposure. So that's what really matters. Everything else is sort of jockeying for position and treading water and making a little bit, chipping up a bit to have those profits, to be able to get aggressive and keeping the downside in check. So again, what's really important, and then once I do trade big, all the positions are pretty much the same, because I'm just putting on the max that I can. That's what Mark and I are trying to get to. We're trying to get to that point where we've earned the right to be as George Soros and Stanley Druckenmiller said, be a pig in the market. I'm a chicken most of the time, but every night you got to get piggish every now and then, and get in there and be greedy, and you put the big positions on and make hay when you may. So, but that's a very small portion of the time that you're in the market. If we're averaging 50% out of the market, and it might be 10 or 20% of the time where you're really super aggressive. But that's the upside. Like, that's the benefit of being exposed only minimally and making a lot of money with not having exposure all the time. You don't want to be exposed all the time. I just had a nice big plate of eggs delivered to me here, so excuse me if I eat in front of you.
Question being asked if you ever use a time stop versus just purely a price stop, because he finds he might be in a trade, other trades are setting up and breaking out. He doesn't know if he should close the trade that's not working to put the money into a new breakout.
Well, you got to be real careful with time stops, because just because a stock hasn't gone in X amount of minutes or days doesn't necessarily mean that it technically has soured. As a matter of fact, like I just showed you in a few of these examples, it could improve, and time is your friend. So I know some traders, actually a couple come to mind that came to Master Trader Program that are massively, massively successful. And both of them, there's two in particular that do use time stops. They use it when they put on the trade. So like, for instance, the ADM trade, they go into this trade today. If it doesn't go right away and it stalls, they give it X amount of time, call it 2 hours, 2 minutes, whatever you want to call it. Then they say, okay, I didn't time it right. And they get out, and then they look to re-enter. That's, a very expert approach that you have to, again, if you have re-entry mechanisms and you're nimble enough and you're in there watching this all day long and you're trading more professionally, as opposed to, you're part-time and you have a job, it'd be a lot harder to do that. So I'd be careful with that, but it certainly has its place. I look at the time factor on the chart. Is this time too long on the chart? Is it abnormal? So I relate everything back to the chart. The chart tells me everything. As my good friend Stan Weinstein says, the tape tells all. And I agree with that. Pretty much everything.
Somewhat of what you just talked about a moment ago, Mark, the question was related to that, so I want to ask it. In what this individual is experiencing, he'll have a couple of successes with the smaller size trades, then he steps it up and has the one loser wipe out what was previous gains, because he wasn't doubling, it's just incrementally increasing. So his question is, his stats look good because having a couple winners, but on a dollar basis, he's still at break even, showing no progress. How do you handle that, or how do you deal with where your stats may look good on a percent, statistically, but the dollars are not reflecting that?
So that's only because you haven't been in a really strong trending environment. I know just by what you're saying that you haven't been trading in a strong trending environment yet. And so you're in a sideways action market where the aggressive exposure is doing its job. That's precisely what's supposed to happen. And it's frustrating because you're not making any progress, and then you very quickly give it up, and you're zagging when you should zig and zigging when you should zag. But that zag zig is actually the proper zigzag. It actually is that is the right way. That's the cost. See, there's a cost. Everything has a cost. There is no free lunch here. All right. If you sell the stock soon, you risk a bigger move, right? If you take the small profit, then if it goes higher, you miss that bigger move. You sell the stock at a loss, it could turn around and go back up. There's always a cost associated. So, but that's the cost for making sure that you are trading small when you're trading the worst and trading large when you're trading your best. So now, okay, let's say the market gets into a real strong trend now, and you do that same pyramiding up, and now you get into that trending period, you're going to be guaranteed that you're trading your largest when you're trading your best. And that's the job of it. But there's a price to be paid. And in a whipsaw market, yeah, it's going to be frustrating. This is why people say, why isn't everybody doing this? Because it's not that easy. It's really difficult. It's difficult. First of all, you got to have the knowledge. You got to develop the skill. You've got to be able to control your emotions and have discipline and deal with all these things that are counterintuitive, and then deal with these long periods of time where it seems like it doesn't work. But you have to, after a while, you learn that that's part of it, that not working, all that boringness. Trading is boring. That 90% of the time, it's very boring. You don't want the hair on the back of your neck to stand up when you're trading. Did you see how calm all the trades I just did? Like, there's no big emotion. I put on the trades. I know exactly where I'm getting out. I know my position size. I bought $600,000 worth of stock today. If I bought $10 million in a position today, there would be the same exact emotions. There would be none. It would be emotionless, because I would already have my risk defined. I've got a plan, and that's the way it needs to be. I'm not looking to get excitement. This isn't for, I want to get excitement. I go drive my Lamborghini and go race around a track. That's for excitement. When I go to Vegas and roll dice and have fun. This is about performance. And if you want excitement from it, that's fine. You can get it. They'll give you a lot of excitement if you want it. But that's not, you're trying to develop this into an unemotional, very systematic, methodical strategy that achieves the goal of putting you in a position to make lots of money when you're right and minimize when you're wrong and create asymmetric leverage always. Mark, you have anything to add to that? And once again, this zigging and zagging, this is the most common thing we hear. Well, I ramped it up and then clobbered. And then when I trade small, then the stocks take off. And this progressive exposure isn't working. It's working perfectly. That's exactly what it's supposed to do, right?
Yeah, it's like it's a feature, not a bug. What was just described there, the idea though is if there will be plenty of times where you're going to jockey for position only to get out, with a tiny gain, right around break even. But if you were able to, increase your exposure without taking additional risk, do it properly. Just think about how many times you could do that. And then you really nail the timing one time. It will more than pay for all those other times. And that is very difficult though, for some folks psychologically, especially, well, I had a couple of winners and then I gave it all away. Well, the idea wasn't to make a little bit. It was to be able to position yourself properly with a small initial risk to make a giant step forward in terms of your P&L.
Hey, another thing. So let me show you. This is what when you're trading stocks, you're trading stocks that look like this, basically, right? They look like this. That's what your equity curve should look like. See, so when you're in that phase where you're getting whipped around, this is what happens right here. Yeah, and this may go on for 6 months, a year, right? But you see, the one thing that's happening here is I'm not losing any major ground. Yes, a lot of frustration in here, but not much ground being lost. And even if it was maybe, was down a little bit and you are getting grinded away a bit, still you're minimizing and putting yourself in a position for the big move and being fully invested when things are working. Just like a stock, your equity. If you were to look at Mark Ritchie's equity curve, look at my equity curve, you go through basing periods and then sharp up moves, and then basing periods and sharp up moves. And very seldom are there any big drops. And if there are big drops, and matter of fact, I looked at your equity curve, and as soon as whenever Mark Ritchie's equity curve had a big drop, it flatlined, which showed that as soon as he got under pressure, bang, he went to cash. And then it just flatlined, and then it slowly moved back, and then it accelerated. It was perfect. You could actually see the progressive exposure in the equity curve. I could look at somebody's equity curve. You show me your trading, show me your equity curve, and I'll tell you everything about the trader. Matter of fact, Mark, you remember that's us, but you didn't tell that story.
I didn't know. Yeah, I thought that one was maybe overplayed in years past, but I'll tell it again. So, in the very actually, it was after the first Master Trader program, because I had sent Mark I think it was 6 months of trading or something to win the triple digit challenge. And he did a webinar, I don't know, a few months later. And we didn't really know, we'd shaken hands in person and said hello. That was about it. And so, sorry about that. He started to describe me in what I felt was rather, somewhat personal manner in terms of my personality and certain characteristics and who I am. And they were all accurate descriptions, so much so that my partner Brandon was like, how in the world does he know that stuff? It was a little bit eerie, almost like somebody was, reading your palm or whatever. So then when we were together a number of months later for the next Master Trader program, I just brought that up. I said, that was kind of a fun trick you played there. How did you know all that about me? And he said, I've looked at all your buys and sells. Your trading is nothing but a reflection of who you are and your personality. It's all there. So, and I can't remember the comments he made specifically, but he's like, I can tell Mark Ritchie is not, he's very disciplined and he's not very emotional in terms of his trading. He said a few other things, but the idea being that your psychology and who you are is reflected in terms of the way you buy and sell in real time.
Yeah, if I look at an equity curve, I mean, I've trained thousands and thousands of traders. I've worked with thousands of people over the years, over 40 years, have had hundreds work for me. And I can look at an equity curve. I can look at someone's trading, and just like with aces, I can't tell you if you're going to win in any particular hand, but I can tell you, aces are going to win over. It's a winning hand. I can look at an equity curve and know this trader is a losing trader. This trader is going to blow up. This trader is doing everything right and is going to be a superstar. I know what a superstar equity curve looks like. You give me, maybe not in a month or two, but show me years of trading of somebody trading, and I'll tell you, I'll foretell the future because it's all right there. And it all comes down to managing the risk versus reward. So it's the exact same thing as what you're trying to accomplish with the stock. There's the same principle. You're putting yourself in a position to have this upside by capping the downside and creating the asymmetric leverage. All right, let's we're supposed to do questions on the workbook here, and we got stuck on progressive exposure for quite a while.
Yeah, well, there was a lot of questions on that.
Yeah, I know it's a huge topic and everybody asked, so it's good that we did, but let's move on.
And then there was a related question to what you just described. I'll just ask while I'm getting the questions on the pages, specific pages, but and now I just lost it. All right, I'll come back to that. Bear with me. 454.
Hold on one second. I just have to 454, did you say?
Yeah.
Gotcha.
Question was being asked if you can just review again how you're adding more shares, but with the same amount of risk.
Okay, so again, when you take your first position here, obviously it's all risk. You're risking $1,000. You're risking $1 on 1,000 shares, so you're risking $1,000 is your risk, right? As the stock moves up, and we're just going to call this a low cheat or a cheat, and then you form another pivot within the base, you get another buy point. As you add shares here and you move your stop up, the new stop becomes a backstop. It actually becomes a trailing stop on your profit and a stop loss on your new shares. So now at 1850, you add 1,000 shares, right? So you have 2,000 shares now. So you have $1.50 stop at $17 on 2,000 shares. But you net this all out, the profit that you have and the risk that you're taking, and you're still risking $1,000. If you get stopped out, your net loss is $1,000, but you now have 2,000 shares on. So if the stock goes up from there, you are now levering up. Your upside is double, but your downside is still the original $1,000 risk.
One question was asking on 430, don't have to pull that up, but on the tracker spreadsheet is asking how you accommodate or adjust for half size positions versus full size positions, because this does not take into account weighting of your trades.
Yeah, that's a common question too. I don't weight them because this, I look at it this way. This is when you look at your largest gain, your largest loss, you look at your average loss to gain. That's your decision making based on where to get out, where the chart sours and the mathematics behind it, risk reward. Position sizing, yes, is another aspect of it. And obviously, if you were taking big positions on the big gains and small positions on the smaller gains or vice versa, that would affect things. What I've found, and I used to track it and weight it. I know Mark does weight it. He does weight his results, and when he analyzes the results, he weights them. I weighted them for years, and I found that it kind of comes out in the wash, And it's just more pure to see the decision making versus the weight. Now, the weighting, if you want to do a separate table and say, okay, well, I want to see if I'm making good decisions on, position sizing. Well, again, like the previous person said, in a whipsaw market, that's going to look bad. In a good market, it's going to look great, because now the positions that are big are going to be your big winners. So it depends on the environment, whether that's going to bear out and look like it's working or not. So you have to know that. So everything comes out in the wash pretty much. Sometimes I'm going to have the bigger positions and a better name. Sometimes I'm not. But I found that it really comes around an average, and I've never seen it to give at any value to track it that way. So I stopped tracking it that way personally. We do not have that in our own tracking. We do not have that. We'll probably at some point add that feature where you can put position sizing in and then get that net result, sort of like the adjusted win-loss ratio, adjust for position sizing. We will add that. And we are now working very quickly. For those of you who are members and have used our software, we're right now working furiously on Monalert. And once we get Monalert to a certain point with charting and a lot of really cool features, we're then going to then improve trading logger, and then they're going to be tethered together even in a more impressive way, where then they all work together. We're going to have a lot of ways to slice and dice the information. So we're going to have a big leap in the technology over the next 6 months of this next year in 2023. But I personally don't use it. Even when that capability, I probably won't utilize it.
Question on 469.
469, yep.
As you increase your exposure, do you still keep overall risk to a total of 1.25 to 2.5% of your total equity? Do you keep risk to total equity even at 100% invested? Not sure why one would make a difference.
Risk of total equity is on your
Per trade.
position, on each position.
Yeah, maybe that's the problem. They're not understanding that's a per
Right.
position.
Right. It's on your position. So if you were to take a 12.5% position, if you have a 10% stop, well, that's 1.25% of total equity, 12.5 divided by 10. If you were to take a 50% position, well, that 10% stop would be 5% of total equity. So you wouldn't be able to do that. So you'd have to cut to maintain that 1.25, you'd have to take your stop all the way to 2.5%. So either your stop has to move or your position size has to move. They work together in creating your risk of total equity. So then your total exposure, that's based on how many positions you put on, but you're still, if you have a certain risk of total equity, well, that's your risk of total equity. You understand? That's each individual trade is what you're basing it on, though. Because this is to help you with the risk of ruin if you get stopped out of a bunch of stocks. So that's why on each individual stock, you only want to be risking X amount of your total equity. So it has a certain level of impact on your overall portfolio. Too little of impact, you won't make any money. Yeah, you won't lose any money, but you won't make much money. Too much, you can make lots of money, but the risk of ruin, if you get a streak and you happen to have 10 trades, 20 trades that are bad, or maybe your batting average goes down to 20%, the last 20 trades, you're only right 4 or 5 times, you can blow yourself up because now you're risking too much. There is an optimal level. And that 1.25 to 1.5 is sort of a sweet spot. 2.5 is the upper end. Anything below, we start getting, below 1 or 0.75%. Now you're getting into pilot buys, and that's not where you want to be optimally when things are working.
Page 494.
Yep.
Just a quick answer. The question was being, if they were just using the 8% at 13, not compounding. So that answer, guys, is when you do a compounding. So if you have a 2%, 25% position sizing, 8% return equals 2% on your portfolio, but your portfolio is growing with each successive winner, that's what will get you to the 30%, not just a straight line using the same original starting amount. So
a 25% position times 8%, 13 times compounded is 30%.
Yeah, so that's what that is. Norman also was just asking if you can try to explain again the concept of the saving bets can be a game changer from the mind-blowing math.
The saving bets. Yeah. And
On page
and we have a
501.
line. We have a line through
Or-
here because there was a typo. We talked about this last night, Bob.
Oh, yeah. Let's
yeah.
clarify
So
that.
this actually should be 2040, right?
Right.
That's 2060 is 2%. It's supposed to be 1% more. But the concept of saving bets is very simple. You know, again, if you're breaking rules, this is just showing that if you're buying beyond the buy point, and let's say I'm saying where I'm not going to buy more than 1%. Okay. So we're still going to stick to the same sell rules. We're not going to change our sell rule whether we bought it 1% above the buy or 2% of the buy. Doesn't really affect the sell rules. So let's just say we sell at 6%. Well, one trader buys it at 2020, sells it at 2120. The other one buys it at, in this case, 2060. 2040 is the math though. 2040, which is 1% higher. Okay, it doesn't sound like much. It's just a 1% slippage. But now do that hundreds of times, and it's a colossal difference because that adds up, all those little. Now that's just on the buy side. What if you have slippage on the sell side, and you start breaking these little, because it's a slippery slope. Once you start breaking rules, you break more rules, and before you know it, you don't have many rules, and the catastrophe strikes. So the whole point of this is to point out that the little things, as Mark said, it's the little things that add up because it's over time. It's just like an airplane. If you take a plane, a jet that goes from New York to LA, and you just put it off just 1 degree, well, in a very short period of time, it goes pretty much on its course. But over a long stretch, it'll be up in British Columbia. It'll be up in Canada, because and same thing with a bullet. You shoot a bullet, if it's off a little bit, the further you go, the further it goes away. So these things add up over time. And that's why you have to think that you're not going to just make one trade. You're going to make lots of trades. So these numbers are going to distribute over a bell curve, and that tightening all this stuff up and having a really, really tight game creates the champion results.
Question being asked: if a stock had historical, a lot of volatility, even though it is setting up properly in a VCP now, does that affect your decision to trade that name, being that it has had historical volatility in it?
That is about as vague and hypothetical as we can get. So I really can't. I'd have to see the chart. Look, the bottom line is the chart tells it all. If it has the chart and the chart meets the criteria, well, that would assess that volatility. Assessing the volatility that's why you have a chart. The reason why you're looking at charts is to assess the volatility and lack of volatility. So you got to look at the chart. If the stock's in an uptrend, see, don't overcomplicate this. All right. Stop trying to get all these answers and just focus on what to do. Don't worry about what not to do. There's 100 million things not to do. There's a handful of things that you need to do. You know what you need to do? You need to look for stocks and uptrends, look for bases, VCPs, tight right sides, single digit tight right sides. And when they get above that pivot point, buy them. Take small positions. When things start working, raise your exposure and do the opposite on the downside. That's what you need to do. That's it. Now that could take a lifetime to become as good as me at doing that, but that's what you need to do. It's simple. It's straightforward. Is it easy? No, but there is no magic answer. Those are the things that you need to do well.
Okay.
All that takes care of everything else. That takes care of everything. Takes care of the valuation. Takes care of everything. It's all going to work out. It manage that risk versus you're going to be in, as Paul Tudor Jones said, I'm going to buy stocks to go to zero and sell stocks to go to infinity. There is so much wisdom in that statement that backdoors the Holy Grail, because what he's saying is that there's this much upside, there's downside to zero, but it's you cutting the middle and managing the downside to the upside. You don't need infinity. You just need more upside than downside. And you need to be able to do it enough times to get to your goal. And the upside is going to set as the pace car, and that's going to set tell you where you need the downside to be. The percentage of winning, the average gain, and the percentage of times that average gain is going to come to fruition. Once you get an idea of that, you don't even have to know exactly. If you have a good idea that I'm going to have 10, 12% on the upside, and I'm going to write 40 or 50%, the downside is a mathematical calculation now. There's an optimal number. It just becomes a simple mathematical calculation. Now you take that risk factor and you back into trades. You back into trades that fit that risk profile. That's the whole thing. That's the whole thing in a nutshell. Those who understand that and are able to crystallize that and to put that into practice, like Mark Ritchie has, become very, very wealthy from this process. Those who don't end up usually giving more money to the market.
Questions, Mark, just not on a page number, but I have had a number of people who are with full-time jobs, not able to look at the market and watch the market throughout the day. And even people from, Australia and such, where they would be sleeping when the market's open. What would be your recommendation for them as far as placing stop loss orders with brokers, buy stop limit orders to make sure they're not chasing gaps and things like that?
You're just going to have to use the technology to be able to, Mark, do you have any suggestions for that? I think you know more about the platform and the parameters. I'm sitting in front of the screen, and so are you all day, and we don't have that issue. But I don't know. Do you have any suggestions for that?
Yeah, I would say, for starters, you probably want to focus on a little less activity in general, right? Because you're not sitting there in front of things. So I would say that tends to be a little bit more lending itself to swing trading, or even swing trading and then playing names for a bigger move versus the shorter term trading and that type of thing. But I would use some type of stop limit in terms of for entries, not for exits. I wouldn't do that. But if I wasn't going to be around and I wanted to make sure I'm filled within 1% of a pivot, I would have it triggered and then only fill up to the point I want to. That way, if it gaps above me or through me, I'm not breaking discipline. As far as getting out, I would not use stop limits because I want out. So yeah, I will take
right back. I gotta go for 1 second. You guys continue.
I'll take the slippage on an exit to ensure that I'm out, but on an entry, I would be a little more stringent.
Yeah, I think that question actually was asked by more than one person. So when stops are triggered, guys, you want to be out. And if you have a limit order where you're saying I want to sell, if it triggers this price, but only to this amount, what happens if the stock blows right past it and just goes down, 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 down? The quick or the old cliche is your best loss is the quickest loss, right, Mark? or your first loss, and getting out and recovering and being able to get back to focus on that is going to save you way more time and energy than the idea that you may be trying to save what is just a few difference of sometimes pennies that prevent you from being able to get out, even if it's more than 10%. It's one trade out of what might be hundreds or thousands of trades. As Mark mentioned, in his 40-year career, it does not happen all that often, but when it happens, of course, it's going to sting, but it's just one trade out of many, many, many that you'll be experiencing. Let's see if I can get a couple questions that won't be page specific, so without Mark there. Bear with me. I got to get to a different list here. Can Mark Ritchie discuss having his specific techniques for re-entering all or part of positions when he is jockeying for a position and reduced either on a squad or closed below the 20-period moving average? That's the detail I always struggle with, where reducing risk, the worst case often is the right move, but lack the ability to re-enter or add back to the reduced portion when the original stop was never hit.
Good question, and there's nothing different than we just presented. Meaning, so I'm looking for some type of, failure reset, like we discussed, or, an improvement in the pivot, like Mark's ALNY is a good example from today. The stock squats, you can decide to sell it. You don't have to if these are the decisions you generally want to make beforehand as well, guys. So that removing those degrees of freedom on the fly will, in my opinion, will help you make better decisions in real time. But there are plenty of times if you're going to be jockeying for position and I decide to cut a name, it might turn around. And this is the whole point of the Hardaway crossover. Sometimes the name leaves you in the dust. There's not always, a re-entry possible. The key is to have a plan, to know what you want to see in order to get back in. So sometimes I might step aside. Let's say the name just pokes its head out and then pulls right back into the range. And I don't like the way say the action in that stock and other trading, I might cut part of the position, but then set an alarm at that high saying I'm going to re-enter the position if things turn back around, or I want to be alerted to the possibility of re-entering the position. So that's kind of how I do things, but I'm always looking is there a plan for re-entry? And in most instances, if I'm cutting something off before a stop, it's always either because the train didn't come in on schedule, so to speak, or my overall trading is not going very well.
Real quick too, I always say you can't kiss all the girls. There's going to be a lot the stocks that take off and blast off, and a lot more stocks are going to go up and make big gains without giving you buy points. But again, that's the upside. The downside is what you got to concern yourself with. You got to put yourself in that position to have that happen on occasion. But the downside is what you have to be concerned with, not the upside.
On that note, I'm going to grab some lunch here.
Go right ahead.
This is a question that also was asked a few times in markets, a concept that I will admit and acknowledge took me years from tutelage from Mark to understand. And now that I get it, it's so obvious, but I know a lot of people may be struggling with understanding the benefit of selling into strength. And Mark Ritchie, who just stepped out, made a comment back on page 379 during the presentation.
Yeah.
And the question was, what does the benefit of the equity curve smoothing do for you? Because the example here was you were selling into that, gap or move up into the 24-25 area. And Mark Ritchie made a comment, he would be selling into probably that 22. The first gap
on the right slide. First of all, there's no 24-25. What are you talking about?
379.
Okay, I was going to say we're definitely on the right slide here.
Yeah, you're right about that.
Hold on, 379.
Yep.
Yeah. So go ahead.
So Mark Ritchie made the comment that he would be selling into that gap up around 22. And the comment was the person's asking why, and it did continue higher to 25, and why not just let it see if it could go higher and then have it your backstop it at 22 at that point? What would be the difference or the benefit of selling into that strength at 22 instead of waiting for it to come back to 22?
You don't have the benefit of hindsight. You don't know it's going to go up the next day, first of all.
Right.
It's easy to say now that you see what it did. So I don't understand. I don't understand the question of the comment.
Yeah, it's
getting climactic. So we're getting out when the getting's good. You don't know when it's going to break. So you've gotten the 8 out of 9 days up. You got a gap or two. You got the largest uptake. Okay, you didn't have maybe you didn't have the widest spread at that point, but it was up. It was accelerating. So and I wouldn't even sell all of it necessarily. This is where you start scaling out. As it goes up, you scale out, and then you maybe backstop the rest, or you sell part of it. So you certainly could, do a partial, but you don't have the benefit of hindsight. And it's not about getting perfect, of getting out at that exact high. It's about making more than you risk. You guys got to understand that this getting the highs, getting the lows, getting it perfect, that's not what it's about. It's about the general vicinity of where the stock is now. The risk outweighs the reward. And now the risk of it coming in and giving back all your profit, like this stock came back in, from 25 or so back down to 18 change. is increasing, and you've accomplished your goal. You've accomplished your goal. Look, if you want to play for a bigger move, you can put a backstop and you can hold it. You don't have to sell it. It's all based on your plan and what your goal is. You have to have a goal and a plan. Some people they want to trade their way to the big return and minimize that drawdown, so they're selling at the strength and taking the short-term moves. There's other people that want to have a more passive style, and they're going for the bigger moves. Well, you're going to have a lot of times where you're going to give back profits, and you're going to have to go through that to get to that. Everything has a price. It all has a price, but you have to keep your eye on the not just the prize, but the process and the goal. What is your goal? Your goal is to make more than you risk and to do it as many times as you can. It wouldn't matter. Let's just say I bought the stock right here and sold it 2-3 days later. If I can do this X amount, if I can cut off the downside in relation to this upside, right? This little tiny microcosm of all this price action. This is where I operate. This is my whole operation, is in these little short-term moves. Well, if I can reliably get this on average, let's just call it 10%, and I can keep the downside to 5%, and I can do it 50, 40, or 50% of the time, I make a fortune. See, because that's what it's about. It's not about looking back and saying, oh, well, I want to sell at that high or buy at this low. And that's what people get into. Everybody wants to buy Facebook now at the low. They want to bottom fish to Facebook. They look at how high it was. Oh my God, it's down 75%. How much lower can it go? 100%.
Mark, I think we did.
I know I'm going on a tangent, and I know I'm going off things here, but I want to make sure I keep you on what's important. But go ahead.
Yeah, I think we did a study that showed for the trailing stop, it was something along the lines of 10 to 25% is what you give back of that profit that would have been taken had you just taken it, into the strength originally. So you may want to do your own study to see, as you learn better how to sell into strength, how much are you giving back when you do that trailing stop? Because by definition, it has to be lower.
But it goes even more beyond that. There's things that, again, my karate teacher used to tell me when I started thinking I got it down, and he'd say, I taught you everything you know, but not everything I know. So there's more to it. All right. There's even more to it, because when you have a situation like this, all right, and let's just say you're using a moving average, right? All right, let's do this. Okay. So now here's the moving average. All right. Here's the moving average. All right. And now you use a trailing stop. You use the moving average. Well, over here, the distance is from here to here, right? You've got this distance, right? So that's your give back. But when you accelerate and you have these accelerated moves, well, now look what happens. Look at the distance between the moving average, because the price accelerates way away from your trailing stop. And now, in order to get that sell signal, you've got to give back a giant portion. So what Bob is trying to say is that when you sell into strength, what you save, okay, by the time, if you use a trailing stop or you let the stock go to a point where it's obvious, it has to break so much that you give back so much, it's not worth it. The other thing too is that when they like a plane that goes straight up, or a rocket, then it when it stalls, it comes straight down. These stocks, when they get up like this and they get so extended, and you got all these sell rules start kicking in, they break hard and fast. This is when they can come in super, super fast. So these are all the elements that have to be taken in consideration. But you'd be better off if you just trust me and you put this stuff, that you'd be better off than trying to figure it all out. I figured it all out, and O'Neill figured it all out. And guys like Mark Ritchie came in and said, you know what, instead of me trying to rebuild this whole thing, maybe I'll just do what Minervini's doing and then learn it and get some expertise and then start, and then what happened, Mark? After you did it for so long, you realized you didn't have to figure anything else out new, right?
No, the wheel was still working just fine. Put it that way.
The wheel was, the round wheel, was the best wheel. There was no other way to make a circle. So again, and then what'll happen is, once you get to the point where you've got the expertise using these techniques, the subtleties that I'm talking about, you will start to experience yourself, and you'll know all these things. because one thing that you can't do is you can't force experience. No matter how much I give you, I could give this could be 10,000 pages, and we could do this for the next 3 months every day. And you will never get to my level in that amount of time. It's impossible because I have 40 years of experience. Okay.
You hear me? The potato chips. Sorry.
You're on, your mic is on.
Turn the camera off, not the mic.
Yes, I know. It's like the time we were at the live event in person, and I went to the bathroom and left the mic on, and everybody heard everything. And I came back in, everybody was laughing. We actually did that a couple times. Bob did it once.
Yeah, I was first.
You were the first one to do it. So you will learn all these things over time, but in the beginning, there's certain things that you're just going to have to use some guidelines and get there and put in the time. That's why if you don't build proximity to your goal, mental proximity, as you're utilizing these techniques and strategies. And if you're not doing well, realize that you are getting closer. You're getting closer to being proficient at this, even though it may not feel it, and you're going backwards, and you're losing money, and things aren't working, and it's 2 years go by, and I can't seem to make this work. It's the guy who says, you know what, 2 years have gone by, I must be getting closer because I've got all this time, I've got this knowledge under my belt, versus the person who says, I just wasted 2 years of my life. That's how everybody always asks me, how did you make it through those 6 years where you didn't make any money? Because after the first year, I said, wow, I got a year under my belt, I must be getting close. Then 2 years went by, and I went, well, I'm a year closer, so it's got to be right around the corner. At 3 years and 4 years, I went, man, it's got to be any day now. The longer it went, the more I felt I was closer, as opposed to saying, oh my God, I just wasted 6 years of my life. This doesn't work. Why am I doing this? Pounding my head against the wall. That's the way a loser thinks. A winner builds proximity to their goal. They stay the course. They make a commitment, and they keep going. And they're tenacious to get to that goal, but building mental proximity. So my point is, and I know I'm going way off here, but because these rules, there's a lot of things that you can't see, that you don't understand, that you may think you understand. It may seem obvious, but you don't until you get in there and you make these trades. You got to make trades. You want to play the piano? I played the drums for 50. I started playing the drums when I was 6 years old. I'm 57 now. I've been playing the drums for 50 years. You know what? You got to play the drums. You got to go in there. I had to go in there and play the drums, and play and make mistakes and learn. And over the years, that experience, you can't force it. You just can't force. You have the best instructor. You have got the best. You could have sheet music in front of you. You can have the best band. Doesn't matter. You can't force the experience. Get in there and make trades with real money, and make the trades. And that's how you'll learn, and you'll get these answers.
I'll just add too, Mark, I think, because one of the things I remember taking away, it's in my first notebook somewhere. And for those of you guys who want to, here's a stack of some of those notebooks right there. But of old workbooks. Mark said most traders overestimate what they can do in 2 years and underestimate what they can do in 10. And I put that in my books. Like, this isn't a 1-2 year, ride. I'm
5-10.
Yeah, and that has definitely been true. I thought I was going to make $1 million the first year or two. It took me longer. But if you'd told me then, that I'd be where I am now, I would have said, yeah, I think I'll take it. But the idea was you had to have a longer term perspective, in mind, and expertise. I continue to get better at this. People, how long did it take you to figure it out? I usually answer, I'm still figuring it out. I feel like I'm getting better all the time. So viewing it as a process, not that you're going to hit your destination in, a few months after this program or whatever.
Yeah. And I definitely I'm never going to peak. Like, I'm never going to be where I'm the best I can be at this. This is like a golf game. You're never going to shoot an 18. You're always striving for a better score and to get better at this. But the difference between me and the average guy is that I make smaller mistakes. And my expertise is my good stuff is better, and my bad stuff is less, and I'm able to manage it in a way, but it's still imperfect. I am not perfect at all at this. I make all kinds of mistakes, and I'm still learning every day. Everybody is.
Mark, I don't know if you're able to pull up your charts again, but ADM on the intraday setting up a real just right now as we
It
speak.
just
right
went,
now.
oh, it just went into new highs here. That's good. Good. Once
But
again,
look-
we're erasing some of my
But look
luck
on the
in middle of
intraday, on
it.
the 5 minute, you'll see a setup that,
Yeah, I'm not really set up for that right now though, but,
Yeah.
but
if
I
you're
see
looking
it.
at
I see it
ADM
came
on a
out
5 minute
it's a little,
chart.
I have it on my other, on my, order entry screen. I can see it's a little mini VCP. It's coming out of right now.
Yep. And also even
Classic Bob, always pointing those out.
I
that's
know.
that's how I do it. So I'm working off of the daily chart, stocks that we have a swing trade on based on a daily chart. And now you're just looking for that incremental opportunity to trade around that core with these types of setups. And you're on that type of mini VCP on intraday, you're talking about,
There it is.
20 cents of risk.
There it is.
20 cents of risk. You
There's
could
the
get
chart
an
here. So
extra.
we're at the high of the day here. Can you see that?
Yeah, we do.
We're at the high of the day. So this is acting really well. And what Bob's talking about is right here. Here's this little mini VCP. See how even on the 5 minute, look here. You have your little cup with candle right here. Here's a VCP breakout. Okay, comes back. Natural reaction, right? Tightens up. Low cheat or cheat, whatever you want to call it. Handle. Look at quick breakout. Now, same thing. Go through VCP breakout. You think it's a coincidence? You think it's a coincidence that the price action forms the same pattern over and over? The volume dries up and at the same areas, it expands. The advances are strong coming out of those areas. Weekly, monthly, daily charts, intraday charts. You think that's a coincidence? After millions of charts, I've seen this. Millions. I've done hundreds of thousands of trades. This
Look
is
up
it.
Monster, Mark. Also, Monster, same idea. We have a stock on a trade, on a
Right.
swing trade based on a
Right.
daily chart
It came out a little. Here's the little cheat area right here. Come out.
this morning.
Natural
Now
reaction
you're-
here. You're even
now
getting
you're
a
setting
little.
up-
You're even getting a little failure reset. Came out here. Now it came in, and you get the failure reset, and there you go. There's a little pause pivot. Like if this was a daily, you'd be buying it right here. Now that the question that will be asked is, well, can we buy this here on intraday? Sure, but the move might be $1. It might be 50 cents. Everything's going to be way compressed now, so you have to realize that.
But I know plenty of folks who come to the programs and trade, and Bob being one of them. Bob will Skype me, hey, did you see the little 5 minute VCP? It's like, no, Bob, I'm not looking at the 5 minute, but they're everywhere. They're everywhere.
Mm-hmm.
And then and this is, keep in mind, guys, the Nasdaq's down a full percentage point today. The market's down, and our stocks that we're looking at are up, completely ignoring the market. And even though the market is getting a little rally here right now in the last 5 minutes or so, but that just shows
This is
you
exactly what I said. Remember, I said we might get a later day rally, and then the stocks that broke out will pull in a little bit, but won't stop you out, and then they'll strengthen into the end of the day. It's exactly what's happening. So we'll see how we end the day here. But again, this has to be put into perspective. If we're assuming this is the daily, then this is the weekly. So we have to see what are we in a late stage base? Are we extended? So this could be coming from an extended period, and then we go back to those sell rules. Where is it a breakaway move, or is it an exhaustion move? So it still has to be put into perspective. If you're going to trade on the daily has to be put into perspective with the weekly and the longer term. Just remember this. Here's the general rule. And I should put this. I had this in the workbook before, I think, somewhere. But your current chart is only as good, a shorter term time frame is only as good as where it resides within the longer term time frame. All right, if you're intraday, it's only as good as where it resides within the daily, and the daily is only as good as where it resides in the weekly, and the weekly is only as good as it resides in the monthly, and so forth. Why? Because if we're in a downtrend, well then sideways action and line of least resistance is going to be on the downside. It's going to be on the downside. If we're in an uptrend, line of least resistance could be on the upside, because in a downtrend, we now have big institutions are selling. There's distribution. See, we're requiring the wind to be in the sails. The whole idea of the supply not coming to market and weeding out the shorter term players and the weak hands is because we're making that assessment that there are big players that have an appetite. And that's what creates the supply demand imbalance. On the flip side, when you get that no supply, well, the supply demand imbalance is on the supply side. You're in a downtrend. The big money is selling. So you create the line of least resistance is to the downside. And now you'll be looking to short. So it has to be put into perspective. And that's why I started the whole workshop off with reference points. We have to have reference points and a chronology to this, that you have to understand where you're coming from and have those qualifiers, because this doesn't work if it's not put in the right context and stacked in the right direction with all the probabilities all stacking on top of each other. When you get it all right, though, when you're in the right environment, it is magical. That's all I can tell you. Absolutely magical.
That does lead to a question with the intraday stuff, but a question
Back to the
was,
workbook, or are we going to stay on these charts here? We got questions on the
just a
chart.
general question. Do you trade in the first 30 minutes or 60 minutes? Some people say
I
to
do.
wait.
Yes, I do. I don't wait. First, couple minutes, if something just comes ripping out in the first 10, 15 seconds, I pause usually, and I see if that's a quick, if they're just taking it out on low share. Sometimes they just run it up a couple hundred shares right on the open. I take a little pause, but no, I'm buying the stocks when they break out. I'm letting the chart dictate, not the time in the morning.
Question being asked: any other tools one might need besides Marcus Smith for screening to complement trading your strategy?
Just some a quote system, and real-time charts, and Marcus Smith I use for just screening, and that's pretty much all you need. I mean, you want to get something for earnings reports like a briefing.com or some of, a product like that for checking news. But you don't, it's like the beautiful thing about trading. It's just like poker. There's a saying, all you need is a chip and a chair. And then guess what? Then it's up to you. It's up to your talent. Just like baseball. All you need is a bat and a glove. And then it's all based on how well the operator, how well you swing that bat and catch the ball and throw the ball. In bowling, you need a bowling ball. That's it. A bowling ball. You show up, it's up to you now. Boxing. Two guys put on boxing gloves. Best one wins. That's what this is about. You don't need a whole lot. It's down to you. It's down to the skill. It's not, there are no programs. There's no indicators that are going to make you rich. It's you knowing that indicator. And if you're going to use stochastics, great. Then I'll tell you what my father used to say. My father used to say, I don't care what you do. Whatever you do, though, just be the best at it. Do the best you can. Whatever it's going to be. But go all in. Don't pussyfoot around. Go all in on it and be your best at it. So that's it. I picked this particular style, stayed with it for 40 years, and became an expert in something. That's what I advise you to do. Pick something. It doesn't have to be this. It could be something else, but pick something, because you're not going to be good at everything. And there are no magic formulas or indicators. It's going to come down to real work. If that was the case, everybody would be worth tens and hundreds of millions of dollars. Everybody would be like Mark Minervini and be able to make all this money from trading stocks. But that's not the case. Very few people can, because it's a game of skill where a lot of money goes from a lot of people to a small group that are skillful, just like in baseball. How many pitchers get tens of millions of dollars of contracts and quarterbacks and it's the same principle anywhere. There's a small handful of elite performers that get it and commit to it and become great. Got to give yourself the time to become great. You got
Question being asked.
You got the tools. Now, do you have the wherewithal? That's the question. Do you have the willingness? Do you have the discipline? Do you have the commitment? Do you have the wherewithal? Do you have the ability or the willingness to commit and to stay the course? You have the tools. I promise you, I gave you everything you need.
Question being asked to Mark Ritchie if he had any special strategies on incorporating all the content you learned from the Master Trader program yourself, and just making a comment he assumes it took some time for all these strategies to show up in your trading results.
Sorry here, chewing a little bit.
Not really, seeing as you won the triple digit challenge in the
In
first
6
6
months.
months. Didn't
That's
take
nice.
very long for Mark Ritchie.
Let me put in a few caveats. Well, the first thing I did, first of all, I think that you phrased it strategies, Bob, or something like that. So I went home and just started screening right away. I actually never screened a stock before coming to the First Master Trader program. I didn't know anything about it. In fact, the service, the MPA and all that this was all kind of coming out new at the same time, So talk about those of you guys who feel like you're drinking from a fire hose. I felt the same way. I think I even got the screens I'm using now. I think I got from somebody else who was attending, because we didn't even have a section, Mark, remember, where we went over the screening process. It was just sort of some general guidelines, stay away from stage 3s and 4s.
Right.
You guys are getting more now than
I think the workbook was like 180 pages. Now it's 530.
Yeah.
There's a lot more meat on the bone for sure.
Yeah.
We definitely did not share any Mark's screens in his first few years.
No.
And long story short, I just started screening and looking for the pivots, and I had already been swing trading, and this style, I would say, fits my personality. There's no question about that. There were some things that were definitely intuitively easier for me, as I've tried to teach this to other folks on the platform, whatever, realizing you get a lot of the same questions that people just have a harder time grappling with some of these ideas. But for me, I would say the biggest thing was just refining your eye. I look back at some of my old stuff. I was like, that was sloppy. This was sloppy. Just getting more and more refined in how you see things, catching more little nuances in the charts. And then, look, I went to every weekly Q&A session for, I don't know, 5-10 years, asking questions just like everybody else. After a while, I didn't ask many questions because, then I'm just trying to provoke Mark to get on tangents, because you could still pick up lots of good gold nuggets in terms of what does it take to be successful? How do you think about this situation? How do you think about that situation? Mine has always been too, if I'm in the right frame of mind, I'm going to make good decisions. And so if I'm thinking about things correctly, I'm a big believer in, from right thought comes right behavior. So that's really what these last 2 weekends to me are really all about, teaching you how to think about these things and dispelling some of this nonsense you hear out there in regards to, you want to trade volatility or widen stops and, averaging down, all that kind of stuff. And then the other thing I would just add, though, one thing, as the account grew, trading size definitely took some learning, because initially, I would just buy it all in one hop, where you could turn your whole position over really quickly. That definitely took some getting used to and learning how to do that properly as well.
Yeah. So with regard to the charting, it takes time, and it's all right here in front of you. And again, I would caution you to, as Mark is saying, to narrow it down and try to insulate yourself from the noise. That's our goal here, is to show you what you need to focus on and how you need to think, and then it's up to you, to spend the time putting it into practice and gaining the experience.
I will add one other thing too that I've always encouraged people is to, I've never been a journaler, mainly because I have a really strong, I just have a memory, where I can remember certain things. But I think most folks that I've seen that have been successful at any type of trading, every now and again, they sort of have these aha moments, and the golden nuggets really, I think, are designed to sort of pull those out of the material, but you'll have them in your own trading. And so there've been a few where, everything just lined up and you saw things, work out right. And I feel like you just kind of have to go through some of those to say, you know what, when I see this again, and the reason we tell the COVID story, I've seen lots of waves of setups, never one where I thought the world was going to come down to an end.
Yeah.
And, I just know if we ever get into a period again where people are that skeptical, scared, pessimistic, and the stocks are setting up, if I could be even more aggressive, I'm going to be even more aggressive. So the longer you do this, it will just increase your confidence. And every now and again, you have one of these moments where you go, now I get it. Now I see it. So just encourage you to write those down as they come.
And the only reason why I probably was able to tell Mark Ritchie in the first couple months of the rally off the COVID bear market that we're going to buy the stocks is because I had seen the potential world coming to an end. Not that was completely different. I have to say that was more scary than probably anything that I've ever seen. Although 9/11 was pretty scary when it was happening, and the '87 crash, but I wasn't really involved as heavily as I am or was later. But I went through the '87 crash. I went through the bear market in 1990. I went through the 2000 bear market for years. That was 3 years long, and the World Trade Center coming down, and the 2008-9, financial subprime debacle and financial system collapse. I had gone through a bunch of those, so I started to learn that the market discounts this stuff, and that I gotta let the head, not the tail, lead me here. Otherwise, I probably wouldn't have bought any stocks, and I would let my emotions over. So, I had to trust my experience. And before you can trust your experience, I guess you got to trust somebody else to a certain degree. And that sort of bridges you to get your own experience. But you're probably sometimes going to be where, even though I told you all these rules and Mark Ritchie told you all these rules, and you know everything, you might not do it just because you haven't seen it enough times and you're scared to death. And then you'll see over time, you'll see what works, what doesn't. And then if you stick with it long enough, the truth will rise to the top. The cream rises to the top.
Something else I meant to
anything
add.
on the workbook, because I know we keep
Yeah,
getting off the
going
workbook. But
a lot of questions
yeah, I'm sure.
put in there, very journalistic.
Problem is, when we're doing this, we get hundreds and hundreds, sometimes over 1,000 questions, and Bob sort of tries to bounce around and get questions not answer the same thing over and over. And there's a lot of questions to field. We certainly can't answer them all, but try to get all the relevant topics.
One of the things, though, when you were stepped away for a moment, Mark, that Mark Ritchie was answering the question of sort of how to manage a trade, essentially. And one point I wanted to just emphasize was, if you listen, Mark and Mark both have a plan of not only getting into the trade, but they also are visualizing all the scenarios that can happen once you're in the trade. So what if the stock continues going up? What if the stock starts pulling back? They already have an idea of what they're going to do in certain circumstances, no differently than playing sports. If a second baseman knows the ball's going to be hit to him, there's a runner on first, he knows he's going to go to second, or whatever might be the case. They're already pre-thinking through, visualizing exactly the scenarios that can happen. So nothing surprises them. And that's something I think
but
is
again,
helpful.
Yeah, I think you still got to be careful what you say, Bob, because that almost infers that we've got targets, and I can be very surprised. But I have a response. What Bob is saying, that I have contingency plans and a response for everything. For instance, if I'm surprised with a giant, this stock gaps up huge on me, or takes off right now on news, I know if it's up real big and it's extended, I'm going to probably dump some right into strength. I have a pretty good idea of what I'm going to do. It may not be an exact plan, and know if this stock goes to 110, I'm out. I don't have those hard fixed rules like that, except on the downside, on the risk. But yeah, as Bob is saying, we in our mind's eye, we're pretty prepared for just about any eventuality, and that's in the contingency planning. Like I pointed out, we ended the day 4 with some closing remarks, and I talked about contingency planning. First of all, your first plan is you got to have a criteria to buy and to minimize your loss. From there, selling at a profit, selling at a loss, selling at a profit into strength, and selling at a profit into weakness, and then a disaster plan based on your system, and whether it goes down, you get locked out of your brokerage firm, then it goes to that plan. So all those things, and you, like I said, then you get a full playbook, that you can handle just about any situation. Like, you're in a 757, flying. The pilot, they have protocols. If an engine goes out, there's protocols. If they don't know, they radio to the tower. They tell them what to do. There's protocols based on experience in building this playbook. And if something happens that they don't have a counter move for, they add it to the playbook. So you got to build your playbook, and that takes time.
Question being asked, if Mark, Teresa's asking, she knows that you don't like cyclicals, oil and gas and energy, but if the market in 3 to 6 months turns out that is what is moving the most, like it has been for the last 3 to 6 months,
Yeah.
what from history would that tell you? Not sure.
Well, tell me that we're in a period where, those stocks are in favor for whatever reason. And if, and again, if we see a whole bunch of setups here, and they start meeting the criteria, I'm going to probably take a few, not going to completely ignore them. I'm not going to fight with the market because I don't know. History says that these cycles move in 8-year cycles. I pointed this out in a note that I put out to our members. We're in a couple years into a potential 8-year cycle. So we still could have a long way to go on oil names and energy names, things like that. Deep cyclicals like papers and steels and so forth. I mean, they'll probably have a shorter lifespan and move with the economy. But I'm going to dig in and not bend a little bit. And so maybe I take smaller positions and have smaller exposure. And I don't, for this next cycle, I don't make as big of a return as I normally make. That's okay. It's all right. There'll be that, as long as I protect myself on the downside and I'm making money and doing well in the market. And I'll have periods where I do really well, periods where I do only okay, and periods where I don't do so good. But over the long term, that's how I've amassed my performance. And Mark too. Mark had a few drawdowns early on, some pretty decent drawdowns off the high. He had to learn, and if you look at his performance as he's gone on in the years, the drawdowns have gotten less and less. But he's managed to have an amazing track record over a 13-year period.
Question, Vanna is asking sort of kind of a paraphrase it, but basically she's asking why you're buying Monster with EPS, earnings per share, declining. Would this be an example of differential disclosure?
Let's bring it up first of all. So let's see here. I'm going to just widen this out here. So a few things. Well, first of all, yes, it is. I would say that's a good to point out differential disclosure. Okay, so the earnings are negative in the last 3 quarters, but the stock is hitting, I believe, near an all-time high. Right? That's just, again, this damn thing drives me nuts. Hold on, I got to move this Zoom bar. Okay, let's bring up a monthly. So we're up around all-time highs here. Look at the market. There's the market, the stock, and I'm going to go to a weekly now. So the relative strength line during this correction here, stock is acting pretty good here. And then I look here, and I see all this, these earnings where they peaked over here, and they started slowing down. And you got between 2020 and 2022, you went up a little bit, and then you came back to that 230. You're basically in that 230 range. And now you're looking like this next year, you got a breakout year where that'll actually be the biggest earnings, annual earnings. And these estimates are probably conservative. That number, if they execute properly, that number will probably be bigger. We talked about that, how the estimates are conservative. This is probably a conservative number. The stock is telling you that it's acting really well. So I think we're trading on future earnings here, looking at the estimates. And the bottom line is, yeah, the stock is acting really good in the bear market. The problem is we don't really have much of an uptrend. So if we get it right, maybe we got it a bit early here. I mean, okay, so you said the negative number. I want to show you one thing that sticks out like a sore thumb, right? So you're looking at the number. Remember I said the number don't trust the number, trust the response to the number. Look at here. See right there? That's when they reported earnings. Look at the response to the earnings. The stock has got its biggest up move since it's turned into an uptrend here on that minus 5%. Well, that minus 5% obviously was a pretty damn good number. Had to be. There's no way the stock is going to go up on this giant volume. Let's even look at the weekly. Look at the weekly here. Big weekly move up. And look at this. 1, 2, you got 2 tight bars, 3 pretty tight bars. No variance. Like it's held that move. It's not like it popped up on retail money and then came selling off. It's holding up. And now it's breaking out here. So the stock is telling you that this future number is what it's trading on. And now we've got to see if these numbers start to come in. Future earnings reports are going to be really important because this is obviously trading on the future. It's all stocks are always trading on the future. All right. But sometimes the earnings are on the table and sometimes the earnings are on the table. You've got the earnings and it would be just the opposite. As I pointed out, we saw Crocs come up with 155% and the stock was down 15% that day. So again, you're going to look at the number and go, why are you selling that stock? The earnings came out 150. Let's reverse what you said. Why are you selling the stock? The earnings came out 155% because the stock's down 15%. Same thing in reverse here. So that's the reason why. Now, I could be wrong. This might not work. But again, if I put myself in this position 100 times, 1,000 times, and I manage the downside in relation, I'm going to come out a winner. These trades are going to deliver more on the upside than I'm allowing on the downside. And that's all that matters. Whatever earnings they come out, whatever, it's the response. It's how the stock is acting. Now, I'd love to get it all. I'd love to have big earnings and have the big response. Those are the ones that usually give you your bigger moves and the sustainable moves when you have it all on the table. And this might happen at a higher level. This stock might be just starting to get into that strong stage 2 uptrend. And 6 months from now, 2 quarters, 3 quarters from now, we've got big earnings in the current quarter and the stock is coming out of another base. It's coming out of a second stage base now. And I'm buying it there. And that's actually a better trade at a higher level. You see, not the lowest price, the right price.
Question is being asked because of the bear market circumstances with the downtrending market. Would you look at the 3-month relative strength rating on MarketSmith versus a 12-month because that will be showing you more of the stocks that have been performing well in the last few months?
No, I wouldn't. But if you want to see what's performed well, like during a correction versus that time period, like sometimes in a shorter term pullback, the market's down 6 or 8 weeks, or in a bull market and the market's pulled back for 6 or 8 weeks, I'll run a 6-week RS. I'll run an 8-week RS to match the time frame. You could do that. You could just say what stocks from that point do a rate of change. So what's the rate of change? And then sort it by the biggest to the smallest from a particular date. So let's just say you're going to measure it from where the market topped. And let's say that's 3 months. Well, if you ran the 3-month, then you would see the stocks that are the strongest during that period. Yeah, you can do that. I think that's good thinking. That's a very good way to think about it. But I have found that I don't need to do that. The relative strength rating is fine. And also, just so you know, the relative strength ranking in IBD, the 3 months is 40% of the ranking. So it is weighted already towards the most recent 3 months. Can't hear you.
Thank you. There was a question earlier this morning if you could pull up end phase, which was asking, Jason was asking, with it very close to our stop, would you just sell the position? And you can see now exactly why we don't do that.
It's coming back now. Yeah, I'll bring up a current chart of it here. ENPH. So it did come down, but see, it's getting a pretty good so far. If it closes here, this is great action. This is exactly what you want to see. See, again, while those who get stopped out and those who are undisciplined and those who are in there creating the noise, we being one of them at times, while they're in there getting whipped around, they are forming the basis of your success as they're getting that process of weeding out the towel, getting squeezed and the water coming out. This is just another iteration here. And if we can tighten from here, this stock is proving that it's going through a very nice natural changing of hands of from of weak hands into strong hands, and this stock could be set up in short order here. But you got to be real careful about, if you're going to get in there and trade, if you start trying to trade every little blip, you're going to be in and out, and you're going to be losing money because you're going to just get whipped to death. You've got to have a cutoff. Now, yes, you can trade really short term if you want, but then you've got to truncate everything. You've got to, your gains got to be, you've got to adjust for all that. And you're going to have a lower success rate. You're going to get stopped out a lot more times. So it's all maintaining it's all adjusting and maintaining that risk reward relationship. So if you want to sell it here, you could sell it. But when it gets really close to the stop, that's the time where I'm not going to sell it, because if I put a 6% stop and it's down 5, why would I sell? I get 1 more percent to know if I'm right or wrong. I might have told this story before, but good friend of mine who was one of my very first assistants back in the 1990s, we bought Stryker. We bought it on the same day. He used to sit right across from me. Our desks were right next to each other. I bought Stryker. He bought it. Stock took off. And anyway, stock came back and came right down within 1/8 of a point. Back then we traded in eighths, came within 1/8 of our stop. It was like an 8% stop. He said, I'm selling the stock. I said, why would you sell it? It hasn't hit our stop. He goes, it's definitely going to hit the stop. It's 1/8 away. It's 1 tick away. I said, well, you could sell the stock. I'm going to give it the 1/8. Why would I sell it now if only 1/8 more? I'm not going to lose a whole lot more. Long story short, to this day, he still talks about it. He's brought this up to me many times. The stock turned around, never hit that 1/8, and went up and tripled from there. And I made a double on it. So, again, now the caveat to that is it's at the end of the day, right? And the stock is going to close right near your stop. Now you're taking the overnight risk because you're so close to your stop that the next day, if it gaps down, let's say it gaps down 3% the next day, now you're going to get 2% of slippage. So that would be a time where you might, if it gets close and you don't want to take that overnight risk, you've got to understand that now I just increased my overnight risk because now it's closer to my stop and a gap will give me more slippage. So see, there is a little caveat to that. So your thinking is not completely off. It just has to be put into perspective.
I still laugh when I hear that story. I've heard that story for decades. On page 488, if you want to go back to the book.
Those of you who heard the story about the throwing the money out the window, and the friend of mine that was in the car and refused to throw the money out the window with me is the same guy, by the way.
Yeah, I was going to say.
It's the same guy. Yep. And I told that story again. I'm not going to tell the story. Maybe at some point, if you guys want to know, there's a link. Someone did a story on it. It was interesting the way they did a story on it. But my friend, he came to my house to visit me one day, and this is literally 30 plus years later. And I opened the door. I didn't see him in a lot of years. I opened the door, and he went. His very first words, he said, I should have threw the money out the window. And then he gave me a hug. I'll leave you guys hanging who don't know that story.
Before you go back to the workbook, actually, PWR, Mark.
PWR, I saw that one on the
Yeah.
weekend. It was setting up in this couple of handle type pattern. It looks pretty good. I'm trying to remember why I passed on it as far as putting it up. Yeah, it looks pretty good. It's the building heavy construction. I know Floor is doing. Is that the same group, Floor? Because Floor was broke out, and that was one I put. Yeah, Floor's number 1. There it is. So let's take a look. Whoops, sorry about that. Go back here. Floor. Yeah, that one came out. And we actually put this on focus list a couple weeks back, right over here. And that's working pretty good. So yeah, I think it looks pretty good. The PWR looks pretty good. Again, here you have your top stocks. It's the second relative strength stock in the group. So that looks fine. I think I'd want to see maybe again a good market I'd be all over a chart like this. I would already be buying it over here, right out of here. I'd been buying it coming right out here. And then if it comes out from here, I'd be adding to it. That's sort of how I would play this. You even got a little low cheat right here, but with a lot of overhead. So this is a bit low, a little bit below the 50-day. But I would definitely here as it shakes out and then breaks out right here, and you come out in the volume, you come out in the earnings right here. That's a perfect spot to start entering it. And then you get the natural reaction. It holds up. We get into new high ground, add to it. So I think you could buy this if it comes out. It got through the earnings, had a pretty decent response on earnings. And now that it's pulled back, I'd like to see it tighten up a little bit more. Optimally, this is what I'd like to see happen. I would like to see this back off a little bit and tighten up just a little, maybe even drift back a little bit, and then come out from there, maybe just a little bit more, and that would be really, really setting up perfectly. You see, right now, trades aren't working well, and we're in a bear market. So I'm going to raise the bar for the requirements, because in a good market, you get bailed out. You make mistakes, the market bails you out, right? You've got the wind in your sails. In a bad market, you do things near perfect and you get penalized. So I want to, at the risk of missing stocks moving, I'm going to make sure that they're perfect. I want really, and if they're not perfect, I'm going to position size accordingly. And I'm going to offset the risk in one way or another. But generally speaking, I want the better setups, the better plays, the highest relative strength, the real crisp entry points, the lowest risk entry points. And also, I may not play everything. I just may pass on a bunch of names just simply because I don't want to get too involved in the market right now and start shotgunning, because again, it's not working. So I don't want to get myself enamored with too many names.
PARR, another name, have not quite similar, very close to 100% move, but not quite meeting that criteria.
I'm playing this, playing ADM remember I said I was going to play this like it's the daily. I just cut half off here. So I cut half off here and sort of free rolling now, a little bit in the bank. It's rolling over here now. But again, if you're swing trading, I want to make sure I reiterate this. You wouldn't want to be selling this quickly. On the downside, if it pulls back here, you could let this squat, give it another a couple of days, a couple of weeks to see if it could reverse a recovery. Stick to your original stop in the beginning of the trade. Go ahead. I'm sorry. What did you say for the question?
PARR, another one that is not quite 100% move.
PARR. That's the yeah. So let's see. Just looking at the weekly here. And I'm going to pull it up here on the Market Smith. Whoops. Yeah. So as a power play, I guess.
Yeah, not quite 100%.
Well, it falls quite short. I mean, it's not, let's see, what percent? Yeah, it's 73%. That's not even close. If it was 98%, but that's not enough. So I would pass on that.
Question being asked: when you want to see the volume dry up in a pivot, does it matter if it's an up or down day? Does that have any influence on you?
What part of the pivot? An up down day?
Where the volume is drying up, like just before it breaks out.
No, it doesn't matter. But unchanged and having low variation and closes that are close to the previous day close is even more constructive. The least amount of variation is better. So you're just looking for, because volatility and volume means supply. That's the bottom line. Okay. When you see volatility, you see volume, supply. All right. That's what you're seeing there. Now if stock breaks out and it takes right off and there's no downside, that's alpha, that's demand. Okay. So what you're looking for is those tight variations, and that is also on the close, looking at it from the previous day. is something that is constructive, especially on the weeklies. This is what O'Neill calls 3 weeks, 4 weeks tight. There's a reason behind that, because those are the footprints of accumulation of strong money sucking up the strong hands sucking up the weak hands. So, but no, within the pivot, real tight in the pivot, would it matter here if this day right here was down? This day here, you see this day, it's on the low here. I'm still going to buy it coming out here when it takes out that high. That's not going to change it. If it was up or down, wouldn't really change it.
So curious to see what your chart looks like on TRQ. It looks like a stock that a new issue, but I have some historical data on it.
No, yeah, it's a mining stock. I see how it's showing pretty tight action here. TRQ.
That's
Yeah.
weird. Mine looks completely different from that on
Hmm.
TradeStation.
Yeah, it's trying to tighten up over here. Volume's coming down. Doesn't look too bad, but it is a mining stock. Be a little careful with it.
Okay. A lot of the questions were more for the live trading day here, not as many.
Okay, that's fine.
But let me just keep trying to
We
plow
can
through these.
stick to questions about today.
There was a question asking if you could just share a quick explanation again of the difference between a cheat and a low cheat.
Okay. Let's go. Where would that be? The page, Bob?
Yeah, the three.
The three.
One,
No. To the three.
no, it's no, it's one.
I got it.
You do.
So
Yep.
the low cheat is going to be in the bottom 1/3 of the base, and the cheat is going to be in the middle 1/3, and the handle will be in the upper 1/3. So just think about it, as the low cheat is it turns up and it has that pause, but you've got some supply to the left. When you get to the cheat, you have less supply, and you get to the handle, you have the least amount of supply or no supply if it moves into new high ground. So the difference is it's just lower in the base, and you have more supply. That's why as we go down in the base, it becomes more of an expert buy, because you have to analyze the left. You got to look left for traffic and analyze the traffic a little bit more accurately, because you've got more potential selling and more supply. So that's why the lower you go, you have more opportunity, of course, because there's obviously you're buying it lower, but you also have more supply to work through. So that's where you've got to make the determination of how deep it is, how far back it is, and that will sort of guide you whether how strong you should be playing the low cheat versus the handle or the cheat.
On page 314.
314, yeah. Let's see. Yep.
Why are you buying where you're buying? There was reduced volume leading up to that, and also much easier. What is telling you to buy at that exact moment is the question.
I don't know what that means. There was reduced volume, much easier. Where?
I guess.
Where was I supposed to buy? I mean, I guess I could have bought this, maybe started buying this right here, but it hadn't taken out this previous high. And I don't even remember, when I saw this stock. David Ryan brought me this stock. Sometimes I don't see the stock until it's set up over here. I can't remember, but this cleared everything out right here. You got where everything got cleared out, and I think I actually bought it on the next day to make sure it was following through. Because a lot of times they'll come out and then they'll come back in, like we just saw, of course, today. And end phase just happened on Friday, so I got a little follow through. So I bought it on the follow through. I bought it on that second day. That I do recall. But whether I bought it the day before or over here, either way, the outcome would have been the same, because the stock would have never hit my stop. Based on this little tight area, I definitely not selling until this comes off a bit here and at least takes out these lows here in this pivot. So you wouldn't have been knocked out either way. You have the same exact outcome.
Page 211.
Yep.
Question being, why not buy it at the box? Because you end up buying it at the same price. It just takes longer.
Okay, so first of all, you're looking in hindsight. So we don't know what would, this is with the benefit of hindsight. That's number one. Number two, this is completely, this is running right up the right side here and it's completely unsustainable. If you go back and you look at all the charts that you have in my workbook, if you go back, you look at O'Neill's, you look at, study the biggest winners where they came out of these bases, you will see very, very, very few that come out of a base that looks like this, because this is unsustainable. You still, and this defies the whole, everything I just told you over the last 4 days defies all of it. There's no time for it to go through the iterations and weed through the supply. So, and we have this big move here. So you obviously have quick profits for some people and you're running into supply. So the other thing too is, again, we're not looking for the lowest price. We're looking for the right price. So you're right. We are buying at the same price. The difference is also, well, I just saved 2 months worth of time or a month and a half worth of time. Time is money. Time is valuable. I mean, if you're buying stock here and getting the same exact result as I am here, I'm going to outperform you because all this time I could be using that money somewhere else with stocks that are moving. So, I mean, I could also use it and lose it. But the point is that it's opportunity cost. I'm tying my money up. You're tying your money up a month and a half, 2 months longer than me. I want to get to the result as quickly as possible.
You're being too generous too, Mark, in my mind. So a little role reversal here, because if you buy those red boxes,
you can drop the velvet hammer.
Well, if you buy those red boxes 1,000 times, you're a money loser.
Absolutely.
In my opinion. I mean, and
if you're using stops, if you're using tight stops,
well, if you're not losing stops, you're definitely a money loser.
Well, right, exactly.
Either
you're not
way,
losing stops, you're definitely going to be a loser anyway. So regardless of what you do.
Well, you know, to the point we've made a few times, you want to think about this. You're not going to make one trade. This is a perfect example, though. The price, in terms of the fact that it's at the same price, is purely coincidental. The reality, though, is that if you buy those correct buy points 100 times versus the red box, the return distribution will be massively different between the two.
Yeah. This is where, where a pair of eights morphs into a pair of kings.
Excuse me. Here's a good question that we haven't addressed at all. If having these setups and having the benefit of using options, which provides a guaranteed stop loss, being the purchase, the amount of your premium that you're purchasing the option, but you still have the ability to profit from breaking out of a VCP with low volatility. Your thoughts on that?
So you're saying using this strategy, but just using options. Mm-hmm. Yeah. So you could, there's a gentleman that was a friend of mine, I've known for 30 or 40 years, does precisely that. It's in Canada. It's been very successful. You certainly could. The problem with that is, or the challenge is, a few things. One, a lot of stocks don't have options. So that's number one. So you do this analysis and you find all these stocks that are setting up, especially if they're smaller mid cap. In the mega cap era, it works a lot better. When the smaller and mid caps are working, a lot of stocks don't have options, so you don't have that opportunity. And those options are sporadic, and there's not many strike prices and so forth. That's number one. Number two, when you're buying or directionally trading, which if you don't directionally trade, you're taking the risk of being at a loss right away. I want to always be trading in the direction of the trade. When you do that, you're kind of, the options defeat your goal, because the premium and the spreads, everything widens with volatility, adjust. So there's premium too. So you can get it right. You can be right on the timing, but there's a lot of premium in the option. And now it takes, the stock is not going to move in lockstep unless you're buying deep in the money. And even then, sometimes you're not completely apples to apples. You're not moving in lockstep. Sort of like an ETF. This is probably not the best example, but a triple ETF, over time doesn't move in lockstep with the market. It decouples. Well, same thing with options. There's wider spreads, there's bigger risk, and then of course the real reason is because their timing has to be absolutely impeccable. So if you go into a stock and now you happen to get it wrong, but it takes a couple weeks, while it keeps building that VCP, but it doesn't hit your stop, well, your option's worth less. You're losing money when you wouldn't be losing money in the stock. So there's a number of challenges. It doesn't mean it can't work. If you need leverage, if you want to use leverage, then that's a way to get leverage. If you didn't, you had a small amount of money and you wanted to use leverage, you could do that, but it will be challenging. It's not easy. It's making this much more difficult, and that's the bottom line.
Somebody was noting on your watch list,
Just
Mark.
real quick, sorry, I just wanted to note that you see this here. This is very similar, especially if you look at it right about here to this example here. See, I'm not doing anything different. This, if you go back and you look at what I was doing back in the 1980s, 90s, or you go back and look at Coca-Cola in 1932 or whatever, it's doing exactly what Monster Beverage looked like. They're coming out of these same bases, but you can see, take a look at this here. You're making the turn here. You've got this cheat area. Now, the only difference is over here, it didn't come out and follow through. So maybe it's going to take a little more time. Hopefully this will end up looking like this and will break out and will work. But you could see the setup to it, very, very, very similar setup in the footprint here, the VCP footprint.
Somebody made a comment that you had an R, the letter R next to your stock on deck AMPX. They were just wondering what that was for.
On deck. Which one?
AMPX. They said they
R.
see an R on the ticker in the on deck list.
Oh, okay, hold on. I'll move that over. Here's my on deck list. Where? Let's see it.
AMPX.
Right here. You mean that little thing right there?
I guess so.
That means there's an alert. It's not an R, it's an A.
Oh.
It means there's an alert set. Right there. There's a whoops, sorry. Right here. That just means there's an alert. See, there's an alert right here. This is the one that I'm watching that's tightening up here. Getting nice and tight here. You got this little cheat area forming. So that just means there's an alert.
Gotcha. ANET.
ANET. Yep.
Which actually on a 5-minute is showing a nice low cheat.
Yeah, wedging up a little bit though. It's not the greatest, but yeah. This is wedging up a little bit here. It looks okay. I mean, I like to look at it and see what it looks like over here. 90 RS. Yeah, this is kind of wedging up here. I like it. You had a good the earnings. Was that after? Yeah, it actually gapped up before earnings. It's acted well after earnings. It looks okay. Let me see the weekly. Again, a little bit laggardish, not really a strong uptrend. You can see, you flattened out. You started rolling over here, started looking a little toppy, and it's holding up during the bear market, but not really looking strong like a leader. You take a look at something like, and again, it might outperform First Solar, but when you take a look at something like First Solar, this is looking a lot stronger. See, the uptrend is more intact here. You're really outperforming the market. Just real strong relative strength line. I want to be in the more powerful situation if all things being equal.
Question about CLR. And guys, when you're looking at a stock that is like a flat as a piece of paper,
yeah, that's a takeover. That's
almost always going to be a takeover scenario.
Right. So that we're not going to bother with that.
STLD.
STLD, which is of course the steel stock.
Was that too extended? was the question this morning.
No, I wouldn't say this is a pretty good sized base. This is a deep cyclical, and I've been asking myself, do I want to buy these deep cyclicals and these steels? ATI is another one. Take a look at ATI, where it's trying to form a base here. Of course, not as looking as strong as STLD, but yeah, I mean, again, it's a matter of if I want to, if I want to start really shotgunning here and buying everything that's moving out. It looks fine. I mean, you could buy it here. Certainly could buy it here. I mean, it's coming out of a really well-formed big base. You moved up on earnings quite nicely. I am being a little careful with the cyclicals. Here I have to say.
There were two questions on
Big deceleration earnings too. Look, about 500%, 187, 98, 10. They're decelerating in the earnings here. 4 PE. When you start seeing these numbers are so dramatic, way, way, way below. And I've got this big deceleration. Now I got negative estimates for it. I mean, this is just all over the place. This just reeks of cyclical, deep cyclical. Everything's inverse. You can see how you got the estimates next year are down. PEs are 4, earnings are decelerating, the stock's breaking out. So you could say, well, trust the stock. Yeah, you could, but a lot of these cyclical moves, when they get to this point and they break out, they don't have the legs. So I am being more careful with the cyclical names at this point. I'm being careful with everything right now.
Look at that half of earnings, losing 50% year to next year. So curious, I've had a couple questions on Gilead and BIIB, and I'm not sure, guys, if you came this weekend and paid attention all weekend, how you're thinking these are entry points for.
Gilead has come up here, and it's certainly not enough to be a power play. It's just starting to turn up on the 200-day. BIIB is a little bit better. You're turned up a bit here. You can see here they just got a new CEO. That's good. The stock actually gapped on that. We got through earnings, but again, an early turn here, not enough to be a power play. So I mean, I would say you could have bought this maybe back here, coming out here, when it first formed this little BCP, or right here off that pullback buy as it started turning off the low near the danger point, and that's where I entertained entering it there. I was thinking about entering it right here, but I just decided not to. But they did get some good news over here on this gap.
Question about Mark Ritchie, but just talking about when to be adding to an existing position in conjunction with your progressive exposure. Are you doing that? Really, paraphrase the question. Are you doing that within stocks that you already own, and when would you do it, or how soon before the stock kind of moves away from you too much?
Well, any subsequent buy point. This is a good chart here to the left. This Intercept Pharma, because this is exactly how
that's why I brought it up for you.
Oh, good. Those 2 buy points stand on their own. And actually, this is an example where I bought some and then pyramided the position up. I think I might have even sold a piece of the first one and then added more on the second buy point. I can't remember exactly, but that's something I'll do from time to time too. But think of it this way: every buy has to stand by itself. So if you didn't buy the first buy point for whatever reason, and you're buying it subsequent, does this meet the criteria all by itself? And then ideally, that's exactly how I want to handle things. If the name I already own sets up, perfect. Now I'm just getting more concentrated, but it's both. It's not either or.
Yeah. Let's take a little break and give people a little time to just rest and recharge a bit here, myself included. Let's take a little break. The market seems pretty quiet here. There's nothing. It doesn't look like there's really much that I'm going to do at this point, trading wise, except the trades that I already have here. ALNY, of course, is still just drifting down. You can just, again, think of this as a daily. Look at how many days down here and all these lower lows. See that those violations gave you the tip off. It hit those violations, and the train did not come in on schedule, and that gave you the tip off. And since then, it's just been down, 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 down. And even though, and now look at the daily. Let's zoom up on this. Now we've got a full blown outside day. So now the volatility has widened here, and that's the opposite of what we want to see. Now, does that mean it's curtains? No, because it's still on this right side, and it still could tighten up here and go inside for a couple of days. And like I said, it would be perfect. So, but this could happen. This is what just happened. How I bought some here, and got knocked out. This happens all the time, and now I'm not going to take this off my list because it's still within the VCP building up that right side. But I'm going to look now for it to tighten up and reassert itself, and I want to see it improve. I want to see this tightness and this price action with the volume get even better, and then I'll be buying it again as it takes out that high, because it's still holding up nicely in that right side there. So out of that, ADM still in, took half off as it started to roll over right here. And now, I've got the option if I want to break even or finance my stop a little bit. Not really much. Yeah, the other ones. Now, DGII reversed everything. This is just par for the course. This is what's happening over and over and over and over. This theme just is been in force and just doesn't seem to be abating anytime soon. So again, this is why I'm being cautious and careful and not loading the boat on these breakouts, waiting until they start to work, and it's just not working. CVI, let's see, what's the other one I was looking at? Took out the low. See, that needs more time. So we're in a holding pattern here. We're just in a holding pattern at this point. Monster's up a little bit. We got to see if this is going to hold. This might be another one that ends up squatting and reversing everything. So that's the theme right now. So why don't we take a little break? Maybe we'll take a half hour. What time is it? At least 15 minutes. Why don't we take a half hour? We'll go to 2:45. Get some lunch. I only had 2 eggs for the whole day. I'm gonna grab a quick lunch here, and we'll come back at 2:45. How's that? All right, let's see. Let me go back here. All righty. You all set, Bob? Can't hear you.
Looks good.
Okay. All right.
It is.
Be
It's
back in a-
Skype.
All right, we'll be back in a little bit.
Recording stopped.